We would like to thank our knowledge partner Deloitte, our gold sponsor State Bank of India, our silver sponsors Kia.ai and Shriram Finance, our logo sponsors Mahindra Finance, Ugrow Capital Limited, Credible ESG and Rupee Boss Financial Services Private Limited. Namaste and a very warm good morning to all ladies and gentlemen. On behalf of the IMC Chamber of Commerce and Industry, I, Selby Nambishan, would like to extend a very warm welcome to all our esteemed guests, industry leaders, distinguished speakers, media and delegates to the 14th Annual Banking and Finance Conference Advancing Last Mile Financial Inclusion in Amrit Kaal, Role of Banks and Financial Institutions. Today we convene to explore strategies, innovations and collaborative efforts aimed at reaching the last mile and ensuring that every individual, regardless of their socio-economic status for geographical location, has access to essential financial services. Before we delve into our discussions, I extend my heartfelt gratitude to our esteemed partners and sponsors who have generously supported this conference. Their unwavering commitment to advancing financial inclusion is commendable and serves as a testament to our collective dedication. It is said that lighting of the lamp amounts to awakening of the Atma Jyoti within oneself and welcome positive energies. To do the honors, may I request our chief guest, Dr. Shrikanta K. Panigrahi, Honorable Director General and Distinguished Research Fellow, Indian Institute of Sustainable Development, IISD, New Delhi. Our guest of honors, Mr. Sumnesh Joshi, Deputy Director General, Joint Secretary, Government of India level, Ministry of Communications, Government of India, and Mr. Surendra Rana, DMD, Agri, SME and FI, State Bank of India, along with our dignitaries, Mr. Himanish Chaudhary, Partner and Financial Services Industry Leader, Deloitte India, Mr. Sameer Somaya, President, IMC Chamber of Commerce and Industry, Mr. Sanjay Mariwala, President-elect, IMC Chamber of Commerce and Industry, Dr. M. Narendra, Chairman, Banking NBFC and Finance Committee, IMC, and former CMD, Indian Overseas Bank, Mr. Ajit Mangrulkar, Director General, IMC Chamber of Commerce and Industry, Mr. Sanjay Mehta, Deputy Director General, IMC Chamber of Commerce and Industry, and Ms. Sheetal Kalro, Deputy Director General, IMC Chamber of Commerce and Industry, to come forward for the lighting of the lamp. And wisdom. It shows the bright path forward, and so we initiate the inaugural session with the traditional lighting of the auspicious lamp for prosperity and success. With the positivities invoked, may I now request all the respected dignitaries to take their designated seats on the dais. All the dignitaries are requested to take their designated seats on the dais. All the dignitaries are requested to take their designated seats on the dais, sir. A round A loud round of applause, ladies and gentlemen. I now request Mr. Samir Somaya, President, IMC Chamber of Commerce and Industry, to present the welcome address. Over to you, Mr. Somaya. There's heavy rains in Bombay, so there is a little bit of shortage of people reaching. Kindly bear with us. Thank you. Over to you, Mr.
Ladies and gentlemen, a very good morning to you and a warm welcome. I'm delighted to deliver the welcome address at today's 14th Annual Banking and Finance Corporation Conference, Advancing Last Mile Financial Inclusion in Amrit Kaal, Role of Banks and Financial Institutions, organized by IMC's Banking, NBFC and Finance Committee. A special thanks to all our distinguished panelists and moderators from all sessions. We are grateful to you for sparing your valuable time and helping each of us in benefiting from your in-depth knowledge on the subject. So it is an honor for the IMC to welcome Dr. Shrikant Panigrahi, Honorable Director General and Distinguished Research Fellow, Indian Institute of Sustainable Development, New Delhi, as our chief guest. We are grateful to him for having spared his time to deliver the inaugural address. Sustainability is always environmental, social, and financial. Banks are required for the financial bit. Sustainability we have to have. The world is today having much reliance on fossil and having a lot of climate change. Dr. Panigrahi has been leading the knowledge thought papers in the country and advising the government as to how we can go to net zero by 2070. Thank you, sir, for sparing your time. I also welcome Mr. Sumnesh Joshi, Deputy Director General, Joint Secretary, Government of India, Ministry of Communications, Government of India. Sir, thank you for the leadership you are showing today and what you showed during the our unique identity. So thank you so much for leading that effort. And having India at financial inclusion would not have happened for the Aadhaar, for the Jan Dhan, or the mobile internet. So fantastic, sir, for that. I also welcome Mr. Surinder Rana, Deputy Managing Director, Agri, SME and FI, State Bank of India, our guest of honor. So you are leading the way, SBI. And we also know that advancing last mile inclusion, we have to reach the agriculture sector and the SME sector. Thank you so much. We are grateful to Mr. Himanish Chaudhary, Partner and Financial Services Industry Leader, Deloitte India, for preparing a knowledge paper for the conference. So thank you very much. The Banking, NBFC and Finance Committee of the IMC have put together sessions at the conference which are very relevant to the time we live in, and the speakers in each session, who are leaders of the domain, will enlighten us on the topics revolving around the theme of the conference, Advancing Last Mile Financial Inclusion in Amrit Kaal, Role of Banks and Financial Institutions. Financial inclusion has been identified as an enabler for 7 of the 17 Sustainable Development Goals. India has made significant strides towards this goal through the Pradhan Mantri Jan Dhan Yojana, under which 52 crore accounts have been opened so far, which collectively hold approximately 2.1 lakh crore in deposits. The financial inclusion has significantly impacted rural and semi-urban areas, where 67% of the accounts have been opened, out of which 56 account holders are women. Digital payment infrastructure is another important initiative of the government towards inclusion. There are other inclusion schemes such as the Pradhan Mantri Jeevan Jyoti Bima Yojana, Pradhan Mantri Suraksha Bima Yojana, Pradhan Mantri Mudra Yojana, Aadhaar enabled payment system, direct benefit transfer, Atal Pension Yojana. However, there are gaps that need to be bridged for creating financial ecosystems that include everyone. This conference has covered sessions for discussion by renowned experts on the whole gamut of inclusion, whether it is sustainable inclusion, bridging the credit gaps, inclusive insurance, and so on. The IMC Banking Committee, led by Narendra Ji, and all members of the committee have put together this conference that promises to be enriching experience to all participants. The Deloitte has ably helped in conceptualizing and preparing the knowledge paper for this conference, which will be released soon. We are thankful to them for support. A few words about the IMC. Established in 1907 and having its headquarters in Mumbai, the IMC Chamber of Commerce and Industry is an apex chamber of commerce, trade, and industry in the Western region, with its membership base of over 5,000 members and over 150 trade associations affiliated to it. Together, it represents an advocacy interest of over 400,000 business and industry establishments across the country from diverse sectors of the industry. Sir, it is the only chamber where Mahatma Gandhi had accepted honorary membership. Mahatma Gandhi also talked about inclusive development, inclusive growth, where no person was left behind. And this conference advances that. I once again welcome everyone to a very insightful conference. Thank you very much.
Thank you, Mr. Somaya. As a token of our appreciation and respect, may I request Mr. Samir Somaya, President, IMC Chamber of Commerce and Industry, to hand over a memento to our esteemed chief guest, Dr. Shrikanta K. Panigrahi, Honorable Director General and Distinguished Research Fellow, Indian Institute of Sustainable Development, IISD, New Delhi. To our esteemed guest of honor, Mr. Sumnesh Joshi, Deputy Director General, Joint Secretary, Government of India level, Ministry of Communications, Government of India. To our esteemed guest of honor, Mr. Surendra Rana, DMD, Agri, SME and FI, State Bank of India. A loud round of applause, ladies and gentlemen. And our esteemed knowledge partner, Mr. Himanshi Chaudhary, Partner and Financial Services Industry Leader, Deloitte, India. Our esteemed dignitaries' contribution to this conference is highly appreciated, and IMC is grateful of this. Thank you, Mr. Somaya. May I now request Dr. M. Narendra, Chairman, Banking, NBFC and Finance Committee, IMC, and former CMD, Indian Overseas Bank, to deliver the introductory address on the theme of the conference. Over to you, Doctor.
Good morning and welcome to all of you. It's a great pleasure to extend a hearty welcome to all of you, because in spite of some rain being the season, you have been able to come in time and be a part of this, our 14th Banking, NBFC and Insurance Summit. I am also grateful to all our chief guest of honor, as well as the other guests on the dais. And today, rightly, because this is the time when our Honorable Prime Minister Narendra Modi Sahab has assumed again the third time. And in this period of Modi 3.0, the importance of advancing last mile financial inclusion in the Amrit Kaal, the role of banks and financial institutions is very apt. So when I approached a lot of my friends about this program, they all said that, sir, you have done the program in the right time. So what it communicates, in the sense that India is already the 5th largest, economy, and it is now poised to achieve the 3rd largest economy. And our Prime Minister has set the, the goal of Vikasit Bharat, a developed economy, by 2047, that is in the Amrit Kaal. So in that period, along with the growth, we need to have growth with equity. In the sense, the benefit of this GDP growth should pass on to the last mile or the bottom of the pyramid, and we must find those who are really deserving in terms of the financial inclusion along with economic inclusion. The financial inclusion is the first step where we make access to the bank account. The next is the access to credit. Third is the access to insurance. Then the access to the pension. And I add one more thing, there should be access to equity. In the sense today, whether it is micro and small industries, or a retail trade, or a small business, or a rural agriculturist, the farmers, all of them along with the what you call debt, they also need a dose of equity. Equity in the sense capital. So if we are able to give, which our government of India also has made a scheme of fund of funds. And during the COVID, they brought out that scheme, and this has to be made available because whenever they need expansion, they get short of capital. And without the capital, they cannot achieve because the MSME is contributing almost 40% of the GDP and equivalent or 50% of the exports. So it is necessary. And along with that, they have to also be in line with the environment and social and governance, in the sense ESG. They have to comply with the ESG so that the supply chain becomes along with that, for which again, during all of you are seeing what is happening in the climate change and what has been affecting the vulnerable section of the population or such of the countries globally. So in that, we need to ensure that these companies also, the micro and small, gets into the mode of ESG compliance so that their products are accepted globally, not only India, even in globally. So in terms of that, how are we going to do? What is the role of the bank? Like, this Jan Dhan Yojana account, we have more than 50 crores account with the 2,03,000 crores. But now they need to be given credit and other facilities so that they engage in a productive activity. Then our goal of achieving third largest becomes faster. So banks should have to, this is the 50 crore is the golden, in a way, data with the bank. Now they have to be covered with the credit. So similarly, in terms of our JAM Trinity, that is our Joshi Saab knows that Jan Dhan Yojana, a mobile and Aadhaar. This is, and along with the digital public infrastructure, which all of you are aware, and the India stack. Now there is so much enablement has been done, and with the players like payment banks, small finance banks, or the regional rural banks, and the local area banks, as well as the public sector bank and the private sector bank, and the new generation bank, the ecosystem has been done very well because banks are in a very good health position now. They don't need any much capital, they are well equipped in capital. But there should be agenda for them in terms of the financial inclusion and economic inclusion, and they should take the flag very high so that we in the Committee of Nations will become a role model. That is very important. India should do the role model for others. And in terms of that, our various sessions have been done very well, and I am very happy that we have been able to get good speakers, and during the course of the deliberation, there will be a lot of takeaways for all of you who have joined here, and I was totally asked by that you should make it online. So we will send the deliberations later to all of you, those who could not come also, because with the guest like our Saab from our Dr. Srikant Panigrahi, who is my good friend, and he has been working on the climate change, sustainability globally, and he is in the Prime Minister's Committee also, and with this experience and Joshi's practical experience, where he did everybody to move and get that act done, and with the State Bank of India, which is the banker to everybody today, and with the Rana Saab here, I am sure the inaugural section will bring lot of inputs for you, and we will get benefit out of that. Wishing you all of the best, because my time I have to maintain also. Thank you very much.
Thank you, Dr. Narendra. Our knowledge partner, Deloitte India, has been instrumental in coming up with a crucial knowledge paper on building inclusive growth in India's financial landscape, emerging trends in banking, insurance, and asset management. I request our Honorable Chief Guest, Dr. Srikanta K. Panigrahi, to kindly release the knowledge paper along with the other dignitaries. Thank you all. A loud round of applause, ladies and gentlemen. A loud round of applause, ladies and gentlemen. May I now request Mr. Himanish Chaudhary, Partner and Financial Services Industry Leader, Deloitte India, to give us a brief insight onto the knowledge paper. Over to you, Mr. Chaudhary.
Good morning, everyone, and thank you for giving us the opportunity to be a part of this amazing session and of course, being a part of the IMC through this knowledge paper. I think it's a privilege for us, and it's also a privilege for us to be part of this extremely accomplished set of people that we share the stage with. So thank you once again. Insofar as the knowledge paper is concerned, of course, it focuses on the theme of the last mile financial inclusion, and we've tried to take a point of view on banking, insurance, and asset management as it kind of progresses to the last mile. There would be a certain overview of where we have reached so far and what are the steps that are the imperatives for the last mile. But while I would, obviously these copies will be circulated and it'll be there in the deliberations throughout the day, I would like to kind of give a little bit of perspective on how we, through our work as Deloitte, see last mile financial inclusion and relevant to the theme that we have for discussion today. In our minds, very clearly, India is really the poster child of financial inclusion. We have reached a stage where we have conquered the complexity and the scale of the problem, or of the problem that is financial inclusion, and we've done it using technology. Just a case in point, me and some of my colleagues were addressing the Australian Bankers Association in Sydney and Melbourne a couple of weeks back, and they wanted to know about financial inclusion. They wanted to know what we are doing, and frankly, they were in awe in what they heard about. Now, what is going to take us from what we have achieved to the heights that we want to reach? The first 10 years has been a start and then a kind of proliferation, and the next 5 to 10 years will be where it reaches the intended purpose of having insurance for all, having financial security for all, giving people the means to plan their finances, spend judiciously, and have the economic and the financial strength that every individual in this country should have. And for that, there are two levers that we would largely want to index our thought on. And the first lever is data. We are data rich. We want to be insight rich. So we have to go from information rich to data rich to be insight rich. And the moment we have more insights, we will be able to drive those insights into the last mile. And the second one is technology. And in that sense, we have a fantastic ecosystem. Our government is sponsoring the backbone of the ecosystem. And it is for the technology providers, the banks, the ecosystem players to leverage this and make this very vibrant. So technology, data, I think we have enormous will, and a will to build and a will to succeed. I think if we can get that together, then this will be this last mile financial inclusion will be faster than what we think it will be. So with that, I'll end my piece, and thank you so much once again to all the guests of honor, Mr. Narendra, for having us. It's a privilege. Thank you.
Thank you, Mr. Chaudhary. May I now request our esteemed guest of honor, Mr. Surendra Rana, DMD Agri, SME and FI, State Bank of India, to address the August gathering. Over to you, Mr. Rana.
A very good morning to all of you. And ladies and gentlemen, it's a great honor for me to be here today in the 14th Banking and Finance Conference of IMC. I'm grateful to have this opportunity to share my thoughts on this such a critical topic, very contemporary, advancing last mile financial inclusion in Amrit Kaal, role of the banks and the financial institutions here. So Amrit Kaal, as we all know, refers to the period of prosperity and progress, particularly in context of India's developmental journey. This term, which actually translates into the golden era, it envisages the nation's aspirations towards achieving significant socio-economic milestones here. And in this context, the last mile financial inclusion is critical. Last mile financial inclusion aims to bring the essential financial services to the underserved and the unserved populations, particularly in the rural areas and remote areas. And banks and financial institutions play a pivotal role in this endeavor, serving as a primary conduit through which financial access and literacy are extended to the marginalized communities. So when we say last mile, as we all know, last mile is always the most difficult one, be it a marathon race where many people drop out after maybe 20 kilometers, 30 kilometers, 40 kilometers, be it a relay race where again the last lap is the most important and if it is the make or break lap, or even in case of whenever people climb mountains, you find so many people dropping out before the last mile. So the last mile, reaching the last mile is of utmost importance to all of us. And towards that end, the Government of India, the Reserve Bank of India, and of course other institutions, they have done a fantastic job in the last 10 years or so. And RBI has implemented several initiatives to promote financial inclusions. These initiatives aim to provide affordable financial services to all sectors of the society, especially the underserved and the unbanked one. The Reserve Bank of India's initiatives of financial inclusion demonstrate a comprehensive and multi-pronged approach in integrating the unbanked of the society to the formal financial systems. Some of the initiatives, as you all must be knowing, that RBI has come out with, like it started with the Jan Dhan accounts, we all know in 2014-15 when the new government came in, and today, as one of the speakers was saying, 52 crore Jan Dhan accounts have been opened in the last 2 years, and I'm happy to share that out of those 52, 16 crores are with State Bank of India today. The other initiatives like the game changers have been the UPI, the NEFT, RTGS, which are now available 24/7 to everyone. Similarly, the AEPS, the Aadhaar-enabled payment services, has also been played an active part in including the lowest strata of the society to the main economy things. Payment banks and small finance banks. So RBI came up with this idea of having these type of banks. They have also played a very, very crucial role as far as reaching out to the last mile is concerned, sir. One more very brilliant initiative by RBI I must highlight here, and which is probably not appreciated to that extent by all of you, because you may not be directly related to the RBI regulatory sandbox. I must mention here there is a lot of work going there, and RBI has basically brought it out to enable regulated and orderly growth of fintech's ecosystem in India. The Reserve Bank and very few countries have this type of ecosystem, and within this ecosystem, the eligible entities can live test their initiative, their innovative products or services in a controlled environment. And we in SBI, we are participating in a big way in whatever initiative that RBI is coming out with, be it a straight-through process for KCC loans, and I think very shortly they are coming out with many more initiatives, RBI in this particular sandbox. RBI also takes a financial inclusion plan from all the banks every year. And all the unbanked or underbanked areas are basically covered in a way that nobody is left out in this entire journey, sir. Apart from this, what I feel in financial inclusion, one of the most important aspects is the financial literacy. And towards that, RBI also has a very good system in place. Banks also have been asked to create financial literacy centers in every district, one financial literacy center in every district, wherever any bank which is the lead bank in that district, they have to set up a financial literacy center, and it is now called as financial literacy and credit counseling centers. So it has been, the scope has been expanded now, and these are working very well in the entire country, throughout the country, sir. The government and other initiatives from the government like the Aadhaar and the other schemes like the Mudra, the Stand Up India, they all have played big role there. But now, as Mr. Narendra was just now saying, it is no more financial inclusion. The term itself has undergone a sea change now. The meaning of financial inclusion maybe 10 years back was to have a bank account and be happy with it, feel very privileged. But now everyone, the ambitions have increased many folds, and in the last many years, as he was mentioning, now people want insurance also, people want access to credit also, cheap and easy credit also, maybe pension also, and I think that's the way forward. And if these ambitions have to be fulfilled, then banks and financial institutions, they have to really come out in a big way with new innovative ideas here. But still, the challenges which we still have in FI in this country, maybe broadly, a few of them could be the geographical barriers, maybe reaching the last rural areas where the infrastructure may not be that good. Of course, the lack of financial literacy also is a big hamper in this particular journey, and a lot of things are happening there also. Technology constraints, yes, definitely. If such a large population has to be served, it has to be through technology. It cannot be any other mode. And of course, sometimes the cultural and social barriers also prevent people coming into this role. Coming to banks, banks have done a lot of things. Banks, they serve these populations through their branches and also through their banking correspondent, what we call as customer service point, CSPs. India, I think we have almost 3.5 lakh customer service points, physical ones, all across the country. We in SBI, we have almost 25%, 30% of them. We have around 82,000 CSP across the country, which is almost 4 times the number of branches we have. So the ratio is around 1:4 sort of thing. But with the advent of the handheld devices now, the payment banks and smaller banks, they have really taken to even further by giving the handheld device. And I understand from one of the data in RBI, probably there are 15 lakh such CSPs now who are moving from home to home to give these financial services at your doorstep here, sir. Microfinance and small loans, they are the backbone here again. And for that matter, the banks have been partnering with various stakeholders in this regard. Maybe government agencies, maybe some NGOs, maybe the fintechs also for that matter. Like many government, like I was posted earlier in Bihar, and we have a government department called Jivika, which works in close tandem with the banks for SHG, the self-help groups. And they are doing fantastic job, and in the last few years, the penetration has increased multifold. Similarly, in many other states also, you have such bodies which coordinate with the banks to get this last mile financial inclusion done, sir. As regards the making the credit available, easy access to credit, I think technology has to play the part here, and I must share with you here that at least we in SBI, we are doing a lot of things as far as bringing these facilities to the customers in a very techno-friendly way. Recently, probably I think I will just share with you, leak out something here today. Maybe very shortly you will see some big advertisements in the newspapers coming from SBI side. We have now digitized our SME journeys up to 5 crores. And we have tested it already, and it is basically, we have divided into 3 parts, I would say, 3 models, I would say. One is the Mudra model, that is up to 10 lakhs. Second is the smaller version, that is 10 lakhs to 50 lakhs, and then 50 lakhs to 5 crores. These all loans are digitized loans, and they draw the data from various data points, do some churning inside, and then come out with the result. And we rolled out this 10 lakhs to 50 lakh model somewhere around December in our bank. And I'm happy to share that we have already sanctioned around 20,000 loans through this process, and this is now working very smoothly. Now we are escalating it to up to 5 crores very short. Recently we have already started doing the 5 crore loans. and now we are coming out in a big way. We shall be doing good publicity so as to make, and it is all, the customer need not even visit the branch for this. He can, sitting in his comfort of his house, he can apply through, and the advertisement that will give, it will have the QR code also. You don't have to visit any site, just scan the QR code, it will take to the right site, and then you fill up your data. There will be some authentication, some verification, some validations, and after that, your application will travel to the bank, and bank will take a decision very fast, yes or no, and if yes, then how much, and how to get it. Those things will be decided within a span of 2 to 3 days or 4 days, max to max 5 days. So this will be a great enabler for all the MSME, small MSME customers for us here. Digital banking and mobile banking, of course, again is something which everybody is using these days, and everybody wants it here today, and without that, the last mile financial inclusion is just not possible at all. And financial literacy programs, as I already said, banks are running, and there is a body, National Center for Financial Education, which is run by RBI, SEBI, IRIDA, and PFRDA. And we, SBI, we have tied up with this body to use the reach of our 82,000 customer service points across the country. We shall be onboarding, selecting some of the CSP, and basically training them in the financial literacy, and they will be holding program in their areas on a weekly or on a monthly basis, so as this financial literacy things reach the last person in this entire thing, sir. Talking about, you said banks and financial institutions, there are other institutions also which are playing equally important part in this journey, be it the MFIs, be it the NBFCs, the cooperative banks, the regional rural banks, and of course, of late, the fintechs. They also have come out in a big way, and we, at least in SBI, are collaborating with the fintechs in a big way. We are onboarding them. We are dovetailing their product in our product so as to make it very easy for the customers to use. And fintechs, again, standalone, they may not be that effective. They may not have that reach and maybe that credibility also. But when they come with SBI, it gives them credibility as well as the ease of business. Someone talked about the digital public infrastructure in India. I think, of course, that is something unique to India. As as he was just sharing in Australia, they were really awed about the SBI. I went in a conference to US last month, and there was so much of interest among the other US banks and US companies about India. And when we told them, myself and SDFC, SEBI, there were 2-3 people from SDFC, and we were sitting together with a cup of tea, and when we started sharing what all things were doing, they were just awed. I mean, they said, oh, wow, all these things happening in India, we can't even think of it. So probably the digital public infrastructure has played a big role, and it has to, going forward, it has to play even a bigger role in this entire thing. I'm happy that all the institutions, the fintechs, the banks, they are using these DPIs in a big way so as to bring ease of business to the last customer. And one more last thing which I would like to just highlight here is no conference in India today is complete without talking about AI and ML. So here also, I think AI and ML, with the type of data that we have, especially SBI 50 crore customers we have, and the public infrastructure that we have today, be it the GST, Aadhaar, and so many things. Now account aggregators are also in the field now. I think taking into all these things together and using AI and ML, that is going to be the game changer going forward here. And I'm happy to share that banks have already started using AI ML in most of their products, developing their products. And going forward also, we shall be doing it in a big way, and we shall be the biggest contributor in this journey towards this thing. So to conclude, advancing last mile financial inclusion in Amrit Kaal is not just a financial imperative, but a social and economic necessity now. Banks and financial institutions are at the forefront of this mission, employing a variety of strategies to ensure that no one is left behind in this financial ecosystem. By expanding their reach, leveraging technology, and collaborating with various stakeholders, these institutions can transform the financial landscape and contribute to a more inclusive and prosperous society. The journey towards comprehensive financial inclusion is challenging, but achievable with concerted efforts and innovative solutions. I wish IMC a grand success for this particular conference here, and I'm sure I have gone through the topics which are lined up for the panel discussions. They are very, very thoughtful, thoughtfully carved out. And I'm sure a lot of tangibles will come out from this, this particular conference. And we will be happy to have all those, anything tangible that comes out where we can also contribute towards this particular aim in a big way. We will be thankful if you can share with all those things with us also. So my best wishes to IMC for this conference, and thank you, each one of you. Thanks for the internet.
Thank you, Mr. Rana. May I now request our esteemed guest of honor, Mr. Sumnesh Joshi, Deputy Director General, Joint Secretary, Government of India level, Ministry of Communications, Government of India, to address the eminent gathering. Over to you, Mr. Joshi.
So very good morning to everyone, and respected all distinguished guests and chief guests and all eminent speakers and distinguished participants, and hall is full. In the Amrit Kaal, that is till 2047, there's a roadmap that Government of India has already laid down under the leadership of Honorable Prime Minister, and we all set just to accelerate, the lot of ecosystem is already created. Now we have to reap the benefit of the ecosystem. And objective, as the earlier speaker told, it's the Antodaya. We have to serve the person who is in the last, who's at the last mile, the last in the queue. We have to reach up to that point. And how we have to reach that, it's organizations, entity have to innovate, find out some ways and reach. And United Nations Sustainable Development Goal that we have to achieve by 2030, 8 SDG goals have financial inclusion as a very prominent space. Without FI, they can't achieve those goals, whether it's hunger or poverty, all these things. But it's a linkage with all those goals. And I can say with proud that India first has shown as a form of the digital identity Aadhaar, first DPI, and we have given the 52 crore account under the Jan Dhan. Because if FI and bank account are not there, UPI is not a success. See, the way we are seeing, gone are the days when the credit card is a luxury. Now, every street hawker, vegetable vendor is doing the digital transaction, use the UPI. This is the power that we have shown to the world. And last year in the G20, we have showcased to the rest of the world. So everyone is after India that how to do it, this DPI, how to reap the benefit of the DPI. And ecosystem, what I can say, it's ready. So one is the identity, everyone is in the identity. Now this is the one core. Another core now based on the financial inclusion. So bank account is a core now. So this bank account opening is not a financial inclusion, it's now the core, it's the foundation. Now we have to build upon that foundation. So many products. And in this, again, how to serve? At the last mile, what we required? First, connectivity. So connectivity for the far-flung areas, now we have 1 billion plus mobile phone, all 4G, very high-speed connectivity is available. And in October 22, 5G is launched. So many of the areas now, 5G is available. It's a low latency, real-time communication. And now IoT devices, the sensor devices will communicate directly with the 5G network. So again, and I can say with the proud that India has rolled out, is one of the fastest rollout of the 5G in our country, all across the world. So now we are growing ahead. And fiber, 2 lakh gram panchayats are connected on the optical fiber. And the BharatNet phase 3, all the remaining panchayats are going to be covered through the optical fiber. So we have to ensure this digital highway, OFC, each and every village. So if someone wants to open an industry there, see, immediately they can reap the benefit of the digital highway. Now it's not only the road as a highway, we require the digital highway. So that is again one of the priority area. And government is again, very ambitious project that is underway, and this year we are going to complete it. There are villages around 26,000 where no connectivity at all. But we have to serve those villages also. So, and with the Make in India technology in the 4G that CDOT has developed, the work is underway to have 4G saturation in those villages. So objective is that everywhere we will have the high-speed connectivity so we can deliver the services whether it's the financial inclusion or any other services. Of course, now financial inclusion, I term is just a foundation. See, without this, it's very difficult to, provide more and more service because banking is required. Now, we have entered into the new era. As Rana Saab has mentioned that without AI/ML, we can't, conclude any conference. So all AI/ML, Internet of Things, DPIs, all cyber securities, all these things you put together. Now we have to again innovate, and we have to reap the benefit, and we have to, promote the startups also, right? So maybe what processes we can automate, what other value addition we can give. So again, Ministry of Communication has designated 100 universities or institutes as a 5G labs. So where banks as an industry or maybe your startups can do some prototype testing, and you can find out how 5G can be used, for any banking application. So you can design a system, you can collaborate. So ministry is ready to work with industry or any startup that we can work towards achieving this financial inclusion goal in a broader sense. And maybe all are aware from the banking industry, the RBI Innovation Hub has come up with a public tech platform for frictionless credit. That is very much required. Why it is taking weeks only? Why not a minute? So now every data is available. So through the API we can connect. So they have come up beautifully this platform where the civil score is connected. So this pilot was done in the Ahmedabad, in Gujarat, with the Amul dairy farmers. So farmers data, landholding data, how much milk they are selling to the Amul dairy, that data. So basically the information-based lending. So I will not dwell into detail because you are bankers or from the financial industry. So if we know that, okay, this is the turnover, so bank can give the loan. And it's not only the Amul dairy. Why not a vegetable hawker? When we speak to any taxi driver, they say, no, sir, I can't afford the car. I'm paying rent every day, 500 rupees or 800 rupees to the owner of that car. But revenue is, he is earning every day 2,000 rupees. So as sir, the cost of that 2,000 rupees is the 500 rupees per day. So that now again we have to work that how to ensure that those type of people, based on this information, because everything is digital, the money is going into the bank account, so one can deliver. And of course, using the AI/ML risk analysis, we have to do. And it's again at geography to geography, it varies. So maybe banks can quickly do the risk analysis and give the loan. One can see the consumer behavior also using the AI/ML. Even the CCTV that is available in the bank branch, we have lots of data, but if you are not using the data, it's a garbage. So one can, using the AI/ML tool, you can find out how many customers are entered, which counter they have gone, the customer comes in happy mood or sad mood, in which mood he has gone back. So you can do lots of things, what is the time spent on a particular thing. So we can find the consumer behavior, what they want. And as Rana Saab rightly pointed out that lots of data is there, so we can find out behavioral pattern and what type of need. And sometimes, whatever the pattern, expenditure pattern we are having, how we are earning, even the AI/ML tool can predict that, boss, if you go by this way, you require a loan after 3 months. So do something. Or maybe you are a surplus money. You can invest in these type of shares and mutual funds. You can earn a lot of money. So, all these things, yeah. Caveat is security and the privacy. That one has to ensure that it's all consent-driven mechanism. And ESG, of course, it's one of the goals. So banks are actually have started, and some of the startup also have seen that they are promoting the green, green thing, and the industry who is maybe making the green automobile, or so they are giving some incentives to them also, and many other ways. Our task is to achieve the net zero. For that, our chief guest will elaborate in more detail, so we love to hear him. And then now UPI, of course, 13 billion transaction, more than 13 billion transaction in a month, but still more banks have to come on the UPI. There are not only the 500 or 600 banks, there are many cooperative banks also. So it's again our duty and responsibility how to handle them. Because there are many customers served by the cooperative sector. So those should come up with the digital apps and UPI, etc. And of course, women empowerment. Because one great thing has happened because of the financial inclusion that we have seen, it's the empowerment of the women. When I showcased our AEPS Aadhaar enabled payment system to then US Treasury Secretary way back in the Machimar Nagar in the Mumbai, he was amazed that in US also no one can open the bank account so fast. And the transaction started immediately. And the lady that who is selling the fish every evening, now she told, now I am able to save in the bank account. So it gives a sense of proud to that lady that now I have a saving of 2,000 rupees. So that is how, we are contributing to the economy. And there is a trade-off between the convenience and the risk. So then we have to, in the way, geography to geography or customer to customer, that how we have to provide the convenience and what is the risk associated. We have seen in these days, there's a tremendous growth in the cyber frauds, phishing, SMS are coming, fraudulent calls are coming, and many people are falling to the prey. It's not only the people who are in the village, so-called literate person are also falling to the prey. It's not that, so the financial literacy, I say it's not that literacy of the ABCD. See, it's something different. So maybe we also require that type of literacy, right? So for that, bank have to work. And last, 2 minutes more? I can take? Okay, sorry. So 10 minutes is very, less as such. So I will finish. So one thing that I would like that banks should work proactively. See, it's of course your main primary job is to give the bank account or give the financial product, etc. So now next disruption is coming in the form of the ONDC, that is Open Network Digital Commerce, where every individual, artisan, anyone can sell the product, right? Maybe they are creating as a hobby also, but they can sell on the ONDC. So bank account is required. Now banks have opened the bank account, but what we want, banks should proactively engage those person onboarding of the ONDC. So what will happen? He will earn money, and money is saved into the bank account. Bank will get profited by this. So ultimately the economy will, so the bank, if promote the ONDC onboarding, so everyone will come like this. Many things, maybe the farmers, right? You give the loan to the farmer. Make your BCs as a, give IoT-based service to assist the farmer that your productivity can increase by having the testers that, okay, moisture level or maybe a pesticide is required or whatever. So if productivity is increased, he will earn more, default on the loan will be less. So, this is a cycle. So if bank should come out with certain policy to help the customers also for making the, increase the productivity, that will be a great thing. So thank you very much for inviting me here. But one thing I forget before I say, the fraud is happening a lot, right? So 1930 is the number where everyone is aware, but again I say always 1930 number where you can report the fraud. And now this has become a last mile tool, very important. If it is lost, you are nowhere, where to report, right? And maybe you are also not aware that how many phones have been taken, SIMs have been taken on your name, because earlier it is given on the based on the paper, right? And someone can misusing those numbers. So Ministry of Communication has launched the Sanchar Sarthi portal. Please do visit and spread the word about it. So any fraudulent communication, any phishing message, or if your mobile is lost, you can report on that portal. It is a recent initiative taken by the Ministry of Communication. So thank you very much.
Thank you, Mr. Joshi. And now, ladies and gentlemen, the moment that you have been waiting for, I humbly request our esteemed chief guest, Dr. Shrikanta K. Panigrahi, Honorable Director General and Distinguished Research Fellow, Indian Institute of Sustainable Development, IISD, New Delhi, to address the eminent gathering. Over to you, sir.
It is indeed a great pleasure to speak to you for a few moments on a very important subject which matters to all of us. I would like to thank IMC for inviting me and get me here. And this is an area in which we are working with a great deal of dedication and in research, in policy making, and translating things into action on the ground. If you see the topic, it's extremely important. Advancing last mile financial inclusion in Amrit Kaal. Role of banks and financial institutions. All of my previous speakers very profoundly brought out a lot of issues, making my presentation very simple. I have a very detailed presentations. Now I will have the options of integrating and make it very small and powerful. I would like to congratulate Sri Samir Somaya for which in his leadership this program is being made, and I am quite impressed that he is not only an industrial leader but also is a profound personality from knowledge domain, a thought leader, and also he is playing a big role in promotion of knowledge by building institutions. I would like to thank Sri Sanjay Mariwala, who will be President-elect, and he is also has shown profound leadership in the sectors and needs appreciation. I would like to congratulate Dr. Narendra. He is the soul behind the entire program that is happening today, and he has architectured it in so nicely that the theme, sub-thematic areas, and the guest and audience all are very profoundly designed. He has a great experience of last many years. He is former CMD Indian Overseas Bank, and a proud among very few rare financial sector leaders in the country. So big hand to him. I would like to congratulate two of the guest of honors who has exemplary made the presentation, particularly Surendra Ranaji from State Bank of India. He has not left any single point. He has covered everything in a very detailed and the most upgraded manner, which is not an easy thing to be done. And a person who is very deeply and technically involved right from the policy making to translating into the ground, he can have the capacity of delivering such a wonderful detailed lecture. I would like to congratulate my colleague from the government, our Sumnesh Joshi ji, who is from the Ministry of Communication. He has profoundly covered many key points of my presentation. So I would like to congratulate him. And Deloitte has brought out a small and impressive report, and it is just a teaser. The main course is yet to come, and I hope that will be equally profound and bridging the gap in this most important sector of inclusivity. So in this auspicious occasion, I would like to cover, I have a very specialized subject which is connecting to the main theme, that is India's global leadership in financial inclusion and sustainable finance achieving UN SDGs. We have multiple objectivity. India is now world's 5th economic power. India has a very impressive growth plan ahead. You all know that. I am not wasting time by repeating our growth objective. And all these growth objective to achieve we have to be equally sustainable in our path. Those days are gone. We don't have a luxury only to concentrate profit without thinking about social or environmental issues. So, in such a context, I would like to tell you a little bit on climate change. All of you know now the world is at the crisis. There is no cold currents. All the currents has become hot ocean currents, and they are frequently changing their path, and that is impacting our ocean life and the global carbon reserve hugely. You know, the west coast of India was not used to face cyclone before, only eastern coast used to be. Now it has become even more frequent in the western coast, affecting a lot of property and life. So, because air pressure belts are changing, and the lower pressure air pressure belts has become heavier pressure belts, and the monsoon pattern and entire changes has happened. And the benefit is Mumbai has welcomed us today with a pleasant weather. The India has shown its strength in G20, and while thinking about financial inclusion, the climate inclusivity, the climate risks finance, and the ESG risk mitigation all comes together. They are integrated. You only concentrate for financial inclusion, that will ensure you the rest. So my presentation will briefly cover the financial inclusion. This pointer is, sir, the red pointer. Huh?
Not going?
Not going. But anyway, if it is possible, then. लाल वाला pointer.
Pointer है? हाँ इधर
उधर नहीं आ रहा है. So we will be talking financial inclusion, and from financial inclusion we will go to sustainable finance, which is in number 2. Sustainable finance again will connect to climate risks, and which is also related to ESG risk finance, and that will ultimately translate into climate risk disclosure and how do we manage that. We have 4 credible institutions, national and international level institutions having existence of last 16 years, and relentlessly round the clock we are working for sustainability and decarbonization. And we celebrated Global Sustainability Summit in Vigyan Bhavan in the plenary hall last year, and this year also we have planned it. It may happen in September. So I am not telling more about the institution. The presentation have it, you can know. You must, I must mention that 30 airports, international Indian airports, we have certified carbon neutral, which is a great achievement, and it is level 2 airport carbon accreditation. We are into maritime sector, we are into aviation sector, we are into biofuel sector, energy sector, green hydrogen sectors, and climate risk mitigation and ESG sectors. So these are the institutions. There is a carbon management school, there is a school of business sustainability, there is a Carbon Minus India, and the Indian Institute of Sustainable Development. Now, what is financial inclusion? Financial inclusion is something, finance is key to growth, and no growth is possible without inclusion. What is inclusion? The last mile, which is the topic. And what is last mile? The Gandhiji's talisman. What is talisman? If we are going to do something, whether it is going to benefit the poorest of the poor, if it will bring a little smile in his or her face, then we'll say we are in right path. This just to test whether we are in right direction or not. So inclusivity is nothing but to carrying everyone along. सबको लेके इकट्ठा जाना ही inclusivity है. We need a inclusive growth, we need inclusive finance. Without inclusive finance, inclusive growth is not possible. Without inclusive growth, there is no meaning of development. But India is a country with a lot of disparity. The 10% of our wealth is concentrated with 10% of the population of the country, the 90% of the wealth is accumulated, and the vice versa. It is not distributed very well, which is not there anywhere in the world. So that is the largest challenge for which inclusivity is the key. So you know UN SDGs. My previous speakers have told about you. There are 17 goals. The objectivity of these goals is to ensure inclusive growth and to bring sustainability where no one will be left behind. While walking, we have to carry everyone along with us. So that is again, all these 17 goals has three large verticals. One is environment, social and governance. Governance could be the economic indicators too. So sustainability has three pillars: people, planet, profit. Profit can be told economic also. So, and the governance, it is related to governance as well. So this is ESG. All the 17 goals has been distributed. Everyone should be carried along with this, and that's the key to the entire objectivity of this presentation. India has a big ambition. What is this? To become 30 trillion economy by 2047. Where is we now and what we are aspiring for? Will it be possible? And if it will be possible, will it be unsustainable or it will be sustainable? That is the questions. You know this. I am shifting to next. We have banking institutions, banks, insurance, there are pension funds, all these are there. Other than this, the non-banking financial institutions like my friend from SBI explained you, so which are dominating non-banking financial institutions, and largely with government institutions of such kind, SBI has a collaborations. We work with IRIDA, we work with SEBI, we work with Grid Controller of India, and all of them are part of this process. And in this, we have government initiatives, and there are technical adaptation. And technology adaptation is the key. Without technology, inclusive is next to impossible. So, and government initiatives, because in last 10 to 11 years, we have achieved a lot of inclusivity in financial sectors. Now anybody can open an account. There is a lot of transferring of money is happening. All these, you know the story, it has been told by my colleagues. I am not going into the data points. Like Jan Dhan Yojana is considered as the largest focal point of inclusivity, and so all these points are the subject of inclusivity, and these are the challenges ahead. This is also covered by our colleagues. Now, UPI, you know, it is already told. I will tell you a very interesting story. I was speaking to Dr. S. Jaishankar, who is our proud External Affairs Minister, Foreign Minister. So when he was in US during security verification in the Newark International Airport, his COVID, how many vaccines you have taken? So he showed it in the mobile and his clearance was done immediately. His son was struggling to find out a paper from the money purse to show a hard copy, and it took a lot of time. So Jaishankar told his son, you are living in a developed country, I am from the developing country. So US doesn't have a system that is so advanced. When in G20 so many foreign countries came to us, they told your ordinary thelawala is having a UPI. He neither has a money, there is a box to keep the cash, nor the people have a money purse, and it is all happening very smoothly. So whole world is after India to assist them to introduce UPI system in their countries. So India's respect and got enhanced because of these instruments. Our banking transactions are very fast, one of the fastest in the world, and the digital transformation that we are having in banking sector, no other country is having so far. So we have spoken about digital lending, bridging the credit gap. So these are all extremely important points. And the most important point is AI and machine learning and IoT, all the emerging technologies in India is a front runner, and this government Modi 3.0 has an ambitious plan to create a special fund for AI. So insurance sector is as important as the banking sector, and because from this links to climate risk and ESG risk. And if you say there is a lot of success story of the LIC, that is, and other agricultural insurance and other kind of insurance, and insurance sector is vital because it find out the solution to risks through financial which is mechanisms which is affordable to and a win-win case. So there are micro insurance policies for the government. There are many things are happening into ground. I am not going into the detail for that. And there are many Prime Minister Jeevan Jyoti Yojana, Prime Minister Suraksha Bima Yojana, all those are there which takes care of the insurance policies of the government. Now the sustainable development goal, to make it successful, the most important is the social and economic inclusion is must, and to achieve that we have to have a series of risk management policies linking to many of these UN SDGs and almost all of them. You cannot think of poverty reduction, reduction of hunger, empowerment in education and health, women empowerment without financial inclusion or risk mitigation. Coming to the, so these are the various policies and programs in which Government of India has taken a global leadership to achieve those goals. And this is just I am giving you an example of women empowerment, UN SDGs 5. If you see the gender equality, the PSBs, what is PSBs? Public sector banks. Public sector banks is going out of the way so far as policy interventions are concerned to support the women entrepreneurs to make them lending both in depth and equity availability smoother, so that women's participation in financial inclusion will enhance. This is a news about 3 to 4 days before, where the public sector banks are taking very dynamic role. Subsequently, it was just 2 days before, there was a news that it may take 154 years to achieve 100% gender equality in the world. There are many challenges to making men and women equal. It has taken over years for the problems, so it will also take an equal amount of time to achieve the gender equality. And this report is given by Global Gender Gap report by World Economic Forum, which says 154 years more world will take to achieve 100% gender equality. And in such a context, Indian public sector banks initiative is really credible. Now I will be coming to the sustainable finance. Sustainable finance is the very basic and fundamentals to economic development, and also to be succeed in achieving SDG goals, and as well as ESG goals. So sustainable finance, many people don't understand its boundaries. People say it is just a buzzword, but it is not like that. It involves the risk finance, ESG risk finance, climate risk management by Indian banks, and climate risk disclosures. This all will be covered under this banner. Next one. So, what are the global risks? There was a Forbes study, and there are so many risks has been identified. At the top, it is cyber security is the largest risk we are having and encountering right now. Next to this, the climate risk, the risk finance, ESG risk, because natural calamities are happening which we don't know when what will happen. And when some natural calamities is happening, it has a great impact on the lives as well as properties and total number of days that it is happening. So how to do the climate risks or assessment, or how to take the adequate precaution for that? I will congratulate State Bank of India, inspired by the RBI's principles. RBI has 2 proud publications by now and papers, and followed by recently a draft disclosure. SBI has come up with a detailed procedural document how the risk is to be achieved, and they have started appointing climate risk officers in various branches. And it was interesting for me, but I saw one advertisement 3 days ago that they have advertised for vacancies against climate risk officers. So big hand to SBI. So what is a financial risk? There are many types of risk. So financial risk is defined in financial term as the chance that an outcome of investment's actual gains will differ from an expected outcome or return. आपका प्लान कुछ था कि इतना रिटर्न पक्का हो जाएगा. You have calculated return of investment ROI. You have calculated internal rate of return. All will fail. Some unexpected monsoon disruption will be there. There will be flooding. There will be drought. There could be cyclone, and you don't know what has happened. So how do we manage financial risks, and what are the type of financial risks? The first thing is market risk. SBI also advertised for market risk officials. The second is credit risk. Third is liquidity risk. Fourth is operational risk. And fifth is legal risk. These are the 5 risks that a financial risk involves. And how do we manage that? This is the RBI's document. It first came in July 2022, and climate risks document. And according to this, there are it is the first on behalf of the Central Bank of the Government of India. There is a report came with few definitions and directions how the banking, insurance, and both FIs and NBFIs will be working in this climate risk sector. Followed by a survey. This is RBI's survey, and which bank is doing what, which insurance sector is doing what, whether it is adequate, if they have got enough awareness, all are very well described in this report, and it is a eye-opening report. Followed by this, SBI's detailed report came. The other banks are also proactive, and they are in the process of building this. This is draft disclosure framework for climate-related financial risk. This has come on 28 February. You all are aware about it. This is SBI's climate risk management policy, and this is the advertisement in which they have advertised for market risk officer and the climate risk officers vacancies. And it is a naturally it is a eye opener and the very good beginning. I am confident all other banks will follow this path. We have many windows for financial inclusivity, and which relates to climate related risk mitigations. These are the global instruments as given by European Union. You must have heard about CBAM, Carbon Border Adjustment Mechanism. It is affecting India's economy in a big way, and particularly 7 sectors and first prime sectors, metal sectors and petrochemicals and chemical sectors, it is largely affecting. So if any Indian export has to be there into the European Union, as per the European standard, if it is not done, the kind of the carbon adjustment that has not taken care, against that they have to pay a carbon tax to European Union and buy the certificates which will slowly replace EU ETS. It's very interesting and powerful international process. Not only European Union, Australia is having one, US is having one, Canada is having one. European Union has started strictly taking it up, and it will be operational, truly operational from 1st January 2026. UNFI is extremely important. United Nations Environment Program has brought out its principle for responsible investment and financial sector on sustainability, which is few Indian banks has also got a certification from UNEP-FI, and any banks which is following these sustainable banking principles as per the United Nations Environment Program, they offer this to them. The UN principle for responsible banking, principles for sustainable insurance, I am not going into details, my presentation will be made available to all of us. IIST CMI is a proud member of the GEFI, Global Ethical Finance Initiative. It's a very active in the United Nations negotiation platform and playing a big role, and so the member organizations are committed globally to financial inclusion and climate finance under this banner. Climate risk strategy and mapping, this is the basic 3 principles. I will also, before closing my presentation, I would like to tell you, India is going big for a carbon market. We at IIST very deeply involved with Prime Minister's office, Ministry of Power and Ministry of Environment and Forest in 2 things. One is Indian carbon market. Indian carbon market is going to create an internal carbon market where carbon credits will be traded among the industries and businesses within the country. And this is the notification. And there will be another green credits which Honorable Prime Minister declared in COP28 in Dubai last year. So this is Indian carbon market, how it will be saved, and Ministry of Power is the ministry, right ministry, and Bureau of Energy Efficiency is the supporting agency, but it has a multi-ministerial team and, being regulated by PMO. This is CCTS, Carbon Credit Trading System. It's again proud system by the Government of India. During Kyoto Protocol, CDM was there. So we are not having any target as a country, but now under Paris Agreement we are having a target. We are third largest emitter of greenhouse gases. So we are responsible for all these greenhouse gases, and we are required to pay a tax against that under Article 6 of the Paris Agreement. So if we are reducing that through some measures inside the country, creating an internal mechanism, our carbon tax burden will reduce. This is most important. I am concluding the blended finance. There is a huge shortfall of money. We cannot guarantee sustainability without financial resources, and from where these resources will come from. The government doesn't have enough money for that, and when there is a private investment is required for sustainability, it has to a sense of business, a sense of profitability. So how that can be assured to private players? So we need, so this is called blended finance, and this is the commercial capital, the concessional capital from government, and commercial capital both from public and private. They needs to be blended to achieve UN SDGs. And this is European Union, strategic public investment, private investment, both needs to be mobilized together as a blended finance to achieve sustainable finance and risk finance. So that's my profile, and thank you very much.
Thank you, sir. And as we conclude the inaugural session, may
Can I make a request to Dr. Panigrahi?
Yes.
Yeah.
Sir, thanks for your appreciation for SBI, but can I request, can you put a representation to RBI to give some incentive to the banks, those who are going in for green finance? In the sense, like, sir, it's a very, like we have priority sector obligations, 40% we have to do for priority sector. So banks which are not into infra financing, banks which are not into this green financing, they are easily achieving it. But bank like SBI, if I give some 10,000 crores for some infrastructure project, I have to lend 4,000 crores for priority sector, otherwise I am penalized. So if I finance for infrastructure or if I go for green finance, can it be considered as a priority sector lending? Or if not, then can it be excluded from my base at least, so that I don't have to do that much more correspondingly. So maybe from your institute, through you, if I can.
Yes, you are very correct. It has a requirement and it is extremely important. And government will surely take up this issue. We need to make up a representation, and because without this it will be difficult to promote in a large scale in the entire banking ecosystem. So SBI did a very good beginning, so the morning shows the day, created a example, but to making the entire program and system sustainable, financially sustainable in a longer run, there has to be arrangement from public funding, and we need to take up this from with the government, and I am confident it will happen. and we at IST will extend all support to take it ahead.
Thank you, sir. And as we conclude the inaugural session, may I request Mr. Sanjay Mariwala, President-elect, IMC Chamber of Commerce and Industry, to present the vote of thanks. Over to you, Mr. Mariwala.
Thank you. Dr. Shrikanta K. Panigrahi, Honorable Director General and Distinguished Research Fellow, Indian Institute of Sustainable Development, New Delhi. Sir, we are grateful to you to spare your time and address the gathering today on the 14th Annual Banking Finance Conference. We brought out very interesting elements in sustainable development, inclusive goals we need, the risks and challenges we face as a country in wealth creation and distribution, and why technology is important for the industry. I think this was a very, very useful session. Please join me to give him a big hand. Mr. Sumnesh Joshi, Deputy Director General, Joint Secretary, Government of India level, Ministry of Communications, Government of India. Thank you so much for your address and your sparing your time for us. We appreciate your visit and the points that you made today, sir. Mr. Surendra Rana, Deputy Managing Director, Agri, SME and FI, State Bank of India. Thank you for bringing out how the systems are changing and how banks are changing in the country. The importance of digital in information, including in the last mile linkages. We thank you so for agreeing to be a part of this conference, and thank you for sharing the MSME loan digitization goal. Please join me in giving him a big hand. We're grateful to Mr. Hamanish Chaudhary, Partner in Financial Services Industry Leader, Deloitte India, for preparing the knowledge paper for the conference. Who pointed out the importance of inclusion and using technology to achieve these breakthroughs. Thank you so much, Mr. Chaudhary. A vibrant and resilient banking sector is at the foundation of India's economic growth. The investment that banks make today will not just guide the future growth, but will also help institutionalize innovation amidst a potentially turbulent global macroeconomic scenario. As we come to an end of this morning inaugural session, I'm confident that the day-long conference will throw up many interesting perspectives on the theme of the conference, which is advancing the last mile financial inclusion in Amrit Kaal, role of banks and financial institutions. We look forward to hearing our eminent speakers as we go along. I would particularly like to express our gratitude to Dr. M. Narendran, Chairman of IMC's Banking, NBFC and Finance Committee and former CMD Indian Overseas Bank, Mr. P.D. Singh, Chairman of IMC's Banking, Co-Chairman of IMC's Banking, NBFC and Finance Committee, IMC, and Bank CEO, JP Morgan Chase Bank. Mr. Mahesh Thakkar, Co-Chairman of IMC's Banking, NBFC and Finance Committee and Director General of Finance Industry Development Council, for conceptualizing and structuring such an interesting conference and getting prominent personalities from the domain to speak at the conference. I would like to thank Ms. Pooja Bharwani, Executive Director, Deloitte Financial Advisory, Financial Services, FinTech sector, for a coordination preparation of the knowledge paper for the conference. I'd also like to take this opportunity to thank our knowledge partner, Deloitte, our gold sponsor, State Bank of India, our silver sponsors, Kia AI and Shriram Finance Limited, our logo sponsors, Mahindra Finance, Ergo Capital, Credible ESG, and Rupee Boss Financial Services Private Limited for their support towards the conference. We look forward to their continued cooperation for all our future endeavors. Our sincere thanks to the media representatives for participation and to all the delegates and all of you for joining in such large numbers. Last but not the least, the IMC team for the hard work and putting up such flawless execution. Thank you all.
Agarwal, CEO, Emirates NBD Bank India, and Mr. Madhav Nair, CEO, India, Bank of Bahrain and Kuwait, BBK. Kindly take your nominated seats on the dais, sirs. May I request all to take their seats? We are beginning the panel discussion. Over to you, Mr. Singh. All are requested to take their seats. The panel discussion has begun. Ladies and gentlemen.
Yeah, good morning, everyone.
Thank you.
We are all set to start. May I request everyone to settle down? Hello?
Please settle down, ladies and gentlemen. On the right-hand side, please settle down.
Yeah, anyway, I guess we're going to start in the interest of time because we are already running a little late. So, firstly, a very warm welcome. The topic for today is the role of banks to achieve sustainable inclusion in the next decade. And we have with us a high-powered panel. It is going to be, I promise you, a very exciting discussion. But first of all, we will start with some of the very important part of what's happening in the country today. So a lot of us want to know, and I have interacted with a lot of people just before this session and before we started. And the popular demand is that before we start, we want to know from these doyens in banking exactly what's going to happen in the economy and what's going on in the international arena as well. So let me introduce my panelists first. We have Mr. Rajiv Anand. He actually requires no introduction. He's the Deputy Managing Director at Axis Bank. He's someone known in banking circles who has created large and scalable models. He's an expert, as we all know, in the financial services industry. His strength has been in capital markets. He's a CA by qualification, has held many important roles in the bank. And has worked with many other international banks as well. So thank you, Rajiv, for being here. We also have with us Mr. Sharad Agarwal. Sharad is the CEO of Emirates NBD Bank. He's been with this bank since 2007. It's a rare thing for folks to have worked for the same bank for so long. He spent a decade in the Middle East as well, where he's done multiple functions. And when the bank started their India operations, since 2017, he's been their first CEO. He's worked for HSBC Middle East for a number of years as well. And 25 years ago, he and I used to work together as well. So there's a long history there. Sharad is an MBA, CFA, and has a diploma in leadership from the Duke's University. Since Mr. Rajneesh Karnatak was summoned by the new government, and now you can realize the pace at which things are moving. So he was not able to make it for this. I got a call from him just this morning. So he sends his regards and his message for the event. Very graciously, Mr. Madhav Nair has agreed to join us. Madhav, as you all know, is a prominent figure in the banking industry. He's part of many forums. He's been part of the Indian Banks Association for many years, where he's also the chair of the Standing Committee on ESG. Madhav is the CEO of Bahrain, the BBVA Bank, the Bank of Bahrain and Kuwait. Have I got that right, Madhav? Great. Actually, he's a brand on his own, so he doesn't need any other. So let me start maybe with the questions that our audience had on the economy, and I'd leave it open to any of you to talk about it, where we have entered a new phase, and we also have a lot of continuity as we've seen signaled by the government in various forms. Maybe Rajiv, if you have any comments on that.
Yeah, now that, firstly, thank you, PD, for having me here. Really delighted to be here. I think now that we've got the elections out of the way, and now that we know that exit polls are not to be believed, so let's move forward in terms of what's happening as far as the economy is concerned. I think the fact that there is going to be continuity, I think, is certainly very positive. We don't anticipate any, sort of major changes as far as government policy, etc., is concerned. As I look at the banking system itself to start with, and I think previous panels spoke about the fact that a strong and resilient banking system is critical for the growth of this country. I can assure the audience here that whether it is private sector, public sector, foreign banks, I think from an Indian perspective, the Indian banking system is in fine fettle. It is well capitalized. The asset books are well managed. Risk is well controlled, and I must compliment the fact that our regulator RBI has been proactive in ensuring that there is stability in the financial system at one level and managing inflation and interest rates at the other level. I think the way that RBI has managed the system is indeed laudable. If you look at corporate sector itself, their balance sheets are also in great shape, probably the best shape that I have seen in the last decade or so. Leverage is low, cash flows are strong, growth is strong, profitability is strong. And similarly, as you go into SME and retail businesses, each of them is continues to grow strongly. So I am very positive about the growth of this economy. I do believe that we can sustainably grow at 6.5 to 7% into the foreseeable future, and perhaps with a little bit of help from the global economy, we could even grow at 8% plus as we go forward. We are also seeing new avenues of growth in the country. We are seeing a rejuvenation of manufacturing. The PLI scheme is certainly helping to some degree. And I think the biggest story over the last 3 to 4 years has been the services sector, and within that the GCCs and the way that they have been sort of contributing to our growth, and particularly on the export side. So I think put it all together, ultimately, the banking system is a microcosm of the underlying economy. If the economy does well, typically banks do well. And I think the fact that banks have done well over the last 3 to 4 years and expected to do so into the foreseeable future is really a testimony to the fact that the underlying economy continues to remain strong.
Thank you, Rajiv. And as you mentioned, I think the important part here is that the regulator has succeeded in achieving what they had set out to do. Secondly, it is disruption by regulation rather than by the banking sector in India. And RBI doesn't fail to remind us that if banks are slow to do certain things, then someone else will, and we'll be left behind. So I think the banks have their jobs clearly cut out. But from a global perspective, Sharad and Madhav, would you like to comment about the economy or how things are viewed at this stage?
Thanks, PD. And I think Rajiv really gave us a good oversight of what's happening in India. Probably we are, like most people say, we are definitely in a VUCA world. There are geopolitical shocks which are taking place. Nobody had seen the Russia-Ukraine situation linger on. We are seeing a West Asia crisis which is brewing. So these do have impacts on the trade chains and the value chains and the supply chains. And that's definitely a cause of worry. India is still dependent on the fossil fuel, and most fossil fuel comes in from that region. So there can be supply side shocks. So there are some areas where we need to be watchful for, and that's what I see from a situation. And I don't think these situations will change. We are living in a volatile environment, and I see that we need to be sort of more well prepared to handle that. So are we well prepared? I think yes. I think both the government and the regulator, RBI, have done all the right steps to keep us quite insulated from what's happening. Now it's a remarkable thing that RBI has managed to keep the inflation within the 2 to 6% range, and now it's slowly coming towards the 4% range. And once that happens, we also see that there could be a reduction in interest rates, which most corporates today want. So from a corporate banking perspective, I concur with what Rajiv has said. I think a situation which probably a decade back, people were calling it as a twin balance sheet problem, that has now completely converted into a twin balance sheet strength. The strength of the corporate balance sheet is very strong, and the balance sheet of even the banks are very strong. And this is a right sort of environment for taking us through the Amrit Kaal, and as what we call as Viksit Bharat. I think the foundations have been quite well laid out. Thanks.
Thanks, Madhav, for that. Our inaugural session, Mr. Panigra actually took us through details of sustainability. So I'll use the 3 segmentations that he made on sustainability, which are to do with climate change, sustainable economic development, and social inclusion. And my questions to my panelists will be therefore around these 3 parts of sustainability. We've seen globally a very credible transition plan being formed. These are via various frameworks and taxonomies. We've seen global sectoral guidelines, as we've seen happen in the UK, or what we've seen happening in Singapore by the Singapore Monetary Authority forming a task force. We've also seen other changes, like, for example, the Moody's net zero assessment, the methodology to evaluate such transition, and we all know what's happened at COP28 as well, where the way forward on fossil fuels has been agreed. But as the leading Indian bank, Axis Bank, Rajiv, has made a number of path-breaking innovations on climate, I must say. For example, I do remember the first 81 sustainable bond was issued by Axis Bank. There also, I don't know if there is anyone else who really has an ESG nominated board member on the board of the bank for that work stream. So please tell us more about what Indian banks are doing on sustainability, especially with regards to climate.
So I think first and foremost, sustainability has become fashionable in the Western world today. But from an Indian banking system, we have had priority sector lending for the last 50 years. Right, and so therefore, for some of you who don't know what is priority sector lending, banks are expected to lend 40% of their net book to sectors like agriculture, small and marginal farmers, small businesses, and so on and so forth. So therefore, inclusivity has always been built within the Indian context. And for all of us in this room, what is now fashionably called circular economy is something that we have always followed. We have never thrown away old clothes. They always went to your driver or maids or whatever it is. Bottles are never thrown away in India. They're used for, I mean, once you finish your Kisan jam, it is converted into a water bottle and so on and so forth. All that is now, the Western world is talking about it. And so therefore, I think we should certainly take credit, for the fact that sustainability, recycling of stuff is in a sense ingrained into the Indian mindset. So first and foremost, let's take credit for that. I think, from, just going back to the point on, we are the first bank, and we had actually created Axis Bank Foundation 20 years ago, before, sustainability became, fashionable, and, we've been working extensively. The first 10 years was around creating 1 million livelihoods, which we were able to achieve. Now we are creating 2 million families. We are trying to improve their livelihoods. Second is, we have a ESG committee at the board level, and incidentally, the chair of that board also sits on our credit committee. Because we also believe that, I mean, while climate risk, sustainability, etc., is important from a planet perspective, my primary responsibility as a banker is to be able to find borrowers who are bankable. So therefore, the first check that we have is the promoter or the project bankable, and then we put it through the ESG lens, because we have to always ensure that whatever money we lend, comes back to us. And so therefore, as we think about green financing as well, we will first wear our credit lens and then wear our sustainability lens. And so therefore, all projects over a certain, all term loans over a certain number goes through the IFC framework of sustainability. So where we do enhanced due diligence from an environmental perspective. And I'm quite delighted to also inform the audience here is that from a large corporate perspective, we have never rejected a proposal because the due diligence, the environmental due diligence has failed. So the point I'm making there is that I think it's fair to say that corporate India has well adopted their responsibilities from a sustainability perspective. So whether it is affluent treatment or water, etc., I think, corporate India is today, quite responsible, because I'm sure they're also facing pressure from their investors, their bankers, and so on and so forth. We also are committed, we have also externally committed to do 30,000 crores of incremental lending to green financing. We are committed to do that in a period of 5 years. We've already done that, and now we are working with the board to come up with a new number. We have committed to do 10,000 crores of affordable housing, particularly to women, and we're well on our way to be able to do that. We've committed to do up to 5% of our two-wheeler lending to EVs. That's working pretty well as well. We're also committed. On the one side, we're looking to increase our green financing, but on the other side, we're also looking to reduce our exposures to dirty sectors, thermal, asbestos, and such like. But ultimately, the balance that I'm always constantly looking to get is working with the board to be able to do what is right from a planet perspective, but ultimately doing what is right for the country as well. Because remember that India will continue to be thermal, at least up to 2045 or so. And given the increased levels of electricity that all of us need, to suddenly switch off, thermal is not going to happen. And so therefore, it needs to be a transition, and I think the word that you used is transition, PD. So therefore, it has to be transition, and we are working very closely for us to be able to achieve, these targets.
No, Rajiv, thank you for sharing with us very specific targets that you've put in place. This is really encouraging, and I think it shows the seriousness that the Indian banking sector has now adopted to taking this forward and making sure it's very rigorously followed, part of, like you mentioned, part of the credit assessment as well. Sharad, as we heard from Rajiv, there's no quick fix in the world to energy and climate goals. And how do you view sustainability in the background of all this?
The word sustainability, I'll rather talk about two terms, where we have the opportunity and where is the risk that is associated with this. Sustainability for the banks is a huge opportunity because it's close to about $1 trillion bond market at this point of time. The loan book is growing. More and more corporates are going towards the sustainable financing in terms of the liquidity available and also the kick we get in the pricing as well. So more and more corporates, in order to meet their net zero targets, are moving towards the sustainable financing, and banks are also finding it easy to finance these sustainable loans, to finance these ESG linked loan to meet their goals as well. The liquidity pool is growing, the word is growing, and workers are pushing towards that. We, as Emirates NBD, has also been part of that. While we are based out of the hydrocarbon jurisdiction, you can say, particularly in the Middle East, where the entire business is based out of the petrochemicals, but still we are trying to manage that part as well. We have also set up a future trading desk also for the net zero targets and for the carbon trading. We are also partnered with some fintech companies which are carbon trading platforms as well. In terms of the risk associated with it, yes, if every bank is deciding today that they will not like to do thermal, they will not like to do commodity, then where are those players going? So that's a very trade-off which we need to work with. While we cannot say technically no to any businesses because those businesses are required from our perspective, from the requirement as Rajiv also mentioned. Today, if we don't do thermal financing or coal financing, how are the producers going to produce? So ideally, yes, we have to continue with that for the period of transition. We have to look at the net zero targets, which the banks can decide on their own, or what is the carbon footprint reduction which we can work towards it. If today we are, say, 100, whether we are able to reduce it to 60 in next 10 years, that is something which we need to look. So, but the word is huge, and as mentioned in Mr. Shrikant's presentation also, in India itself, you need about $10 trillion of financing by 2070 when we are talking about net zero targets. And within next 10 years, we are talking about financing of about $170 billion. So it's a huge, huge opportunity for all the banks like us.
Thanks, Sharad, for sharing again very tangible and clear inputs showing a serious intent. Madhav, you know what the Indian banks are thinking about when it comes to changing regulations in this regard. Would you like to share something about sustainability and specifically to do with your role at the Indian Banks Association?
So a couple of things. I think one quote from Barack Obama, which hit me, and which has been often repeated in many of the ESG sessions, is that we are probably the first generation to feel the impact of climate change. And probably we'll be the last generation that can do something about it. And this is so profound. And I think that has been the genesis for our way of looking at the Indian banking side also. So what has been the regulator doing? I think our regulator has been very forward-looking. Reserve Bank of India has been very forward-looking. In fact, I was just going through their website. Way back in 2007, they had come out with informing about the climate risks which the banks need to be aware of. This was way before any other regulator even looked into this. Coming closer, in the last couple of years, I think Reserve Bank of India has come out with a couple of things. One, they did a survey of all the banks to see the current status of what banks are doing on climate change, climate financing, as well as sustainable financing. And immediately thereafter, they came out with a draft discussion paper which they circulated. Thereafter, the second aspect which they did was more recently in Feb 2024, they came out with draft guidelines again on the reporting which they would want the banks to start looking at to do. If I look at it, the first draft circular sort of mandated the Indian Banks Association to do one principal activity that was on capacity building and on building awareness and knowledge sharing. I think that's something which is currently happening through various forums, and we saw today also IMC doing that part of knowledge sharing. I think the first session was quite, it went in depth about what is India's strategy on sustainability, which we heard from the Director General himself. So from an IBA perspective, what the Banking Association is trying to do right now is trying to organize various kind of forums of knowledge sharing. IBA has also partnered with various global institutions like UNDP, FI, etc. For getting the best international practices to be known. Having said that, I think it's still a distant away. If I look at the other regulator, SEBI has actually mandated the BRSR reporting for the top 1,000 companies by market cap, and I think that has become a mandatory reporting from this year onwards. What I feel, I think there are certain things which I believe that could further happen, and when the SBI DMD asked a very pertinent question today morning, I think I would sort of build upon that. I think there's a greater need for collaboration between various agencies. A lot of good work is happening at SEBI, a lot of good work is happening at RBI, a lot of good work is happening at the ministerial level also. Probably the nodal agency should sort of connect all these people together so that we can have a comprehensive. This battle cannot be won by one party alone. So my way of looking at it is, I think the government first of all has to come out with a taxonomy, because that is the primary thing which will drive everyone else. So my suggestion to the government in the first 100 days was that build that, have a nodal agency, bring in all the various stakeholders together, and banks will be an active contributor, because our banking regulator was probably one of the first to have a sustainable finance group within the Department of Regulation. It's a wholly, the big team sitting there who is looking at this. Also, we at IBA managed to host International Banking Federation, which is a federation of, global federation for an umbrella organization for all banking federations. And in our discussions, this topic of climate change and climate financing did come. Probably, each country is in a different space, each region is in a different space, and they have to sort of look at their own interests first. And I think that's what India is also doing. But India is also playing a major role with the G20, etc., to see how we can be really a Vishwaguru in this subject. So with that, I think that there's a lot of things which can happen, and I think government would be looking at it in a consolidated manner. Thanks.
Thank you, Madhav. Very detailed and very informative. Taking on from what Madhav said about multiple agencies being involved, even when we look at sustainable development, Rajiv, there are multiple agencies that we see that are involved. There is government, there are NGOs, there are DFIs, microfinance, and of course there are banks. So how do you see any replicable frameworks coming in place, and in general, how do you think Indian banks and private sector banks in particular can play a part in this?
In terms of climate finance itself, or
No, this is in
creating the
terms of
frameworks?
social inclusion. Sorry, in terms of economic sustainable economic growth.
Yeah, I heard Dr. Panigrais talk about the fact that SBI was doing some very good work, and which I'm actually quite delighted that they do. But it is not as if private sector banks have shirked their responsibilities in terms of inclusive finance. Axis Bank itself, we have a separate segment which is focused on what we call Bharat banking, which is our semi-urban and rural banking. One of the things that we have learned is that it is very important for us to create different products and services which cater to that set of people. We are also already seeing that affluence is percolating into these parts, at this point in time, and so therefore their needs, their aspirations, continue to grow quite strongly. We have a customer base of about 2.2 million in our microfinance business. Almost all of them are women. It's a good business. It's a very profitable business, and we continue to grow within that space. And so, therefore, as we think about Bharat banking, there are multiple routes to be able to get there. One, I think there was a lot of conversation in the first panel around the fact that ultimately we need to use technology. We've already seen the JAM Trinity helping us. UPI has been sort of a huge success. And AEPS, Aadhaar enabled payment systems have also ensured that we are able to, or customers within this space are able to connect to the formal sector. Two is banks have continued to increase and expand their physical presence in these branches. So we are today about 5,200 odd branches. 50% of our branches are in semi-urban and rural. Three is we work with the startup fintech community to be able to get that last mile connect. It could be in terms of last mile connect, or it could be in terms of getting the ability to be able to underwrite these customers for loans, because we do believe that there is a massive opportunity of moving people from the informal to the formal sector. So I think all banks can see the opportunity. All banks are committed to inclusive growth, and if inclusive growth also means it is profitable, why would we not go after it?
Thanks, Rajiv. Like Madhav was talking about the IB Fed engagement. Some interesting things that we learned there, since you mentioned about branch expansion. There is an idea, there are certain countries where you actually have shared branches. So all banks get together, like you have shared ATMs, they have shared branches itself. In fact, in some of these countries, the government mandates the number of branches that need to be there, and it's not very large. The number of branches is not very large, but ensures that the last mile access is always available to...
We also have that, PD.
Right.
25% of, if you open 500 branches, 25% of them need to be in underbanked or unbanked areas, rural areas.
That's right. 1 in 4
That
needs to
rule's
be
been there for many years now.
Yeah. So, Sharad, moving to you to see what your views are on how India can attract more capital for sustainable development.
So I take it from the current election. So if you see, India as a country has a very fair and democratic process for conducting an election, and that has been proved in this election, and which means that the government is really and truly chosen by the people. This has given immense confidence and trust to the foreign investors to again come and keep on investing in India, to continue with the economic growth which has been a part for last a decade or so. Almost 20% of the global economical growth is coming from India, and that continues to be the sectors and promising sectors like electronics, semiconductors, power, energy, railways. they will continue to attract so much of investments from the world. While the government has laid down their policy and 100 days to chalk out the plan for the next 5 years and beyond, we will come to see that what exactly the finance minister and the various ministries comes out with their budgets. What will benefit from the global investment perspective is that India as an alternate to China +1 has been proved in last so many years, and which will continue. India is still treated more as a friendly destination for investments and for the production and for the global supply chain, which will continue to happen. India has an amazing bilateral relationship with almost every country in the world, barring few of our nations, but the neighbors, they continue to purchase Russian oil. They continue to maintain a great relationship with US. They are maintaining possibly relationship with every country in the Western Asia. So that's a very promising thing for Indians to do. We are capable of technology. We are capable of expertise, manpower, the efficiency in the production. So these all factors, and with the PLI scheme of the government, will continue to attract global capital. And I'm pretty sure next 5 years we will see massive investments.
Great. And just to add, we've seen interest of large Indian MNCs based in India to even list in the capital market. So if that happens, not only are they raising money locally, but they're also giving a chance to international investors who already follow them to bring in money into the country's capital markets and subscribe to these issuances. What happens with all of this is it helps them drive their entire ecosystem, and you have a whole lot of other suppliers and distributors that then start expanding their own facilities, which could themselves be then supplying to multiple other large MNCs as well. Madhav, would you have any last words on sustainable economic growth? Maybe something to do with SMEs or MSMEs and their inclusion?
PD, before that, I thought I'll share an anecdote. Someone in a conference, an ESG conference, just caught up with me and said, you know, you banks are so looking at sustainability, and you look at when you go to the ATM machine, it says that whether you want that slip, go green by not asking for that slip, and you keep 2 ACs on 24 hours. So frankly, I was also foxed. Probably there's a lot of inward looking which we need to do. When we are talking of sustainability, I think we as institutions also, I'm sure most institutions today have a sustainability champion within the organization, and that's something which we are also trying to see how best we can reduce the carbon footprint within. Many banks are, there are strict guidelines given of who could print, and what could be printed, etc. In fact, one of the banks was telling me that they are not allowed to print visiting cards anymore. So they have to carry their identity card with the QR code, and they have to just show the QR code. So small things, but they make a big change. Coming on I've been speaking to a variety of corporates. What I notice is in the large corporates and in the MNC segment, there's a greater realization for sustainability, and a lot of activities on that front have taken place. But moment you go to the mid corporate and the SME, the awareness level is a lot more lower, and I think they are waiting for some kind of a push to happen. So they are waiting for a regulatory push or some kind of incentive to be given. So the two things which I talked about earlier also, one is the taxonomy has to be defined, and some people only will do, change will happen only if there's a regulation which comes about. And the second thing is, apart from the PSL which was spoken by the DMD of State Bank of India, there are many other things which could be done. For example, if you are getting a green deposit, can we get some cut on the CRR? Can the government give some subvention or an incentive? So these are things which are ongoing discussions with between IBA along with the Reserve Bank as well as government, and knowledge awareness and knowledge sharing with the SME would help. Further, I think even SEBI is going through that direction. The whole thing of making the top 1,000 companies start the BRSR reporting itself is that their supply chain, which includes the SME, will get sort of involved in this. So I think the right framework has started off. I think in the next few years we can see a lot of development with support from government and the regulators. Thanks.
Madhav, wearing your IBA hat, please push for everything that you just mentioned.
And I think IMC can be the one driving the sharing of information to MSMEs, and that's where we can play a role as well. So coming just to the last round of quick questions, Rajiv, in terms of digital solutions, we heard a lot this morning in our first session, and how we can have digital solutions for inclusion. So I'd like to pick your brains on that a bit, because we still have 540 million folks who still do not have access to finance or digital banking at all.
So PD, my head of digital banking is here, Samir Shetty. He's on the next panel. So I'm sure that I don't want to steal his thunder. I'm sure he'll tell you everything that we are doing from a digital perspective. But I think that 540 million wala argument, I think, is a bit speculative, because remember that we also have 300 million people who are living subsistence. And I think it's more important for us to put food on their table rather than worry about whether they're doing digital payments. I think I'm not able to understand why people are not happy, proud, delighted that we are effectively doing 10 transactions per citizen per month. Let me put it again, 10 transactions per citizen per month on UPI. And I think that is a phenomenal achievement. We'll worry about the other 500 odd million people later. And this number, the ubiquity of this payment system, the simplicity of the payment system, and most important, it's free, boss. I mean, if you go to the US, you'll have to pay $5 per transaction. And all this is being done on the back of the payment rails that the banking system has created. So please, a round of applause for the banking system.
Sometimes very good to put things in the right context, and that's what Rajiv has done for us. So thanks, Rajiv, for doing that. And the last chance to talk about banking the unbanked, so opening it up to Sharad or Madhav, if you'd like to have a few words on that. Otherwise, we may be able to take some audience questions. We can take probably a couple of audience questions. Yeah. Yes. Yes, sir.
Yes. My question is concerned with the capital market and with the micro segment. I don't know whether this is indirectly concerned with the AMCs, asset management companies. My observation is this micro segment, which is out of MSME, or these hawkers. What do you think they could be? They are not in the tax bracket. They are in the UPI bracket. They do the UPI transactions, but they don't generate wealth when you have a product like SIP. I have not seen any measures of any MC. I'm the investor for mobilizing these people to come into the mutual fund bracket. I'll tell you, there's a research. India's capital market investment is less than 12% of the population. If it is 2% more, our GDP will anyway increase. Even with SIP, SWP, STP, this micro segment is not coming under the I think wealth generation. They are not aware. They are not for financial inclusion. I'm concerned with from financial inclusion. Now with UPI, there should be wealth generation so that overall economy will grow. I have not seen any measures. Can be covered in the private sector? Just my question. I have been interacting with the various bodies regarding this. This segment is very important. This non-tax segment and also wealthy segment, enough wealth to have SIP.
So, if you look at what the mutual fund industry has done through SIPs, now you can invest as little as 250 rupees. And so therefore, if you look at the number of SIPs that are being generated on a monthly basis, we are certainly seeing inclusion. Is it the hawker? Is it the thelawala? I'm not sure. But the fact that the mutual fund industry has enabled the ability of pretty much everybody with very, very small ticket sizes, and once again at a very, very low cost. In the cost of entry into the mutual fund is pretty much zero. So I think they've done a great job. I think their advertising campaign which is mutual fund sahi hai, has caught the imagination of the population at large, and I think it's just a question of time before you're going to get more and more people into the mutual fund industry.
Hi, my name is M.K. Chauhan. I'm on the board of Indian Merchants Chamber. Rajiv, particularly, I was quite delighted to hear that Axis Bank has at the board level ESG committee, and I'm sure quite a number of other companies also have that committee. We've been working for the last 24 years with the directors under the Asian Center for Corporate Governance and Sustainability. My sense is that at the board level also, and Madhav will bear with me, ESG people understand sustainability, but not in so much detail as to strategically or on tactics level what needs to be done. And therefore, sustainable finance and the other initiatives may not go forward unless it is also included in the incentive system of the top management. Any views you have on that?
So I can only speak about, from an Axis Bank perspective, we have a board committee which has been there for for now about 3 odd years, and they are well versed with what needs to be done, and wherever required they would use the capabilities of external partners, IFC Washington, and such like, and use that capability to be able to guide us in terms of what needs to be done. I think it's still early. I mean, if you look at some of the commitments that we are making, externally, there is a reputational risk if we don't meet it. And so therefore, the fact that there is reputational risk, in a sense, impacts all of us, particularly in senior management, in multiple ways. And so therefore, just putting it from an incentivization perspective or putting it into my KRA sheet is really not necessary. And I think all of us well understand there is a push from the board as well that we need to do what is right for the planet, and we have demonstrated over the years, and I speak from a broader banking perspective as well. I mean, if you look at banks of the size and scale of JP Morgan to all the banks here in India, our commitment to ESG has been very strong. But I just want to reiterate once again that we are lenders first, and therefore projects need to be bankable, and then we will take it through the lens of green financing.
Rajiv has aptly put it, but also what we have noticed is that in quite a few banks, under the KPIs for senior management, there is now some what you call percentage points given for the sustainability part. It was also interesting in one of the seminars I was hearing Hindustan Unilever CFO mention that his whole package, there is a huge emphasis on the sustainable finance part in that. So obviously corporate India and institutions in India are slowly bringing in, and I think it's a very right thing, sir, what you have pointed out. It has to come into the, what you call, if it has to become a DNA of the organization, if you have to drive a behavioral change, it has to come in through the KPIs and the way you incentivize people. I agree with that point.
So let me thank my panelists and a huge round of applause to them. Thanks very much. I enjoyed this session. I hope you did too.
May I now request Mr. P.D. Singh to present a memento to Mr. Rajiv Anand as a token of our appreciation and gratitude. To Mr. Madhav Nair as a token of our appreciation and gratitude. to Mr. Sharad Agarwal as a token of our appreciation and gratitude. May I request Mr. Ajit Mangrulkar, Director General, IMC, to present a memento to Mr. P.D. Singh as our moderator as the token of our appreciation and gratitude. So, ladies and gentlemen, we now will begin with our second panel discussion on digital public infrastructure, enabler for advancing financial inclusion, for which I would like to invite the moderator of the session, Mr. Naveen Surya, Chairman, FinTech Convergence Council, Chairman Emeritus, Payments Council of India, and Strategic Venture Partner, Beams Venture Fund, and the elite panelists. Joining him on the days are Mr. Vijay Mani, Banking and Capital Markets Leader, Deloitte South Asia Payments Consulting Leader, Deloitte Asia Pacific. May I request all the audience to move away from the dais. We are having the next session starting. Ladies and gentlemen, please do not crowd. Banking and Capital Markets Leader, Deloitte South Asia Payments Consulting Leader, Deloitte Asia Pacific. Mr. Rajesh Mirzankar, Managing Director and CEO, Kia.ai. Mr. Samir Shetty, President and Head, Digital Business and Transformation, Axis Bank. Mr. P. N. Shetty, CEO, Rupee Boss Financial Services Private Limited. And Mr. Anil Kuril, Chief General Manager, CTO and CDO, Union Bank of India. Kindly take your seats on the dais, ladies and gentlemen. Excuse me. The panel is about to begin. Over to you, Mr. Surya. Thank you. And sorry for the disruption.
Hi, are we ready? Is the audience ready for us to start, or we all should just take a lunch break and just have offline interaction? That might be good fun, right? You get to ask a lot more questions. So Narendra Bhai told me that since we are running delayed, I have to cut down time. So what we can do is that probably run a panel for like 45 minutes, keep Q&A time there, depending on what you want at that time. Either we extend that 15 minutes or not extend. That will depend on how much is your interest for lunch versus questions. So that's up to you. So the topic is, I think, very simple and common, right? It's about digital public infrastructure and obviously enabler for advancing financial inclusion. I don't think anybody has doubt about it. We all know about it. The only caveat that when we talk financial inclusion, usually traditionally it used to be talked as a bank account plus few things. But I just want to clarify that here we are talking about financial inclusion as the inclusion of all financial services. While we would have obviously appreciated if we had representation from investment and insurance side, but we do have bankers who will cover that piece because they do both the products. So that's one part. Secondly, usually you talk about individuals for financial inclusion, but the reality is in the business also the same pyramid exists, right? So you have again, small SMEs, MSMEs, individual entrepreneurs. There are challenges which are very different. So we'll try and cover some of those points as well. So that's just quick to caveat, and probably I'll right away get into the questions with the panel. As we spoke, we'll try and keep the answers between 2.5 minutes. And I will ask these questions to a couple of you as a primary, and then others can add on. So I will start with you, Samir, first. The first question, I think, it's very simple. I think all of you have been practitioner. You have been also user of DPI. You also have been championed with the cause of, as a banker, you and Anil sir both, especially, and of course other entities also doing it. But the task of financial inclusion. So do you want to narrate one or two examples where you've seen huge impact at the cross-section of DPI and financial inclusion? Would you want to talk about those couple of examples?
Sure. Firstly, thanks for having me here. So there are many examples of DPI. I can go on and on. Particularly the inclusion aspect from a savings accounts perspective is very well known, right? Like Jan Dhan and so on and so forth. But let me pick up another example, which is on lending to small businesses, because that is one of the most actually kind of excluded segments. So if I take pre-DPI, the way this would work is, we need to know the customer. So some person will go to the customer shop, get their details, do some PD. We need to get their bank statements, so they will get their bank statements. Then they'll come back. We need to kind of do some checks. All of this would take 7, 9, 10 days, optimistically. What we have now as an example is that we use DPI. So we, as an example, for know your customer, we'll use the Aadhaar, GST, I code, etc., Udyam Aadhaar. For underwriting the customers, we use the account aggregator data. So we can pull bank statements directly from the account aggregator. For validating their PAN, we can do it directly with NSDL. Validating their GST, we can do the GSTN. For understanding their income, we have GST data from GSTN. And then for signing the agreement, we have e-sign, e-nash, and so on and so forth. So we now have a journey wherein small businesses can get a loan from us in, hypothetically speaking, 10 minutes. Typically, it takes about half an hour because, they don't have everything ready and they'll go up front and back and so on and so forth. But if somebody were fully ready and went through the journey, money would be in their bank account in 10 minutes. And this is not a this is not a tick the box small pilot that we've launched. We are doing very reasonable business here. And this is one great example of how DPI can enable, excluded segments to come in. And if I were to spend 2 minutes on where it is helpful for us and for the customers, the biggest reasons why banks are not able to, or institutions are not able to reach excluded segments are because A, reaching them is expensive. Physical kind of reaching out is expensive. B, you don't have good data. You can't trust the data that's coming otherwise. And kind of C, collections is, difficult. And DPI solves for all three. And that's why we are very excited about it.
Share some hard-hitting numbers to show the impact.
So now, by the way, our small business, unsecured small business lending, 100% is of this nature. Right? 100% of our small business lending is, it's not 100, it's 90, but kind of the vast majority is of this nature. And about 15% of it is completely done by the customer themselves. Like there is no branch person or bank person involved at all. So that's kind of the...
You're still not sharing number of customers, the value of the loans. Maybe I'll come to Anil sir for that, but...
It's in multiple hundred crores.
That's good, yeah. So actually, see, we are looking at examples where there's a clear impact that has already been made. So I'll come to Mr. Sethi because he's also been championing the MSME, and then next we'll be coming to Anil sir on this. Again, examples of what you've been doing on MSME. Yeah. And for the impact, do give the hardcore number, what has been the real impact.
Yeah, I think we at Rupee Boss meet about 1,000 plus MSMEs in person throughout the country today. I think government has done a great job in terms of getting all these players on a tech platform. What is happening is, as Samir said, it was taking about months sometimes to give a loan. Today we have instance of giving sanction on the same day. That means one good thing is most of the credit mechanism is moving to cash flow based method. That means more and more banks and NBFCs are relying on banking, and if it is MSME with GST data. So between these two, banks and NBFCs are in a position to take the decisioning faster. And with all this KYC being automated, even those things are becoming easier. Yeah. I think now that we have done a great job there, I think what is the challenge which we see in the marketplace is that one is accessibility of finance. I think the affordability is becoming a challenge. And maybe whichever MSME we meet, the working capital limit that they have is not sufficient to manage their businesses.
So it's the quantum and the cost both?
That's right. Cost is yes. That's a big challenge there. I think if all of us can work on that aspect, where how can we come at the actual eligibility criteria for the same? Otherwise, maybe multiple funding will happen, and
so Mr. Sethi, you have been in this space. So do you want to talk about what kind of utilizing these technology? How many customers you have impacted?
Yeah.
And what are the examples you saw the benefit of DPI,
yeah,
which is actually driving inclusion in MSME?
That's right. So on an average, we are giving loans to about 1,000 MSMEs per month now, which is about 250 crore a month. So it is about more than 10,000 crore in that segment.
Yeah.
And the way we are going forward, because of this DPI, that we would like to go to customer's place in the morning and sanction his loan by evening and come out.
Perfect.
I think that's where we would like to reach
Very
with
good.
this technology.
Yeah. So my idea of this first question was that we are not no longer in a theoretical inclusion space. Things have already happened, it's assumed. And we'll now come to Anil sir. Again, another bank doing a lot of work for inclusion. So sir, I just wanted one or two examples where you're using DPI and there's been a huge impact in the financial inclusion with some numbers.
So, yeah, good afternoon everyone. I think Surya, when we are talking about the DPI, so differentiation between the urban, rural, inclusion, underbanked, I think in terms of accessibility of the technology no longer exists, because the same technology which is there at the urban side or metro side of it, same is available at the other side of it also. It is only the use cases which are making difference of that. Now, I do remember when in fact, I was a committee member which has designed the micro ATM, the financial inclusion piece of it,
APS.
along with the UIDI and the people from the other banks. The discussion point was that how to make the banking services accessible at that point of time. Now that was the aim.
Yeah.
Then we moved to the other product also. Then obviously things have moved. Now today we are here and we are talking about the digital public infrastructure, and there is a host of such services are available now. It's no longer only Aadhaar. It's no longer only the authentication services. Now if you look at the DPI, you can look at the host of services which are available from the public side of it, whether it's a GSTN, whether it's a land record. Even the fintech who are playing the role, some of this data they are combining together.
Sure, sir.
And providing those kind of. So I give one example.
Yeah.
We were the first bank to introduce the digital KCC loan, Kisan Credit Card loan. Along with the RBI IH, we did that and we rolled out in 3 states. The technology which was used by us, obviously one was authentication from the Aadhaar which was being used. Second was used wherever the customer was having a civil score, so we connected with that. Wherever customer was not having that, we used our own BRE to understand that customer. In case of execution of a contract, we use the digital services for contract from the NSDL. Now all those services combined together and then we launched this digital KISA. Today, a large number of our digital loan, KCC loan, are done through that in a completely automated fashion. Even we have gone beyond that also. Today, in Union Bank of India, almost every agri loan, MSME loan, retail loan, renewal, which is an annual exercise for the bank, and for that the customer has to come submit the document. All those are completely done digitally.
Very nice.
In fact, last year, although I am not at liberty to disclose the number, but still I can
some
say that.
Some range which kind of...
Yeah, so last year we renewed almost like a 20 lakh account without face-to-face interaction with the customer.
Nice. Yeah.
That is a kind of impact which DPI services are having. Obviously, today, most of our KCC loans, new, are happening through the digital.
KCC also has a huge number bump last few years.
Yeah.
Any numbers you want to kind of give a range estimate?
I think that I may not be able to.
Sure.
But I can assure
Let's
you that...
say thousands, millions.
In fact, today, that much I can say that today we do not do any manual KCC.
Very nice. All digitized.
And we being a public sector entity, and you can understand the kind of a loan number which we generate on the KCC, and everything goes through the digital. So that is the kind of impact which DPI is having. I think without this infrastructure, if government and the entities which are there in the space,
Of course.
if they would not have provided those, probably this was been a dream kind
Yeah,
of a thing.
yeah.
Because
Of-
earlier also, when we
Absolutely,
think
sir.
through that how to provide the services,
Yeah.
and the question was coming that how the customer will travel to the banking space.
Sure, sir.
So those are the, I think that is a kind of a space
Yeah, yeah.
where we
No,
are
I think
talking.
very,
Yeah.
very good
Thank
input.
you.
So, very quickly to Rajesh and then Mani, and we'll go to next question as well with Mani. So, Rajesh, do you want to add any quick thing, any examples from your partners, very quickly?
So we've been serving banks with solutions that enable the use of DPI. And I think some of the useful aspects have been around SME lending,
Okay.
as Samir pointed out and Mr. Kurul pointed out, that the ability to use and create alternative data for credit scoring without relying on the aspect of a credit score coming in from an agency is something that we are able to do very well with the use of DPI.
And have you seen some growth trend in last 3 years that, you know, in terms of percentage growth, I mean, without giving out any specific details, that the use of technology digitally, how much you have seen with your clients, aggregate?
So, if I were to talk in terms of the number of the time taken to reduce to manage account opening, with on the lending side, what used to happen in a matter of days, or let's say to the max of a whole working day to be taken to sanction a loan, is now happening in under an hour, so to say, for the underwriting aspect. Approval part of it takes the further next leg, because there is a manual leg involved in certain cases, but where it is not necessary, they are able to succeed successfully just move on with it. I think the biggest impact that we have seen this happening in is in banks that are lending to the rural sector, and importantly NBFCs as well.
Very good. Vijay, you want to add anything?
I think a lot has been said about lending.
As a consultant, you could share some number on usage on
Yes.
the DPI. That would be very helpful, right? See,
Yes.
we're talking about the impact. Everybody talks.
Yeah.
We all know generally it is happening. But how much, how big, that would be helpful.
I'll talk about two numbers.
Yeah.
One is I was personally associated with setting up India Post Payments Bank.
Yeah.
We are probably the only postal network in the world, 155,000 post offices,
Wow.
covering nearly all of the 600,000 odd habitations,
Big number.
cities, towns, villages that we have. We are the only network that is able to deliver banking services to every nook and cranny of the country, right? So that's one number. The other number is, this was recently published by the Reserve Bank and by the G20. 2008, 2009, our banking penetration is 20%. Today it's well over 80%. So in 15, 16 years,
This is
what
of
we have
adult
achieved-
population or entire population? Because this number keeps floating in media, nobody clarifies.
Take your pick.
I think
The
it's adult
important
population,
point is-
not the entire population, for
The
sure.
important point is that what we've achieved over the last 15 years, without DPI, it would have taken us 50 years to achieve.
Of course.
Right? Now, and I think technology grows exponentially, right? So what we can achieve over the next 10 years, without DPI, it probably will take a century, right? So we are on path to cover ground that would have taken a century in the next 10 years.
Very good. So the next question, I'm starting with you. So you've seen the impact already of what are the platforms already built, and some which are already getting used, like AI, which is again a recent development. Which are the areas, I mean, we talked about MSME, there are a few other areas, and which are the technology platforms that you think should again come in as a DPI? So couple of examples that you expect in next 5 years or so to make a dent or required, I mean, right?
Yeah, I think the way we look at DPI is that it's not one mega platform, but really a string of pearls, right? These are Lego blocks that can serve different parts of either the lending journey or the investment journey or even the basic banking journey, right? And the way these platforms are set up, the principles that have been laid out by many of the bodies, the G20, the Reserve Bank, is that each of these should be interoperable and should be developed using open standards so that they can be strung together, they can talk to each other. So if someone sets up a shared utility for doing last mile verification of a physical asset, that should digitally be able to connect to
So you're
all
giving a
other
use
DPIs.
case for physical verification
Physical
of assets as
verification,
one,
yeah.
and the kind of technologies that you're talking about?
Photographs, digital imaging, connecting it to,
So again, you expect it to be DPI so that there's no duplication.
That's right.
Very good
I mean,
example.
for every financial institution to do this themselves will
Sure.
not be cost effective. To really bring down the cost of lending.
Any other area beyond lending you want to give one more example?
I think it's primarily lending, to be honest with you,
fine.
across different customer segments.
Sure,
right?
sure. Rajesh, this one I'm deliberately coming to you because as a service provider, you guys always keep thinking ahead of what next.
So I think it's imperative that India has already made the transition from open banking to open finance. And actually, we didn't need to hang around in the open banking space for a long time. UPI sort of dealt with it, and without making a big hue and cry about it, India has already crossed the open banking and straight away into open finance. What is imperative is there is a need to then transition to an open economy. And that is then truly going to bring in the whole aspect of financial inclusion. And I think from a DPI perspective, one need that will be there is if we were to look at the sustainability goals, the 1.5 degree target that has to be achieved, there is a need for a DPI to come for a common data for projects that are green and to be certified. Today what happens is that a bank would go and lend for a green project, but then it's upon them, the owners, to make sure that they prove it was green. Now you have 17 objectives already certified. There is a plethora of people who can undertake audit for this, and I think there has to be an aspect where this, the so-called extent of green comes up, and then you are able to extend credit.
Interesting, very interesting.
The second part I think is the more deeper use of ONDC. It is a very versatile platform. I think it's very underutilized if we were to say from its true potential perspective.
Yeah.
What e-commerce growth we've seen, and when we say financial inclusion, one of the core reasons for financial inclusion and acceptance of UPI also has been the demand for e-commerce and e-tailing to be done at rural shores.
So affordable distribution which was missing,
Exactly.
it can bridge the gap.
So NDC can really extend
And financial
that.
services distribution is still very costly.
Absolutely. So I think the power of what a marketplace can provide will move the power to the citizens.
Very nice.
And that will then render, I think, true financial inclusion
Interesting.
where people in the rural shores are not relying on the person who's there or a mobile phone or an app, but can look at a marketplace approach for products.
Yeah. So Mr. Sethi, from a user perspective, what do you see in the future? Let's, as a user or as a business, which are the DPIs or which segment you think, if just as a quick add-on comment? Yeah.
I think we are talking about financial inclusion and sustainability, right? To me, the biggest problem is currently is that the cost of funding, and we are talking about sustainability, and the cost of funding is so huge. So with the DPI, we can, I think, bridge that gap now. How?
So are you saying we need a DPI infra where different banks, NBFC can put very clearly what kind of a rates they can offer you?
That's right, because SBI talked about 50 crore people banking with them, and we know others, I think about maybe 70, 80
Interesting
crore.
idea.
That means everybody has the data, and we have blockchain. I think if we can marry this, and that if all the banks, maybe through government intervention, if they can come out with the algorithm where they can understand the credit worthiness of Indians, MSMEs and otherwise, I think the cost of funding can come down. I think, I know it's a huge exercise, but I think it has to be done. Otherwise, earlier money lenders were there. Now there are MFIs. I think 8 crore unique loan happened about 2 months back in the country. 8 crore. At what percentage? Maybe 30-40%. So, and what is the assumption that, say, we are charging 40% because there is a high delinquency ratio.
Of course.
What we are doing is we are making so many people delinquent, and again they will again go out of the credit system. Again.
No, I got your point and
Yeah,
example. I think
that's right.
I'll just come to Samir now. Again, from a banker perspective, where do you see in the future? Which are the areas you would like DPI and which use cases?
So DPI can go everywhere.
With quick examples, yeah.
But there are two areas where I think it can unleash a lot of potential. The first one is land records and mortgage records, and the ability both to pull it as well as to establish lien, right? So that secure. See, basically a large part of lending is secured. Current DPI only addresses unsecured, and the security is typically some property. So the ability to identify the property, ensure that it belongs to the person who's asking for a loan, and then to establish a lien on it is one big DPI. If we have that, it'll completely dramatically change the landscape. The second one is actually, if you think of it, right, like India is in the forefront of digital and so on and so forth. The single biggest risk to India's digital story is the kind of frauds that are happening. Right? So if the Indian citizen loses confidence on digital, then then there is no, like, people won't come back. And hence the other DPI that we need is the ability to identify kind of whether a particular transaction is genuine or it's a fraud.
So you're talking about something that is started under Mr. Hota's guidance. Probably
Hopefully.
this input could go and they can look at
Hopefully,
this as well.
hopefully.
Yeah.
But if there is something that can pull data from banks, from telco companies, from all sources,
Common
and then-
Risk Bureau kind of a thing.
absolutely, and establish that the individual is a genuine individual and
Sure.
not a fraudster. I think that's the second. I think if these two come, I think our DPI story can just kind of.
Yeah. Anil sir, you want to add any examples that you would be looking forward in future?
I think being a technical person, when everybody else was talking about, and I think each one of us has talked about all those DPI which is available, but look at the mutual fund, the way they do a KYC, I think that's a unique example where you are able to establish the identity, although there is no single centralized system, it's an all federated system, but still you are able to do. So you are doing a KYC with one and then you are using everywhere else. I think that's a model, because looking at the risk which is there with the centralized system, because if that system goes down, probably you don't have anything to fall back on that. These kind of systems are need of the hour, that we diversify our risk.
Yeah.
There is a more inclusion from the player side of it, that will provide a more agility in the system. So say one example is land record, which talked about. Today almost 14 states have done that land record. Now rest are in the process of it, but there is no interoperability. Now we as an organization or we as a bank, when we rely on that, it becomes difficult, or you need to customize for each and every. So there is a need for that also, because you have to come out with the common standard. I think there is a lot of work is going on. Even some of the organization, they are standardizing those things, whether it's a common lending platform or interoperable lending platform and similar kind of things. So I think that's the need of our, since we are taking that path now, it is utmost important that we take care of that interoperability part also between the platforms.
Very
so
nice.
that will take care of.
So I have a trick question for you, since you put KYC and that used to be always very sensitive topic in my head. While we all agree that we're using DPI and experience and the time has been cut down drastically, but I always put it out privately and now again in public openly, but hasn't the cost of KYC and the number of steps and the duplication actually increased? And nobody talks about it actually with the hard data, because you're doing physical KYC still. You're doing Aadhaar KYC, you're doing CERSAI, and probably additional diligence of customers. So nothing has gone away. It reminds me of a time when you used to send a letter, fax, emails. So while we take huge proud, but have we really achieved that goal? Like you gave a very nice example of SEBI. There's a lot of time other side of regulators don't like to hear that there it's simplified with one ID in the one mutual fund and you can just replicate. We have not reached that in most of the other part. So do you want to answer that? I mean, it's a bit controversial, but up to you.
I think wherever we have reached today, it's a journey. And not every journey is perfect, which we have seen it. And we learn from each other. So obviously there is a lot of...
diplomatically answer there.
No, why I am saying, because I am also a board member of a CERSAI.
Yeah.
So from that point of view, but there is a lot of work which is going on. And I think in a coming 1 or 2 years.
So actually you have an opportunity to get this fixed.
Yes.
That can there be a central PDI agency taking responsibility for KYC rather than this becoming an issue for penalties, business stoppage. I mean, somewhere somebody has to take accountability.
So that's
rather than passing the parcel.
You just wait for another 1 or 2 years. I think those systems will set right.
Perfect.
Because there is a lot of learning which has gone into the systems now. And some of the mistake which has been committed till now, probably those will be taken care of.
Anyone else wants to add to this?
So I'll just add, Naveen, because this KYC problem is actually the second DPI that I spoke of. It solves the KYC. Why is today, like we have CKYC, CERSAI, right? And every bank has uploaded 100% of their data into CERSAI, right? So it exists centrally, but we are not using it. Why are we not using it?
Commercial model issue, right?
No, because people don't trust it, right? It's not CERSAI's problem.
He can take it.
Yeah, the problem is that, see, basically in the KYC, what happens in the, let's say Axis Bank, this is just an example, Axis Bank relies on some CKYC uploaded by Union Bank, right? And tomorrow that turns out to be not correct. The ownership, not current or not, it's a fraudster, let's say, right? Like now the problem is mine. It's not Union Bank's. And in banking, like, no disrespect to anybody, but like he won't trust me, I won't trust him. That's how it'll work, right?
It's a legal issue.
So if we have some kind of DPI which can provide some confidence, then I think this will fly, right?
I agree.
And which is where I went to this kind of getting this fraud DPI in place can really help all of this.
But we are again mincing the word. Fraud DPI won't solve for it. Actually, the word you use, somebody has to own that KYC which is curated, corrected, collated, and say, hi, I stand by it. If you use it, I will take responsibility. Until then, we'll keep having this one more to be done, one more diligence to be done. And somewhere, I think we'll all have to voice and create a solution and give it to the government.
I think when we are talking about trusting each other, because ultimately when you look at the system is always is in process.
Yeah.
So like if I take my own example, of late we have started completely believing on the what CKYC is doing it, because when we look at the from inside, because when you are outside obviously you have a certain view, when you are inside of the system obviously you understand that work. So as an organization also today, if I am able to find a CKYC number for a customer based on the attributes, say mobile number, Aadhaar number and other factors, I don't ask for any document now. I take that as a, provided that the address which is given there is of the same city where he is trying to open another account. To that extent we are ensuring. Otherwise, as an organization, obviously, because if you are not trusting those things, although there is, what he says is perfectly correct, because when there are a lot of players are there in an ecosystem, everybody may not follow a due diligence to the extent which we need.
Yeah.
So there is always a level difference there.
So I will correct, actually it's not a trust issue, it's about accountability issue.
Yes.
CERSA is a DPI, if they say, okay, I have given you this data, curated, corrected, as of today, you use it today, I stand by it. If something is wrong, then I am accountable, not you,
no,
or not even the bank who
I think in terms of a, although this is not the discussion for this forum.
Yeah, so we can skip it, but this was a point this idea was that figuring out some ideas to be generated for future. Yeah, Vijay, I want to make a quick comment. And then we'll switch gear to some other questions.
Just one point about DPI. I mean, generally DPI is construed as something that the government has to set up. I think it's equally relevant for private sector and entities to set up DPI, right? In India, even before you had account aggregators, which was a government initiative or a central bank initiative, you had an open banking variant which was completely private sector, set up by fintechs, right? So I think there's a lot of opportunity. We don't need more lenders. We need more innovators that can digitize different parts of the lending journey through shared utilities, right? It might be locally shared or regionally shared. It does not always have to be something that is set up from day one as a national shared utility.
Yeah. So let me switch gear to a different topic. Idea was to generate some futuristic problem statements that we can all work in and solve for the industry. See, financial inclusion as a term has been used and misused a lot of time. And probably today is a time for us to start thinking of something called financial health, right? That has been the new buzzword. More than buzzword, I think probably it's a holistic. Also, when you use word financial inclusion, you talk about that anybody who's excluded, which is, let's say, a problem which is now gradually getting solved. But what about the guys who are already included? It's to assume that they are included, so problem is solved and they are in control of their finances could also be a question mark. So in today's time, when you look at, again, futuristic view of financial inclusion versus financial health, kind of, what's your view? Should we change gears? Should we start having a new vision? And I'll again start with you, Vijay, because again, on a consulting side, thought process side, and then coming back to others.
A very important issue, and I think Mr. Rana from State Bank referred to it. You know, we do have the CFL programs, financial literacy programs, pushed by the central bank, and that's slowly expanding to the whole country. They're now adding credit counseling to that. So I think that's the point we were talking about earlier, which is that DPI goes beyond technology. There's a lot of literacy, there's a lot of counseling on adoption, about, you know, being aware of the right responsible credit behavior, being aware of potential fraudsters. It's a painful task, but it needs to be done.
Yeah, it's about simple things like telling people how to manage their loans, right? Today we are already seeing savings, rates are dropping, loans are increasing. So Samir, your views on this?
So I would say, so first on the inclusion, I think our journey is more or less done on the saving side, because everybody has a bank, like, 10 years back, the discussion would be that not everybody has a bank account. Now, there are more accounts than people in the country. On the credit side, we have a long way to go. And there, I think there is more and more to be done, and DPI will be helpful. On the health side, it's I would say, a very kind of big and a very long agenda. From our perspective, what we are trying to do is to use digital to do this. So as an example, if you were to log into our app, we will use account aggregator to pull all your bank details and we'll show you at one place. We also have something called a personal finance manager, which looks at, so our definition of health is in 4 parts, financial health. There is, spending, which is how much are you earning and how much are you spending. There is investments, where are you investing, how are you investing. There is credit, which is how is your bureau score and what you're doing about it. And there is insurance, which is, have you insured yourself for unforeseen events. So basis data that we have, and we are pulling from account aggregator and so on and so forth, we are able to show customers as an example that this month you spend 20% more on restaurants. And so now do you want to kind of check that? And similarly that, people like you, invest 30% more in SIPs. And so would you want
So
to
you've
track?
already moved towards a financial health journey already.
Yeah,
and
I would say
prefer
we
that
are,
everybody follows that now.
we are in MVP 1, but obviously this is it's a big journey and it's a need for the hour. And the second part of this health is, again, I go back to this fraud every time, right? Because in my mind, that's the single biggest risk. So how do we enable customers to, so as an example, today, nobody will sign a blank check and give it to somebody, right? But for some reasons, customers seem very comfortable sharing their passwords and debit card pins and OTPs with complete strangers. And that needs to change, right?
Huge issue.
Yeah.
And Rajesh, do you see the demand also from the ecosystem moving from a pure inclusion perspective to a health kind of a thought process, the kind of things they're thinking that how does the customer work in their financial journey?
No, most certainly. I think when we look at the pains that banks go through for enabling DPI and giving microsecond-based transactions, we should be aware of the pains that they go through, that there is a fraud reported on MHA portal that has to be taken into the core, reported within that many minutes back to the police station. You will have instances where somebody could get picked up from the bank to say, why have you not responded in 2 days? Right? This is a FIR that's pending.
Yeah.
Now, given all this, I think there is a need for some sort of an STP to go through. And when we look at financial health, one aspect is, of course, the financial literacy angle. But to build up financial health, there is a need for a database further on adding data to the beneficiaries of funds. So, for example, if there's social engineering and I'm enticed to sort of honor a collect request that has come, which is hopefully going to be 400% returns in 2 seconds, right? Then instead of just the verify ID of the person, I should also be able to see a part to say, this is the background of the person, as first time account holder, the account is 3 days old or something like that, which comes in from the same database.
A lot of preventive, a lot of diligence-based system, which is possible today's time.
We have all the data.
Very
and
nice.
I think when we look at DPI, the DPI should delve further than just account number, IFSC code, etc., to much more information about the beneficiary of fund I'm giving, because there's no concept of...
but you're seeing this kind of a demand coming from the ecosystem?
There is a need, especially the portal part. We had just gone in to see, because we provide UPI switches, you see, okay, we're processing 32 billion transactions and all that. And then you like to just generally go and see what are the pain points with the IT heads. And you figure out that this is the issue, that there's a MHA portal. It's happened with even when UPI was launched, I remember people used to just tweet. And that tweet used to be taken seriously to say, let's quickly resolve this matter. So is it now proper to go and read social media to look at operating your backend? No. People would say that's intrusion, we should look at policies, etc. So there is a need for some, I think, method to say what sort of systems go in to bring STP on the part to relieve banks of the responsibility of crime management.
Okay. Anil sir, do you also feel that the environment is right to move from inclusion as a theme to financial health as a bank? Any steps as a tech kind of visionary? Any thoughts?
I think when we are talking about the inclusion and numbers, numbers are hiding a lot of other things because those are not becoming clear. So when we look at the financial, there are a lot of things need to be done. Sitting here in Mumbai or Delhi, talking about and talking some number, I think that actually do not reveal the real picture as far as the unbanked areas are concerned or far-reaching places are concerned. So obviously we have to take it this the way we are going, at least for some more time. Second aspect, which I think is, we have to talk about the literacy part of it, financial literacy. That is the one area which we are seeing it, because even though I am a CTO, but I can become a victim of a cyber fraud. Now that is the one area. So even though I am taking care of all my financial things, but still those things are there. And one of the issue which we are finding it, when you become a victim of a cyber fraud, nobody is there to help you. I think there is a need for banks to come together, create a system. If you become a victim of a cyber fraud, you have one place to go, and that system should be able to guide you that what are the next steps which you need to do it. Because at that time, customer need empathy.
Yeah.
He needs information so that he can approach the law enforcement agencies. He can take the right step at the right time. Because today, if I am becoming a victim of a fraud, getting my own information becoming too difficult. Because bank thinks that, is there any gap in my system?
Yeah.
Am I supposed to look at him when he does a transaction, where he was? So all those issues are there, which is a something with bank. And when bank extend a help, they always look from back of their mind is always there, saying that what is the implication on me? I think there is a need for us to create
So
a
I'm
system.
clearly
now.
seeing consensus that the theme is becoming more an education and
Yes.
prevention.
Prevention,
Like it is
and
in a health also.
creating an enabling system. See,
Yeah.
that is the important part of it. When you are a victim of it, what things are done, you are able to take the information from your respective bank and take action immediately.
Yeah, yeah.
Because today, if you actually look at it, fund has gone from X bank to Y bank.
Yeah.
I approach the X bank. Before they take action, there is a lot of questioning, a lot of things will happen. Before bank X go to the Y and say that you block it, by the time fund is already moved. Because there is a lot of gap between these actions. So I think there is a need for to do that. Yeah, thank you.
Yeah. Mr. Sethi, you want to add any quick comments?
I think at least in MSME space, the way mutual funds sahi hai, same way now that in with the DPI, your GST, banking, credit bureau, personal credit bureau, as well as your company organization credit score now, and banking. But in all four now, it is easy to avail loan in the country, and that awareness has to go up.
Sure.
I think one, maybe Samir can answer that. I think account aggregators, is that entire Indian banking system is on the board, or what do you think? What is
Not
the,
yet.
where is the bottleneck there?
Most Indian banks are on, but foreign banks, etc.
And PSU banks?
Yeah, PSU banks are on.
Complete?
Yeah, yeah.
I think once
But
100%.
cooperative banks and some foreign banks are not on. But 85% of banking system is on.
Okay.
So I think we have time for probably one question. I think I was told 120 and then probably 5 minutes for questions. So I'm just taking that much time. And we're still ahead of our time, right? Well, I know you're looking at me, but now there are too many hands raised, so somebody has to help me by selecting. Maybe I'll start with Srikanth, benefit of knowing him, but I'll come behind also after this. Maybe 3 questions I'll take.
Thank you very much. Amazing panel, really liked all the conversation here. One of the topics which is all discussed, that when we get to the 5 trillion economy, SMEs are going to play a big role. What is the wish list for you guys have? Because credit is a big challenge.
Who do you wish to the answer from, please?
Maybe Samir?
Yeah, okay.
For SME, the biggest one is unlocking the property because almost everything is secured on the SME side. So unlocking this DPI on property and KYC. if we can figure out these two things, and then I think it will be a big.
See, about this aggregation of land records, what we have done, we are taking care of, I think, ownership. But are we taking care of marketability part? Because the real challenge lies in the marketability. When you go for selling this property, we find that passage is not there or property is at some different place, etc. That is one part. Second, about the cyber security, there is a growing menace of the fake websites. As banks have their R&D, I think the fraudsters have their own R&D also nowadays. And you will find a novel way has started where something will come in your group of 300 or 400 members, and they will say, you invest here, we have earned so much. So this is becoming a growing menace of the security part, particularly the fake websites. How we are tackling this particular situation?
I have a quick comment on the cyber security point.
I am Suresh Jain, ex-executive director of Union Bank. Thank you.
Sure. So just have a quick comment on the cyber security part. I think usually anything happening in financial services, the blame is on a financial services side. While you're saying that the problem is actually on the IT side. So first time we are seeing the approach even from regulator. Is they even calling people like let's say a Play Store or a Apple OS store. So same way I think website, ISP, telecom, all of them have to actually play a role. But I'll let the technocrat answer. Rajesh, you want to answer this technocrat? And then probably the first question you or Anil sir can answer. Sir, maybe.
So I think from a aspect of cyber security and measures to improve that, there are now databases coming up about fake websites. The government has put up a website for more information on frauds, which includes phone numbers, websites, etc. So that's a good approach to take. The other part is with regards to the new technologies that are coming up. I do see that generative AI will play a big role, where if we were to get a phone call and if I had an app that could be able to hear the contents of that phone call and immediately warn me that this is a fraud. And that's something that we are working with at least a pilot bank to say that if we embedded it in their app, how that works. The only pain point is that it would work on an Android phone much better than an Apple phone because of the openness.
So Anil sir, any closing comment on the first question? I think we didn't answer the first question. Sir, I'm not sure whether I have option available for one more question or not. Now there are too many people, Narendra ji will select who's the last question. But sir, please, very quick comment and then that last question.
I think I'm BL Chandak from Sidvi.
Just 1 minute, one quick comment and then. So just he's closing the previous question, then he can answer. Yeah.
So I think what we have seen today, sir, there is a very proactive steps from the CERTIN, from the Government of India, and there is a concentrated efforts on their part to proactively identify this kind of sites and bring it down. That is one part of it. The major issue lies that these sites are hosted in a foreign country where India do not have any control over that. So that's become a bigger issue
Fair
for
point.
us. That.
Yeah. The last question.
Yeah. This is, I am BL Chandak. I am retired DGM Sidvi. What I have to say is that we are missing one critical point about the credit inclusion. That is B2B credit. That is because even without that, even before digitization, banking, B2B credit has resulted in financial inclusion of...
Sure, sir. So who do you want this answer from?
1 minute. Business community like Marwadis. So, and the second thing is that the digital payment system or digitally including the banking, including the MSME requires repayment system should be proper. Otherwise, what has happened is that whatever you do, you cannot depend on the receivable should be the collateral, not the payment, the property. Property, how many times are?
Yeah.
So receivable should be made less collateral, and that I have given my example because without that, you go on. Even today,
we agree.
IFC, International Finance Corporation, estimated that 16% of the units have got the credit from the banking sector. So over the 70 years, if you have reached 16%, how can you? And if banks does not have the bandwidth, not the wherewithal to meet all the requirements of bank. It is the B2B credit, which is more than 50% of the requirement. So that part has to be improved, otherwise there
Sir,
will be
we
no
take this as a suggestion and a comment from you, and we acknowledge it and accept
Yes,
it. On behalf of the panelists, I thank you for this suggestion. I'm sorry, but we are actually running out of time. We have been warned twice, so maybe offline we can try and take few questions. Speakers are there for probably a few minutes. Thank you very much. Thank you, panelists. Thanks.
Thank you for that very interesting and knowledgeable session. May I now request Mr. Naveen Surya, moderator, to present a memento to Mr. Vijay Mani as a token of our appreciation and gratitude. To Mr. Rajesh Mirzankar as a token of our appreciation and gratitude. To Mr. Samir Shetty as a token of our appreciation and gratitude. Mr. P.N. Shetty as a token of our appreciation and gratitude. Mr. Anil Kuril as a token of our appreciation and gratitude. May I now request Dr. Narendra, Chairman, Banking and NBFC Committee, to present a memento to Mr. Naveen Surya as a token of our appreciation and gratitude. Thank you. A loud round of applause, ladies and gentlemen. One group photo, sir. Ladies and gentlemen, we now break for lunch. Kindly note, our gold sponsor, State Bank of India, silver sponsors, Kia.ai and Shriram Finance, logo sponsors, Mahindra Finance, Ugro Capital Limited, Credible ESG and Rupee Boss Financial Services Private Limited. Ladies and gentlemen, request all of you all to take your seats. We are about to begin the next panel. Fireside chat, ladies and gentlemen. You are requested to take your seats. Put off your mobile phone or put it on silent mode so that there are no disturbances. Gentlemen, so the next session is a fireside chat on leveraging AI and ML for financial inclusion, for which I would like to invite the moderator of the session, Mr. Rajesh Mirzankar, Managing Director and CEO, Kia.ai, and the elite panelists. Joining him on the days are Mr. Probir Roy, Co-founder Paymate, Director Alice Capital India, Independent Director Nazara Technologies, and Ms. Amrita Chaudhary, Co-founder and CEO Gaya. Kindly take your seats on the dais, sir. And over to you, Mr. Mirzankar. May I request all to take your seats and not crowd in front of the stage.
I was on the earlier panel making sure all of you got enough time for lunch, and it's now my job to make sure I wake you up after a sumptuous lunch with a very interesting session. The topic is about leveraging artificial intelligence and machine learning in financial inclusion. And I couldn't have asked for a better panel to discuss those points. So how we'll go about this is to try and make it very interactive, have examples, and then open up for audience questions as well. So before I get on with the fireside chat, I thought it will be useful to put it in perspective, the whole concept of artificial intelligence. And my personal thoughts on that are, when you say artificial intelligence, it's typically when somebody has not understood the whole context of it, because that's a nice word to use instead of a definition. When we say getting into the details of artificial intelligence, it has multiple types of artificial intelligence. And if we look at the concept of AI, it started off in 1956, and from then on it's been on. So the fact is that with the emergence of generative AI, it has been the smartphone moment of what happened with smartphones for mobile commerce is now what's happening with generative AI for the adoption of artificial intelligence, I would believe, for the industry. And so it's a turning point in terms of where the industry would head in adopting these technologies for the betterment. We have already seen some of the challenges that have come up with AI, with the bad actors in AI, and how we deal with it is again probably with more AI. So we'll have those aspects being covered in this fireside chat. But just to throw up a few concepts on AI, what we have within AI is the whole part of having computer vision, which is one part of AI, where you look at image processing and the processing of physical information. The next concept we look at AI is within looking at the aspect of natural language processing, which all of you now would be aware with the emergence of ChatGPT, being able to consume languages, being able to process languages. Then is the whole concept of applying this logic to robotics, where you look at working on with devices. And Amrita is here, who's working on building a connected world through Guy, and I think that is something that she will delve on. And we now see the emergence of expert systems in AI. And what are expert systems? When you look at robotic surgeries being conducted, and by processing an X-ray being able to get a diagnosis, this is based on limited data that is available, and based on what you have as input data, you can then come out with inferences of what you have as comparisons. And the last part is with regards to the concept of machine learning as we speak. So within machine learning, you come out with multiple areas of that. So one is supervised learning. I'm giving you this definition so you can apply this to each example. Supervised learning is the concept where you have a fixed data set and you compare that data set to get intelligence out. So a typical example here would be credit history of a consumer and getting that output. You then have unsupervised learning, which is to apply a larger data set which is infinite, which relies on public data, for example, and you'll see examples of that a lot in the concept of how search engines have been merged with generative AI to come out with output for languages. And the third element within that is the aspect of applying this to what you call as the reinforced learning. Reinforced learning is where you give it as a feedback loop to continuously feed information to get better and better outputs. So those are what is the concept of artificial intelligence demystified. So I'll get on with the session right away. Amrita, could you highlight some of the use cases within artificial intelligence and where you see applying those in financial inclusion?
Thank you, Rajesh. So obviously, when we are looking at financial inclusion, we are really talking about reaching the last mile of this country and making sure that they have access to the financial ecosystem. And when we are looking at that, I mean, there are so many use cases today, especially with integration with DPI and inclusion of AI to see, for example, credit rating, and ensuring that the credit rating is quicker, faster. There's a lot of algorithmic decision making that is happening today, bringing in data from not just the customer but from other sources, and marrying that data and trying to arrive at a quick decision making, right? So that's just one example. There's a lot more examples in the whole customer experience management, and especially with all the chatbots and the voice bots that we are seeing today, where a lot of the onus of having the first port of call is taken over by the machine and by the algorithm, and a lot less by the human being, with a transition to a human being where it is needed. So there are many different ways in which that access is happening. And from an IoT perspective, actually, if I may just add, I was hearing in the earlier session, somebody was talking about the ESG monitoring of ATMs and ATM booths. So today there are many of the banks have put in sensors and devices to actually monitor video monitoring of the ATM booths, as well as temperature and humidity and other things in real time, and using AI algorithms and machine learning to have detection of let's say an unlawful entry into the ATM and so on. So there are those use cases as well where things are happening.
Provir, you want to add on a few use cases to that?
Just a quick overview. See, we are all in the financial sector. So before we get into financial inclusion, which is bottom of the pyramid, few 100 million people, if someone says, if Rajesh says to me, AI in financial services, I would say, hey, it's already there. Then you're going to ask me, what is that? So all of you know about algorithmic trading, robo-advisories, customer life cycle management, credit worthiness analysis. These are all the traditional applications of AI as such. But now when you go south, when you try to reach a larger market, so let me give you an example. Recently, there was a lot of crisis, controversy over polls, right? Exit polls. But do you know the most accurate poll was done by Z through their artificial engine called Xenia. They polled 10 crore people and they said they got the poll result exactly as right after the results came out. Now we don't know exactly because they announced this only after the elections. I don't know whether before the elections they had the same view, but I thought to myself, this is bottom of pyramid. This is not the poll where somebody is coming with the clipboard outside the poll station, aap kiske liye vote kiya, usko record kar de. They went and apparently used AI to poll 10 crore people and they got their numbers exactly right. Now I don't want to say whether that's correct or not, but that's a good use case of AI for a bottom of the pyramid problem. Now let's come to financial inclusion. Now in parts of Latin America, AI has been used for creating accounts, for profiling and then creating and giving accounts to people bottom of the pyramid. So they have been able to increase the bank penetration by 2x in the last 10 years by using AI, especially Mexico and I think Chile or Peru. These are two countries went from 30% to 70% penetration by focusing on the dark markets, unbanked, undermet banking, those kind of products. So as yet in India, we probably have not seen our AI in FI, but yes, FI is large. So as Rajesh and Amrita mentioned that you have to go right down to the bottom, which is what? Computer vision, your Aadhaar identity, mapping that to analytics, and then, whatever transactions flow through that you have with people or bank. Use all these three things to figure out, how you can get to the end user and use that. But by and large, still far away, other than biometrics and analytics, which Rajesh does with his company for sourcing of loans and credits and to do profiling of customers. They don't have access to banking systems. So they use social media and other non-banking parameters to do the profiling of their potential customers. And then, based on that, do a sort of scoring of composite credit scoring of potential clients who can get a quick credit, quick loan, instant credit, low delinquency, using that to basically fine tune. For example, in our company, we have analytics which does that. So we reduced our delinquency to about less than 1%. Just by choosing about 280 parameters we have. And by credit scoring that, we give loans 45-day credit to people only who satisfy those norms based on the analytics results that we get from scraping of data from various sources. So these are some quick use items. But going forward, the 4 pillars of financial inclusion, Rajesh and Amrita and all of you, one is technology, one is inclusion of women, third is regulation, and the fourth is products. And the fourth is actually financial literacy. So financial literacy, I feel AI can play a big role in. Because for giving contextual learning and cultural appropriate feedback, for example, there's an AI implementation in Bombay for maternal mothers to reduce maternal deaths when the baby is born. So they have a database of 200,000 moms, 1,000 are chosen, and they are sent messages every 6 weeks in their process of their trimesters to reduce the mortality rate of mothers. So India, the mortality rate of mothers is about 115. It used to be 200 per 100,000, it's come to 115. The world average is 30. This is Bombay, MMR. So just imagine how AI, it's called the Restless Bandit Multi-Band Model. It's pioneered by Harvard University. They've applied it to this database in Bombay for mothers. But it's got 200,000 data sets. So it's not still an LLM, but it's big enough for them to draw inferences and reduce the maternal deaths and both prenatal and postnatal. So these are some use cases which are non-financial but financial inclusion. Now, similarly, like you're giving feedback to them through text every week, twice a week, they get a text. Same way we can use it for financial literacy and awareness, I feel, that, make it more contextual and give it in the local language, culturally appropriate. So that's one way to bring about financial literacy using probably some LLM. But right now, I don't think there's any LLM out there for FI at scale. When I say scale, it means 100 million people at least.
So I'll just add on there. I think one of the privilege that I had was to interact with METI, and a very interesting part, the DPI that we didn't speak about, was the Bhasha Dan, which was initiated by the Prime Minister's vision for enabling language models. And I appreciate the fact that it came almost 3-4 years ago. It's not something that came after generative AI. So what's happening now is that with Bhashini within METI, the Ministry of IT, there are local languages being tuned into large language models and generating this in multiple dialects. In fact, if you heard the Prime Minister's speech getting translated on an online basis, it is probably through Bhashini itself. And that is going to have a big impact in the way we look at financial literacy being taken out to the last mile, to be able to use AI along with large language models and enable financial literacy.
One more use case, since Rajesh, you mentioned it, is AI is being used for onboarding people onto mobile banking apps where people are not familiar. That is number one. And then making that experience of using your mobile banking app much more pleasurable rather than you going to the bank. So that's all done culturally in vernacular or language specific models. So, and you get a live assistant, a virtual assistant who comes on and takes you through the process. So engagement on the mobile banking app for your day-to-day needs is met by a person at the bottom of the pyramid who may not be beyond T9 literate or may not be literate at all. So this is another use case where AI is being used possibly in mobile banking, onboarding, and then increase the engagement and interaction with those apps to reduce the load on the traditional retail bankings.
So, one of the things that when we speak about artificial intelligence that comes to mind is, one is the Prime Minister saying AI for all, which was the aspect of taking AI population scale. And the other one is the moment we talk about AI, the first word that comes as a prefix to that is responsible AI. So Amrita, you want to add something to responsible and ethical use of AI and explain a few aspects of it?
Absolutely. So when we are looking at responsible and ethical AI, there are multiple facets of it. One is, first of all, what is the data that we are collecting, and is that data secure? So data security, privacy, all of that is paramount. And what sort of tools, technologies are we using to ensure that that data is sacrosanct? The other one is the fidelity of the data itself, and especially when you're using AI and generative AI to make, for example, recommendations or any kind of predictions and so on. The efficacy of that data becomes extremely important because you're generating data out of existing data, and there is that whole concept of hallucination of AI. So and basis that you could actually make wrong decisions or wrong recommendations. So it becomes extremely critical to ensure that there is the fidelity of that data is extremely important. I think the other thing that we talk about a lot is algorithmic bias of, for example, you have priority sector lending or lending to women and so on. So the way the algorithm is written will determine what kinds of preferential biases or non-preferential biases come into the play, right? So you want, at one level, you want that AI to be unbiased, right? And so that, but at the other side, you have these preferences. So there are all of these aspects, which are there, and I think a lot more, with the whole financial literacy and the inclusion at the last mile. So I'll give you an example. We're working with the Ministry of Textile on bringing about 40 lakh jute farmers onto a digital platform right now. And the whole idea is to have an end to, farm to factory transparency and accountability. And if you look at that, we're looking at multiple languages, we're looking at AI and blockchain to ensure that the transaction fidelity is maintained, through the system. The pricing is non-opaque and so on. So there's a lot that needs to be done, in all of these last mile sectors to ensure that, A, people are onboarded, B, they are handheld in that journey, because it's that last mile training, awareness creation, and ensuring that they're able to actually tap into some of these products which are becoming available is absolutely critical. So it's as much about training and operations at the last mile as it is about the actual tech management of it and ensuring that the data analytics is all done properly.
And I also think when you see now decisions that will soon be taken by AI, there will be regulatory changes that will apply, in my view, which will try and bring out the aspect to say that if you took a particular bias as a decision, like say for example in case of anti-fraud or anti-money laundering or allowing for frictionless credit to be given, when the auditors question the answer to say that my AI engine took the decision is not going to be valid. So I think there will be a change in the way application of AI will work, especially when you look at concepts of what is now termed as explainable AI, where you say what was the decision, on what basis did you take the decision, what was the underlying data, and what was the logic for taking the decision, which applies then to have an auditability of artificial intelligence. And I think when we look at truly adopting artificial intelligence in industries, for industrial automation, for decision making, etc., this is going to be an important element that will have to be considered. Now, when we look at the use of AI, and we've discussed some bits of it, and we can slowly sense challenges, right? So can we talk a bit on a few of the challenges in adoption of artificial intelligence?
So the challenges, first stem from the people themselves. We do need a cadre of people who are, trained in this, who can actually build the solutions, who are able to, understand the on-ground challenges and ensure, that the solutions are actually, addressing those challenges. The other thing is around explainability, as you were talking about, right? And the ability to not just understand the technical part of the solution, but to be able to then explain it in language that a regulator and or an end customer will understand is, another part of that, ecosystem challenge. I think there are fears. There's a lot of fear of AI taking away jobs and AI displacing humans and so on, which in my opinion, obviously it is AI augmenting the human rather than displacing the human. So those kinds of concerns being addressed are again a huge part of the constraint. I think the other thing is that many people are doing pilots today. So how do you take those pilots and how do you scale them? That is going to be the critical challenge over the next 2 to 3 years, right? And then ensuring that it actually has that impact at the last mile.
Yeah, if you really think about it, AI is quite controversial. You'll find there is good AI, and then there's bad AI. See, Elon Musk is saying AI is bad, it's dangerous. And the other school of thought, all the guys who are pushing AI engines, like Altman and all, they're saying nothing wrong with it, it's great. So we both are all conflicted on both sides. But going forward, I feel there'll be 3 key things that Rajesh mentioned. One is the rules engine. How is that coded? Second is the integrity of the data that you have. How big is your data sets? How large are they? How perfect are they? So that you get the right results more often than not. If I say, please show me a picture of a cat, 9 out of 10 or 10 on 10, it should show you a picture of a cat, not picture of a tiger or Cat Stevens, the singer. So, things like that. So you have to perfect it. And third is, I think Amrita alluded to it, is this, I would put it in the category of transparency, accountability, and ethics. Now, ethics, why? Because what's happening now is that you might have heard about that a lot of women's images are being used by AI engines to get engagement and influence of their customer base, eyeballs and influence. And that is bias, I think, towards getting ladies and their faces to drive customer attention. And secondly is the bias inbuilt into the engine. For example, a French author wrote a book. He's a radical French author. So he gave a query to Llama, one of the AI engines, saying, please write a book on France today. And it gave them, and then he said, these are the keywords I want to put in. So the engine came back and said, I will not be able to prepare this essay because it's discriminatory. So when he probed into it, he found the Llama is based on West Coast America standards and ethics and values. So it became, you could say, over woke. So it didn't, and he's a well-known author, so he could have written the same thing out by himself, but this engine refused to do it. So you're over-engineering that part a bit, just to be too careful. It could be the other way around also, as you know what happened with Google recently. It could go the other way around. So I think this is a challenge, still the verdict is out there, but there are two sides of it, and both sides will have to work on it actually. There's no one solution which will sort everything out.
I think there's a check and balance to be kept as well when you look at application of AI to say how effective has it been. You know, I remember in our firm we looked at saying we should have appraisals for the bots that we create. Have they been accurate? What's the impact that they've done? How many wrong decisions have happened? And then make sure they're tweaked, because sometimes AI can keep learning the wrong things and then soon become not so effective overall and add more challenges in the whole process of straight to processing. Now, could we discuss a few aspects on the constraints of how application of AI goes when it goes into financial inclusion? We did delve upon it in terms of the financial literacy aspect, but do you see any more areas that would be constraints in the use of AI for financial inclusion?
I think maybe in the area of cyber security and fraud, I think as you expand your base, for example, Maharashtra this year has doubled the cases of cyber fraud. And this is doubling every year. So it was 30,000, now 77,000. Next year, expecting more than 2 lakh cases to be filed. So as UPI and GPay and standard financial payment systems go to the bottom of the pyramid, QR code, the number of such cases will keep going up. So you'll have to, I think the RBI is cognizant of that. They formed a cyber security fraud committee headed by Mr. Hota, formerly of the RBI, just to look at this. So obviously it's got their attention. Maybe large language models can reach out to them, because everybody is transacting nowadays, from a regular phone to a smartphone, using the data to figure out, what sort of things are working, where is it, what are the things going wrong, etc. Could be one immediate use case, I feel, going forward.
And from a sorry.
Yeah, very closely linked to this idea of cybersecurity is the whole idea of identity management, which was also mentioned in the previous session, right? And especially if we are looking at these microtransactions too, macro in the B2B scale, the transaction value is much larger. And linked to the identity and identity theft, identity fraud can lead to a lot of issues at the last mile.
When we look at the aspect of the whole implications of DPDP Act, that's something that will be taken up, I think, in a much bigger way now. How do you see the impact of DPDP Act coming in and its application to large language models, learning methods, etc., when we look at financial inclusion?
See, one fear I have with all these DPTI and all these centralized systems is trying to over-regulate a space which is yet to mature. So I know EU has a AI regulation, very strong and stiff and well architected. US is also trying to have its own AI regulations. India, I'm sure, will try to have that. So as part of DPTI, they'll say, just like CBDC or crypto or cyber currencies, they will say we need to also have regulations in this area. But my fear is, Rajesh, is that before you got any scale or good use case, you have so many regulations that you throttle off innovation. The same thing has happened when we started SMS banking, wallets, all that. You had regulation coming in, throttling off innovation and slowing down the growth of the industry. So we should be careful not to over-regulate and try to take the best practices of AI regulation wherever in the world and put it into a A4 size document and send it out, and this is the guidelines. I feel that we are far from that, and that will stifle us in what we can do with AI, especially for financial inclusion. It's all innovative, how to use AI in financial inclusion. Like I gave you this M. Mitra case of these mothers in Bombay, maternal mothers. Out of the blue, who would have thought applying AI will reduce maternal mortality? But just idea of that has kicked off that AI use case. So similarly, might be many use cases in FI, but let's not throttle it off too early with DPTI and such things.
Wonderful. I think, yeah, you're right in that way. I can tell you that I have not seen a firm in Europe that has looked at implementing the right to be forgotten for clients very seriously within GDPR. Because just imagine, if I had taken a loan and then I said I have a right to be forgotten, now don't call me again. Does that work? It wouldn't. And so I think it's about saying how you apply regulations in that way. I think we've fairly covered most of the aspects that you can within the time that we have. And I think it's time for opening up to any questions from the audience.
Just on a more humorous note, in India, if you have right to be forgotten and take a loan, you can imagine why everybody love that, no?
I'm sure if you ask ChatGPT now to say if I'm attending a fireside channel, I want to look intelligent, let me give me a question.
I'm told that the outcome of any question that you put will be depending on the prompt engineers. So how are our agencies or institutes here to really create and tell it? Amrita did talk about the people as one of the challenges. So do we have any credible modules for developing a large talent on AI? One example being the prompt engineers.
So I think it will probably come with training, but it also depends on the context in which it is being used. So for example, if we are looking at using a keyword search, and it could be a keyword search of image bank and documents and so on, to arrive at pointing a user in the direction of a specific information. It may be something different. But when you're looking at crafting a larger article, like this book that Probi talked about, or the question that you were trying to raise, can AI write the question? I think there, the keywords that you can use actually, it can be a broad spectrum, right? And hence, depending on the narrowness, or whether it's a narrow context or a wide context, the prompt engineering and its efficacy can be quite different, and it's something that people would have to learn over a period of time. Any other?
Yeah, just to add to your question, actually, AI can write out a 5,000 word essay on punctuation, grammar, etc. in no time, but it can't solve Wordle. So that's what I'm saying. That's the machine learning. Maybe if it keeps doing Wordles, it will solve it, but it can't solve Wordle or can't create a Wordle puzzle by itself.
Prabir, I have a question. There are two pain areas for any social initiative. One is called monitoring evaluation, other is called impact assessment, which is real pain areas for any, whether it's a small or big. Impact is now come mandatory for the higher CSR spend. Do you think any of the AI tools, maybe in the near future, can at least address this problem? One is M&E, other is impact.
Yeah, the answer to that question is yes or no. It can, provided you have data. And then you keep feeding the data, and that data gives you predicted, and then you see the observed, and then you see the fit, and then you improve the model, where variance is 0.
Is it length of data or the quality of data?
I think it would be also quantity of data. It's like sample sizes, right? If you take, someone was telling me today in the US, sample sizes there are 1,000, which is too small. In UK, it works. In US, it doesn't work. So, Ipsos does the polling for UK, and somebody else does it in the US. There's a variance. So I feel you don't need to do the Nielsen's rating in the US, you need 40,000 panels. So that used to be a few thousands in the 80s. Now it's gone to 40,000. The fit is better. What programs people are watching, and they track it minute by minute, second by second, how it goes. So more data, Amrita, the better the fit, the better the prediction, and that's where LLM's kicking. So I think that you need to watch out for.
So actually one aspect of monitoring and evaluation from a sustainability perspective, because there's a lot of greenwashing, right? And at the last mile, you don't know whether a particular project was green or not green. So in the US, there's a whole concept of DRVs and using these sensors and digital platforms to monitor, not in all areas, but in specific elements related to, let's say, consumption of utilities or water resources and so on, where you can use data and monitoring and large volumes of data, and use exception analytics on it to figure out whether what was the fraction of it that was used, and compare it to different things. So there are areas where you can actually bring in automation.
So thank you, Provir and Amrita. I think that's what we have for half an hour now, and we'll get back sometime.
Tight program.
Thank you for the wonderful session on AI. It is here to stay. Take it or leave it. Simple as that. You'll have to audit and things have to come the right way. May I now request Mr. Rajesh Mirzantkar, moderator, to present a memento to Mr. Probir Roy as a token of our appreciation and gratitude. To Ms. Amrita Chaudhary as a token of her appreciation and gratitude. May I request all of you all to stand for a group photo? So, ladies and gentlemen, we are now about to begin the third panel discussion on digital lending, bridging the credit gap and creating a financial landscape, which is a NBFC CEO panel for which I would like to invite the moderator of the session, Ms. Pooja Bharwani, Executive Director, Deloitte Financial Advisory, Financial Services, FinTech sector, and the elite panelists. Joining her on the days are Mr. Shachindranath, Founder and Managing Director, Ugro Capital Limited, Ms. Shubha Srinarayanan, Director, CRISIL Ratings Limited, Mr. Sudipta Roy, MD and CEO, L&T Finance, Mr. K.V. Srinivasan, Executive Director and CEO, Profectus Capital Private Limited, Mr. Govind Shankaranarayanan, Co-founder and COO, Ecofi, and Mr. Raman Agarwal, Director, Finance Industry Development Council, FIDC. May I request all those who are standing around the stage to move aside. Please, all the audience, move.
Hi, good afternoon. Can we have everyone just seated and away from the aisle?
May I request all to be seated? Please be seated. The session is starting. Yes. Over to you, Ms. Bhatt.
Thank you. So we have a very elite panel today over here, and interestingly enough, NBFCs, who were always the cornerstone and the pillar of financial inclusion, have come in after lunch, right? After the banking conference, but they've always been at the forefront of financial inclusion. So let's take it from here. A lot of the stats have already been thrown out in the morning and some of the sessions, but just to get this session started, we'll go through some of the key stats and then, we'll throw it open to this esteemed panel for their thoughts. So we've all spoken about the fact that DPD has added a lot of value in terms of recognizing delinquencies, in terms of onboarding additional credit, onboarding and understanding consumer behavior. UPI transactions have seen a 15x monthly rise over the last 2 years. Jan Dhan accounts, of course, have gone up. So there is a lot of momentum in the system. But now that's happened more from a banking perspective in terms of getting people identified into the fold. But with that, I'll throw open my first question to Mr. Srinivasan. So you at Profectus deal a lot with MSMEs. And we've seen data, we've seen a lot of data, we've seen a lot of technology. And the question to you is, while all this activity is happening, have we really seen that increase in credit to the MSME segment? And what are their changing aspirations? Today, it's not only credit they are looking for. There are many other things that they struggle with to even get into this formal ambit. So how are we dealing with things like talent and shortage of infrastructure? So if you could throw some light on that, and we'll start from there.
Yeah, I think while obviously money is one of the biggest constraints that the MSMEs keep facing, there are so many other aspects that we really lose sight of in many of these cases. Number one is this whole issue of what do I do with the money? In the sense, how do I manage my business? How do I make sure that the financial discipline is maintained in such a manner that the business actually grows well and all of that? Number one. Secondly, the traditional attitude has been to say that, I am a little scared of the taxman, so if I am out of his radar, I am very good, so therefore I should do everything to make sure that the taxman doesn't catch me. I think those are things that are really changing a lot with the new generation progressively coming and taking over, who are more well-educated, who are much more ambitious, who have a little more forward-thinking capabilities than their fathers were. I guess that itself is triggering a certain amount of generational change in the attitude. I think so therefore people are no longer as scared or as afraid about the taxman, and especially with GST this has really taken a huge galloping step forward. So they are saying, okay, to hell with the tax, let me worry about the balance 70% that I hold, right? 30% to gaya. But so that is one thing which is a huge change. Secondly, progressively people are also understanding that while it's easy to start a particular business, how do I cross the threshold of going from a small scale to a large scale? Because that's what really feeds the ambitions of the MSMEs. So therefore, skill development, how to manage change, how to manage your team, how to raise capital from external sources which you have been avoiding for all these generations. These are becoming very important. So the moment you talk about, let's say, raising equity from outside, governance becomes such an important factor, because the first thing anybody who's going to put money into your equity is going to ask you, are you really compliant with the laws? What is your mental makeup? Are you a deal cutter or are you a person with a strategic vision? So these are all the things that are really changing. So skill development, corporate governance, management inputs, all of these are becoming very important, or probably as important as just the money which the banks and NBFCs would provide. So I think those are some of the changes that are happening, and hopefully it will continue.
And Mr. Srinivasan, and then over to Mr. Nath on the same topic. In terms of MSMEs, so while we're saying that all this is equally important for them, what are we as NBFCs doing out there from a product differentiation perspective, from a delivery differentiation perspective, to be able to address those very issues?
I think this is also the other thing that is really coming across. See, the point is, gone are the days when you had a certain templated product saying, I will give you term loan for 3 years, no matter whether you are in the plastic industry or you are in the hospital business or doing whatever, this is my offering, take it or leave it. So people are like, for instance, we have what is called a cluster-based approach, where we are really talking about what sort of an industry are you, what is your geography in which that you are operating, what is your ecosystem to which you are supplying, and then create a product offering which is meaningful for you and not for someone else. So I think from a lender perspective also, some of these understandings are very important. And one of the reasons why till now, although MSME has been part of the PSL requirements of banks for a very long time, full justice has not been done is because of the lack of understanding of the customer and what does it really want. I think that is changing quite a lot. So therefore, from the lender side also, there is a significant amount of input that is really happening in terms of, do I understand you a little better? What can I do to make your life a lot easier, and therefore create something which is more meaningful for you? And of course, data and the growing formalization of the economy has been obviously an input and a great aid in this whole thing.
Great, thank you. So you use at YouGrow a lot more data in terms of creating proprietary scores. I think you just launched your proprietary 3.0 score, which has additional metrics in it. So how are you looking at all this additional data, and how are you looking at underwriting it differently and getting to that last mile that we all talk about?
Yeah. So one of the things in last 5 years since we started, one of our view have been that India's MSME financing industry is poised to go near to what the consumer financing industry was, say, prior to year 2000. So if I give this example, if you think of this, in somebody in 1995 or 1998 wanted to buy a car or a fridge or a TV or a scooter, there was no credit available for that as well. You would invariably save money to buy a car or a scooter. But today, any consumer product you can buy off the shelf and the credit is available. One of the reasons why we realize is it is not that the lenders don't want to lend to MSME. It is the 3 core pillars of lending, which we call intent, eligibility, and ability to repay. It was too hard and difficult for mainline lenders to assess ability to repay, because the customer itself was very informal by nature. If you take any MSME, we target 15 lakh to 15 crore turnover MSME. 6, 7 years back, if you take that customer, almost 60-70% of their revenue was in form of cash. Now, to expect a mainline bank or a large NBFC to assess and give credit basis the cash income was extremely difficult. But this started changing for one stroke of a button, what we call demand. Behaviorally, small businesses changed after that. I keep saying that the fear of Modi ji taking out money out below the gaddi started coming and becoming real, which means behaviorally people started changing and saying some part of business has to be more formal. With the advent of GST, another part of the business of MSME became fairly formal, which is the turnover data. And then the democratization of the banking data happened, which is now accelerating with account aggregation. Last but not least, the behavioral repayment behavior, which is on the bureau, which is very prominent on the consumer side, has also started getting establishing. So we, starting from 2018, were of the view that this decade and next decade would transform the credit, because your ability to assess the repayment out of this tripod of data is really possible. You take somebody's turnover, you take his banking behavior, and you take his bureau repayment behavior, triangulate the three, and you can come to a very quick conclusion whether the customer is credit worthy, how much money you can pay to him, and in what time period he would be able to pay it back. And that's where we work very hard. I'm very happy to say that now we are still at 30-40% of that level of accuracy, but in next 5 to 6 years, you would see the MSME credit to be at the same level where consumer credit is, which is what we call on-tap financing. If somebody gets an order of 10 lakh rupees and to fulfill that order, he needs 6-7 lakh rupees of credit, he should be able to get it on tap, is our view. And it's a journey. There is lot happening in our ecosystem. As lender, we have to protect the balance sheet. That's why we also apply a lot of conventional lens, which is what we call the triangulation of yield, collateral, and tenor. And then, but you also innovate on the side. And that's why we have grown to a size. We have now financed more than 2 lakh customers in last 3 years, grown to size of 9,000 plus crore, and that journey continues. We are continuously targeting to be more short tenor, which KV said, is this whole philosophy of only giving term loan against a collateral doesn't serve the need for an MSME. If somebody is getting an order, you need to get the order financed. Somebody is making a sales, you need the invoice to be financed. Somebody needs a very short-term working capital. Somebody needs, and I'm talking about the customer segment, which consists of 90% of the credit gap. India's MSME credit gap is 90 lakh crore. Of that, 90% is in this customer segment, 15 lakh to 15 crore. And there, the product veracity and the need has to be serviced, and which require constant innovation.
No, thank you for that. I think, so when are you predicting it's going to be as big as the consumer credit?
I would think so in 10 years' time.
Wow, that's going to be very ambitious, and getting there will be amazing for the country.
Some bit of it that regulators would keep forcing consumer and personal loan to actually go down, and by nature of their denominator going down, we would grow up.
Okay. If I can come to, Sudipto, at L&T, there is a large focus on rural. Given the digital push, are you seeing, in the rural market, are you seeing that those numbers go up? What are you seeing the behavior on the rural MSME side?
So, thanks for giving us the opportunity to be here today. I think one of the most important, and you're right, we are very large rural-focused NBFC, where 50% of our book size is in rural areas. And but in the rural areas, we are one of the largest in microfinance, where majority of our borrowers are women, and mostly borrowers are women in small enterprise. So I would not, classify them as MSME. They are mostly, very small enterprises for subsistence living. But what we do is that when we capture the rural microfinance women borrowers data, we actually create a map of the entire household. What we do is that we also capture the data of what the husband does, what work the husband does, what line of business, whether he is a farmer or whether he has any other business. So we have been capturing that, and we have a very large database of customers. Now, what we have been doing for the last about 18 months is that we have started mining the the other side of the woman borrowers' households data. And we have come out with a set of customers whom we think, and we came up with a system, and these are mostly in our rural or semi-urban areas where we could sort of extend. Now the question for us was that what form could we extend? Because again, in rural MSMEs, there are two problems that you have to solve. First, the problem is access to markets. The second problem is access to credit, right? So, and because we didn't have much of experience in these areas, very large ticket loans also was something that we did not really want to undertake. So, we launched the first, it's a variant of a loan against property which goes into business, but we launched the micro loan against property product in most of this rural area. We started with Tamil Nadu, and we got very good response. We're scaling it up. Our unsecured business loans, which we are also initially doing in the major metro markets, we have now actually taken the footprint to many small towns, especially in the southern part of the country. The response is good, but from a digital angle, I think this business is not really digitized to that extent yet, because it's still a very high connector/originator driven business. Many of the SME really do not come online and apply. Though we have an online journey, the penetration of online applications end to end is not that great. It's still a very high touch, high environment process with physical files moving around, which is something that we would sort of like to work and change as we go forward. Two major impediments in this process. I think the SME underwriting process is still very ratio driven. When you moment you ask, an underwriter will ask you, okay, आपके पास P&L है कि नहीं, आपके पास balance sheet है कि नहीं, give me your bank statement. Banking pool has been digitized to a large extent thanks to the account aggregator sort of framework or through Perfure scraping, etc. We have been getting the banking data quite digitally, but the correspondent underwriting, the PD process, etc. is still very heavy lifting, and most of the underwriters are, I would say, still very ratio and sort of cash flow analysis driven. Sometimes they do not look at the nuances of the file, where if you are very mathematically driven in underwriting the file, you might miss some of the business nuances. Whether the guy is wanting the money for growth capital, whether the guy is wanting the money for maintenance capital. So many parts of this process are very, very fragmented. I think the industry is making a massive push. Two things will help. First is there is no direct GST API as of now, right? It's not a seamless API. There is no income tax APIs as of now which are not available, right? So I think infrastructurally, though a lot of things have happened on the payment side as well as on the India Stacks identity layer side, the GSTN layers digitization, it has happened. The data capture is very good. The data usage is still not that very good. It is disjointed. So when all these things fall in place, which we do hope will fall in place in the next couple of years, RBI's PPFC is trying to build the direct GST API which will be available. I think the digitization will grow, and again, as digitization grows, it will follow into the rural areas and pick up. But to long answer short, digitization is still not there in rural areas. We're still in a very, very physical world.
No, that's a very interesting point. So a lot of the digitization has happened on the lending side, right, you said. And lenders are more and more digitized, but this remains a high touch, and it's getting phygital, but it's going to take some time to get there.
Yeah, and I'll add to that, SME underwriting is not easy, right? Consumer underwriting is very rule driven, right. It is very income driven. SME underwriting requires nuances which the underwriter need to understand. I'll give you a small example. In my previous role, we were having very low approval rates in some of our SME files. So I sat down and started underwriting a particular file. I picked up a file which the underwriter had declined because the organization was loss making. But when we looked at it, the organization was a furnace making organization from Thane, and very high end furnaces they were making. The underwriter had completely ignored the fact that they had got orders in Muscat, they had got orders in UAE, and they were firm orders, right? So the organization was looking for growth capital. The underwriter was going very straight-jacketed, looking at ratios, and then nahi ho raha hai, decline, right? But finally we approved it, and that loan really performed well. So the fact is that some of these nuances in underwriting also is something which underwriters are very young. Underwriters of age group are not mature enough, right? They are sort of taught to be rule-based. This thing is also something that the industry has to learn, how to differentiate file to file and how to take away the uncertainty. And where some of the artificial intelligence learnings or some of the ease of reading balance sheets or ease of reading nuances which a human eye might miss through technology might help in fine-tuning the underwriting process.
That's an interesting point you touched upon, and maybe we'll come back to that later in terms of MSME underwriting or SME underwriting being very nuanced in that sense. And are we training our organizations and our underwriters to be able to capture those nuances along the way? With that, I'll come to Govind. You are doing a lot on the green side. EcoFi is a green friendly, not to say the others are not, because I already see them staring at me. But this is a pure green NBFC. And in the morning, one of the panelists had an interesting quote from Barack Obama, right, which said that we are the first generation to experience any climate risk, and we are the last generation to save it. So, coming to that, because it tied in with the green, how are you looking at green underwriting? Today when we are talking about getting to the last mile being challenging in many ways in terms of underwriting, data, you're going after a segment now which is a layer on top, which is even educating them on green and what is green. So how are you looking at underwriting this segment, and what is green, and is it an all-encompassing term from just the pure EV and all that we see around?
So thanks. I'll try to sort of address 2 or 3 of the questions that you asked, Pooja. EcoFi is indeed, as you said, a specialist in dedicated green financier. But the sense that green necessarily needs to be very niched is possibly not right. It still covers NBFC sectors that we all understand fairly well. So, clearly it is vehicle financing of different sorts. It could be affordable housing or building financing. There are some industries which are very clearly dark green. So, for instance, anything that has to do with wind or with rooftop solar and so on, all of which are expanding, and in particular after the Prime Minister sort of push towards rooftop solar, there is increasing interest over there. So these segments are clearly green, and some of them are, of course, SMEs. In addition to that, you have businesses where parts of the investment they need to make is green. So for instance, you have many industries which have water treatment requirements. Almost all industries have energy efficiency equipment sort of that needs to be sort of acquired by them. Several industries are looking at alternative forms of packaging. So when you add all of this, you have a fairly wide range of SMEs that you can target. The other definitional element about green is there is a sense that the impacts of climate change fall unevenly. A lot of it falls on certain geographies and on certain groups of people. So women in particular, and in particular in rural areas, are more adversely impacted by climate change. There are certain areas in India, for instance, there are like more than 200 million people who live along the coast, several of whom are expected to be like at the forefront of some of the negative impacts of climate change. So the creation of alternate avenues of income, which is again, a fancy way of saying SME lending or the creation of SMEs, is something that a green financing company would like to do. Now to your question about underwriting. Now, in the end, a lot of underwriting is very similar. But I think 2 particular, let's say, trends have come about which facilitate underwriting of some of these companies. The first is when you're underwriting for an end use which is clearly green, most of it would be assets. It would be less likely to be general purpose working capital. You usually have an asset that has or which transmits data. So there is a strong possibility for you to actually pick up real data that you can use. So I think there was a reference that KV made to the fact that underwriters look at conventional ratios, and he's absolutely right. Conventional ratios would usually not justify underwriting some of these companies. And therefore, data that you can pick up, which might be from IoT devices, it might be from fleets of vehicles, etc., is available. The second thing, of course, is the cost of IoT device itself has sort of dropped precipitously over the last 8 to 10 years. So it's not particularly expensive to do this. It isn't, why we felt specialized institutions are required is because doing this is not exactly straightforward. So while it sounds very easy that you can pick up data, the fact is there's some amount of tech in between that needs to be put in place. That kind of data is usually very useful for underwriting. It's also useful as an early warning signal, for instance. So, the very fact that a piece of equipment is not being utilized is usually a sign that there might be, business might have come to a halt and so on. So I think that is clearly one way in which green entities are likely to be slightly distinct in the way that they are underwritten.
Thank you for that. And in the morning, when we had Axis Bank and they were talking about sustainability agenda at banks, he said, look, we do have an ESG agenda, but eventually first is always the credit filter and then followed by the ESG agenda. Is that how you look at it as well when you're underwriting green? Like we said, rural is a bit nuanced, SME is nuanced. Are you looking at those nuances, or are you first having them pass a basic credit filter that is applicable to all and then, going to the green filter? Is there an added layer, or are we looking at it a little differently?
Okay, so I'll tell you how we do it. I think there are many different ways to do it. There are clearly brown filters, which we don't do. So, for instance, our investors don't permit us to lend to anything that is fossil fuels oriented. So, I think those are exclusions. Now, as I mentioned, it is important for us to identify very clearly what the green benefit of it is, which is why I said general purpose working capital in many cases will not always fit that bill, because you don't really know what it's being used for. There are different definitions you can use. So, even the Central Pollution Control Board, for instance, has a bunch of industries which it is classified as white or green or whatever they have services. So, that's large enough actually to build a reasonably good NBFC around if you want to do that. So that filter comes in first. It's not a very high hurdle to cross, and I think that the challenge is really training your team to, who are usually conventional salespeople, to understand what potentially the positive climate impact of something might be. After that, of course, we go through underwriting, some of which is always conventional, but some of it, as I said, is unique to a green business. These days, there are ESG filters that are thrown on it. There is a fair amount of tech which enables you to sort of make some kind of ESG assessment for a SME. This is not easy because, ESG is data-driven. SMEs don't always have a lot of data, especially about social and governance sort of elements. Many of them don't seem to care about it also. And finally, you need to do all of this in a way which is cost effective, right? You can't, you're doing a loan which is like a few lakhs, and you don't want to be spending tens of thousands of rupees in sort of this assessment. So, so that's sort of a brief answer to your question.
Thank you, Govind. And you brought up, yeah.
I just wanted to add, I think so for any of these, what is required is a mindset change. So to give you an example, 2 transitions we've done. If you go, especially for MSME financing, so we have around 350 plus credit underwriters, 200 plus would be chartered accountants. So we did this survey when we're starting what we call equipment or machinery financing business, that why, most of the credit officers are afraid of doing machinery finance. What we realized that all of them never understood the underlying collateral. This is a property to bik jati hai, machine kaise bikegi, right? So then we have to go and explain at length that every machine, which is whether it is CNC, printing, packaging, plastic molding machine, have a residual life and have a self-sustaining revenue element. So if you have templated the cash flow underwriting, and if you add the machine cash flow from that, you can come to eligible limit. When we started rooftop solar last year, 6 months back, we again did this survey to all our credit underwriters. What do you think about rooftop solar? Sir बोले सर ये तो कोई collateral की कोई value नहीं, हम किसी के घर और छत पे जाके क्या उसका rooftop उखाड़ के लाएंगे, ये कैसा loan है? Then we said, oh, this is not going to work, this is very hard, because we can put any kind of data, technology system. Finally, the human element of that would continue to reject that. So we came to the simple, we said we do 150 crore of business loan every month. We said, if think of this as you are doing a pure play, unsecured, non-collateralized business loan. You come to a method of eligibility saying this person can be given a 15 lakh rupees of loan. Now we have to do only one thing, please take his electricity bill, and that amount you add to his eligibility, and make sure that the EMI of the rooftop solar is equal to his electricity bill. What it would lead to is a very large extension of the tenor. So if I am paying 3 lakh rupees of electricity bill and the EMI has to be only 3 lakh rupees for my rooftop solar, it may so happen that the tenor for the rooftop solar loan may go all the way to 6-7 years. So we said, okay, that's fine. As long as you are convinced that his EMI is equal to his electricity bill and rooftop would pay for that, and because the rooftop life is 30 years, why you should worry? And people just really got convinced with that. And now we are seeing big uptick with that. So it is, as it has happened for a second-hand vehicle, as it has happened for gold loan, as it has happened within NBFC sector, for many other things which never used to happen, for every product innovation, you have to bring about a change, which is, sometimes looks riskier, but actually is not that risky.
Understand. It goes back to the same point of actually educating, on nuanced asset classes as well. Right. No, thank you. Subhashri, you look at everything from a rating lens perspective and have a very macro view of the sector. So while we see a lot of credit getting extended, what are you seeing as trends in terms of the asset quality? And, we all know that capital is a big guzzler in this business. How are these NBFCs looking on the liability side? And are we seeing some sort of a liability mix, changing in the last few years?
Sure, maybe I'll just answer this in two parts. I think first on the asset quality aspect, that you raised. Here, if I just maybe step back 3 or 4 years and go back to the pandemic times, obviously we did see across segments delinquencies really going up. Of course, they were limited by the fact that, there were 2 rounds of restructuring dispensations that were allowed, and we really looked at it in the form of then overall stressed assets, how you're seeing the industry. There were concerns around what we would see as slippages from the restructured assets, how the NPA numbers would move and so on. But I think since then, what we've seen is the delinquency numbers have been trending down, and we do believe at this point that fundamentals should hold. So I think broadly in terms of say 90 plus numbers, I think what we're expecting is that from a fiscal 25 perspective, they should be broadly range bound, in terms of what we are seeing, what we saw for fiscal 24. I think what also gives us, this perspective is I think maybe 3 or 4 data sets that we tend to look at. I think when we do our analysis to understand early on in terms of what we could see from an asset quality perspective, and maybe we sort of try to marry all of this data. I think one is really obviously the early delinquency indicators themselves in terms of what we see as early buckets. For instance, maybe just throwing a number out here. If we look at the stage 2 data for NBFCs, and this is across the industry, no specific asset class, really taking everything at one go. At the peak of the pandemic, what was the stage 2 number as on March 21 of about 9% odd? If I look at a similar number as on March 24, that's really come down to almost 3.5%. So a significant change there, right? The second aspect obviously is around, I think what we do tend to track very, very closely is, the various statics. I think different vintages, customer cohorts, ticket size cohorts. I think across all of that to really understand, are there any segments or are there any cohorts that are performing maybe a little bit more, weakly than others? And even that at this point, I think, we are fairly comfortable. The third aspect, of course, is I think we do try to marry this with what we see from an early delinquency indicator is really, I think disbursement trends in terms of all of the various cuts do give a very good sense of, I think, the changes, at an NBFC level in terms of, are there any strategic changes, are there any business level changes? Are you seeing something as simple as saying, okay, are you seeing ticket size cuts moving? Are you, for instance, seeing maybe interest rates moving? Very, very simple data points. I mean, nothing absolutely, the AI/ML that we were speaking about, but give you a very good insight into what the entity is doing. So I think that is all data that we're trying to track. On a qualitative basis, of course, we do understand from a lot of the rated NBFCs in terms of, I think some of the newer initiatives, some of the early warning indicators that they are also tending to track, right? So I think a couple of things that have come up and, are probably gathering pace. On the individual side, I think really tracking around the entire customer leverage aspect, right? I think 2 parts to this. I think one is post disbursement in that sense. And overall, I think NBFCs in that sense have pivoted so much. I mean, just bringing this up, saying that, from what was maybe 10, 15 years ago to a delinquency-based collections to now a pre-due date kind of a collection strategy entirely, and everything is really built around this, right? So I think things like, tracking the customer leverage, looking at bureau hits, many NBFCs in fact building maybe, even propensity to leverage kind of models to really do this even before disbursement at an underwriting stage, try to weed out these customers. The other aspect, maybe from the MSME side, because we did talk a lot about MSMEs, I think really you now have information, you have data sets that are probably exogenous to the MSME, but in a sense, do impact the repayment capability as well. I mean, just an example, for instance, you have an MSME borrower and probably their own counterparties. So really tracking the health maybe of the counterparty can be an early warning indicator in terms of how you expect the MSME to perform, because any stress there will flow through to what you may ultimately see from an MSME perspective. So a lot of steps that NBFCs are taking, and this is a very evolving kind of a situation and will continue to evolve. I think the second aspect, I think around the liability side, I think we're at a very sort of interesting point in the story. I think last 4-5 years, in fact, probably has been very interesting in this space. If I just step back, possibly pre-2018, it was a very benign funding environment for NBFCs, really supported their credit growth, and NBFCs also had a very good run. Obviously, post mid-2018, we did see some funding access challenges. Things had started to normalize, then of course, the pandemic hit, and it was kind of a little bit back to the drawing board for NBFCs. But through this, I think the point to note is I think banks from a funding side have been very supportive of NBFCs. If you look at the bank exposure to NBFCs and, maybe just, when I say NBFCs, of course, I mean NBFCs plus HFCs, and for our analysis, we do tend to exclude government-owned NBFCs. So that exposure has increased from about 6 lakh odd crores as on 2018 to almost 13 lakh crores as on, December 23 is the number that we saw. But at the same time, I think now what has happened is we did have the regulatory changes that came about in, November 23 in terms of risk weights on bank lending to NBFCs. And I think for the first time in a long time, we've really seen that bank exposure to NBFCs stagnate. So I think between December and March, we've seen that the exposure has been very flat. And therefore, it is very important in that sense for NBFCs to focus again, I think, really on diversifying their entire liability side to be able to meet their growth aspirations. And obviously the two broad areas here are, on the capital market side and securitization, and both, I think we're seeing, positive trends there. Just on the capital market side, for instance, on the CPs, what we did see in Q4 is we did see good level of issuances really at the level that we saw in pre-pandemic. Bond issuances also in fiscal 24, I think the trajectory is much higher than what you saw in previous years. But I think what is probably interesting here, these are more sort of high-level, industry-level numbers, but I think two very promising trends that we're really seeing here. I think one, when you look at your bond market issuances, we're seeing the share of mid-size NBFCs having really gone up. So in fiscal 23, maybe only about 6% of issuances were by the smaller, the mid-size NBFCs. And that has doubled in fiscal 24 to about 11 to 12%. So clearly, we are seeing a shift there. The second aspect is really around broad basing of issuers, even on the securitization side. So what was probably around 100 unique issuers in the securitization market in 2021 went up to about 130. And today, I think in fiscal 24, we're seeing numbers of close to about 165 odd unique issuers. So really, both markets you're seeing really getting very broad-based, which would support going ahead. And of course, we do have many MBFCs that are also, in a sense, adopting the funding light, the asset light model to sort of meet their growth aspirations. And that is obviously something that's also a market that's really growing in terms of the entire co-lending market from a volume perspective is also really expanded. But of course, I mean, given funding really is a critical element from a credit growth perspective, I think this is something that we're continuing to monitor, and the ability of NBFCs to diversify their entire funding profile is really what we are also continuing to monitor from a rating perspective.
Thank you, Subhashri. And the two aspects that you mentioned in terms of bond markets and securitization, and at least that's my belief, it unfortunately is still at the top level, at the top echelons of the NBFCs. They are not really, sort of funding sources for the mid and small, where the funding gap actually exists. But, thank you for that. Mr. Raman, from a regulatory standpoint, how enabling are you seeing the regulatory environment today? And more importantly, when we are getting into regulatory things like customer protection, the DPDP, how ready are these NBFCs to comply with all this?
Thank you for having me. Let me answer your question slightly different and pick up cues from the rest of the speakers. So KV talked about awareness, lack of awareness at the MSMEs. Satyendranath also talked about the need of flexibility. Same Mr. Sudipto touched upon. We had Mr. Govind talk about the green aspect of it. We talked about sustainability, and finally she talked about delinquencies. You put a mix of all these. I think some paradigm shift is required. And some time back I had written on this also. Why are we focused on lender-specific regulations? You have norms for banks, you have NBFCs, you have this thing. Why can't there be a borrower-specific regulation? So for example, in MSME, whether the lender is whosoever, because the heart and soul of the issue faced by a small person is the extreme fragility of his cash flows. And the moment you put stringent norms over it, I think that itself is counterproductive. So the whole, I think, because you look at technology, we had a previous session, people talking about AI and all that technology, the entire focus is on the user. So in a lending activity, the entire focus also has, if not entire, equal focus is also to be on the borrower. So if we have that in mind, so why I said this, that partially answers your question. Because when we talk of harmonization, then again it's harmonization of norms across lenders, right? Without, I would say, to an extent compromising to the fact how it will impact the ultimate small borrowers. I remember during the COVID time when we had this whole issue about moratorium, we at FIDC were very strict and we stood by this, that moratorium is not the answer. We said please allow one-time restructuring. Why? Because we wanted that element of flexibility to be brought. And I think that flexibility for a small-time borrower is not only required in events like pandemic, it is required perennially. Unless you give that flexibility, I think it will remain a debate, right? So that's first point. Secondly, if you talk of NBFCs, we've seen some fantastic ideas on the kind of innovations. On the lighter side, even Sudipto talked about wives tracking husbands. That's the most authentic way to track, the movements. So we've seen this kind of innovations happen in the sector, which have been a straight fallout of the market. Way back started from NBFC started used vehicle financing, gold loans, and then the new age fintechs. All that is something which NBFCs mastered this, and MSMEs also. Now, if you see RBI data, NBFC lending to MSMEs has grown 3 times more than that of banks. Third aspect, in this entire business of lending, no matter how much technology you bring in, that level of personal connect and personal comfort, which the borrower feels when he has a personal connect with the lender, is of prime importance. There again, NBFCs have shown and proven to be, real game changers. So if you club all these, I think, and include that in your framework when you talk of regulation, I think we'll see many issues sorted out automatically. There I will also include the aspect of liability. Fine, there was a concern relating to bank lending to NBFCs, it is certainly growing. Now, is the answer to any problem restriction? Overdependence. Overdependence is the key. Is the answer to overdependence restriction or diversification? If you are, and rightfully so, asking that, okay, this seems to be a area of concern, let's restrict this by increasing the risk weight. What is the alternative offered? Nothing. And I think you very rightly talked about the small, mid-sized. You look at the data, partial credit guarantee scheme, TLTRO scheme, all those during ILFS times and COVID times, fine, the entire fund allocation was distributed. But how many NBFCs benefited? You pick up, I have the press release with me, government data talked about hardly 70 or 80 out of 9,000. So that trickle down effect never happened, and it has never happened even till date. So the need here is to have, we've been saying maybe an agency like SIDBI or somebody to take up that role of the refinancing. And I was yesterday also sitting with SIDBI. SIDBI is ready to do it. They said, why can't the government, and we say, why can't government have an allocation of funds to SIDBI and do some kind of funding, especially for the mid and small sized. Because see, capital market, fine, it is desirable. But can you expect a very small time NBFC to get into capital markets? The access is not there. And neither is the expertise there. So all these paradigms, this thinking needs to be brought in. And I think we at FIDC have been trying that at best to put these things across. We shall continue to do so, hopefully, as we go ahead and seek to be the SRO of the sector.
Thank you. Thank you. Mr. Srinivasan, just taking the last cue from there in terms of the schemes. So there have been a lot of schemes that have been initiated by the government. Which ones are really moving the needle, you think? And what more needs to be done to get the sector aware of what's there and the entire potential of the schemes that we currently have available?
See, I think the most successful scheme that I can think of was the ECLGS, for sure. And I think two reasons for its success. One, of course, it was necessary at that time, and it was obviously a very unique one. I have not seen any such model anywhere else in the world. But most importantly, it was monitored and pushed so hard by the finance minister herself, taking week by week review of which bank, which NBFC has not adhered to its quota commitments. And that really made sure that most of the money that was allocated was actually given to the borrowers in the right manner. And that actually helped avoiding probably 80% of the mortality which would have otherwise happened in the MSME sector during that time. So while that itself was a unique case, what I really take away from that is that creating awareness, making sure that the delivery mechanism is geared up to do the needful. The third one is monitoring. If these three things are done, obviously any scheme that the government brings across would be a roaring success. Let's take the example of the capital subsidy scheme. Okay, now, which was there, which was a reasonably successful one. But there also the level of awareness among NBFCs was fairly limited. There are situations where schemes whereby, let's say, somebody in the Northeast virtually gets 90% of the capex being reimbursed by the government in the form of subsidy. But how many people are actually taking it and putting capital intensive industries in the Northeast? It's not that you don't have manpower or you don't have resources or anything like that. There are enough and more opportunities, right? Fruit processing, for instance, 90% of the Northeast fruits get smuggled into Burma and Bangladesh simply because there are no processing facilities. But is there an entrepreneur being enthused to go to Northeast and put up a pineapple processing plant, in spite of the fact that 90% subsidy is available? So there is a certain amount of, pushing, creating awareness and making sure that the delivery mechanisms are enthused enough to do this is so critical. Otherwise, frankly, I am amazed at the number of schemes that the government has created over a period of time. But what is the level of utilization? It's quite abysmal at an overall level. So I think those three things are very critical for it to become a success.
No, thank you for that. So how do we push it? And I'm throwing it open to everybody. How do we push this awareness of the schemes and how do we push this additional utilization? Well, what needs to be done?
If I can take the first shot in it, I think, frankly, the faculties of the banks or the NBFCs have been fairly limited to only giving money. Right? At an association level, as let's say IBA or as FIDC or for that matter, even some of the groups that you can actually create, take this as a mission and then drive it. I will give you one simple example. In my previous organization, I had actually done nearly 300 seminars, okay, over a 3-year period, only for MSMEs, which talked about the need for clean accounting, need to pay taxes on time. How do you make sure that there is a difference between your personal wallet and the company's cash till? These are some of the fundamental things that we used to go and talk to 30, 40, 50 MSMEs who used to come for those conferences. And I personally would have addressed about 3,000 of them. And that sort of an awareness creation is so critical. And of course, it brought business to my organization for sure. right? Because people were obviously looking for money as well. But most importantly, it was a socio-commercial kind of a venture which proved to be a fantastic success. So something like that can be actually picked up by anyone and do it. And more if it's done from a neutral perspective, it's so critical. Because if I do it as a company, then there is a certain amount of color of marketing there. But the moment you raise it to an association level, it just removes all those doubts.
You wanted to add to that?
No, on a lighter note, what Raman was saying, one of the challenges, in fact, we were jointly presenting some very senior people in the government, and I started the presentation saying कि कुंती के दो बेटे थे, एक कर्ण और एक अर्जुन, दोनों के गुरु भी एक थे द्रोणाचार्य, बट वो बेचारे कर्ण को इतना सताया गया कि वो कौरवों से मिल गया. तो हमारे बैंकिंग इंडस्ट्री में अर्जुन बैंक है और कर्ण एनबीएफसी है, तो कर्ण को इतना मत सताइए कि कौरवों के साथ काम करना पड़ेगा, बिकॉज हमारे स्किल सेट मोर और लेस सेम ही है. तो आई थिंक सो दैट इज़ व्हाट इज़ द मोस्ट रिक्वायरमेंट, बिकॉज जनरली it is believed that when it comes to the NBFC, we have poor credit quality, we have poor governance, we have poor capital structure. But contrary to popular belief, actually it is completely different. The credit quality of NBFC, she would confirm this, is superior to the banks, our delinquencies are better. Generally it is said that our collection infrastructure and mechanism of collection is bad. But that is not true. We are as regulated as NPFs and as banks are. What is required is predominantly two things. We believe that we do a better job in serving the underserved market, and that's why we are required to given a level playing field. And second, there is an institutional framework of providing us the liability should be created in India, because we hold better, bigger capital. Our capital adequacy ratios are higher than what banks are. We deliver and perform better, but we are, second child to almost everywhere.
And I think we need not go far behind. We have a precedent before us to answer your question that what needs to be done about what KV talked about. Look at the success story of auto financing in India. How and why it started. NBFCs का जन्म ही गोल्ड लोन के बाद CV फाइनेंसिंग के लिए हुआ था, right? Why? And why is it a success story even today? Because this segment NBFCs इतना घुस गए that the person coming to me is not a borrower. I cater to his vehicle maintenance, his insurance, any breakdowns, कौन सा मॉडल खरीदो, कहाँ खरीदो, किससे खरीदो, कहाँ बेचो, किसको बेचो, everything, the entire ecosystem. And why was it possible? I will relate it to my earlier remarks. There was that extra element of flexibility allowed by the regulations. And I'm sure if that is there, NBFCs are not only competent, but far more better equipped to do this exercise. Yes, we will be needed assistance of other stakeholders that I'm not showing. We don't work in silos, but we need, and we've done it in the past. So I think it should be left, something you need to leave to the market forces. Leave that. Give thoda sa chodo. Let's not be a very tight leash. And I'm sure things will take care.
Thank you. Two last questions, one for Govind and then one wrap it up with Sudipto. So Govind, from a green perspective, of course, there is a lot of technology, there's a lot of DPI in terms of getting the right data for underwriting for MSMEs. And from a green perspective, would you like to see more on the DPI front, or are you seeing a challenge in getting the data that you need to assess it from a green perspective? And given the sustainability focus, do you think that's the next step that one should take from a DPI perspective as well?
Yeah, I think there was an illusion that KV made earlier about the fact that you need to be able to underwrite in a different way. And he gave that example of one case which he underwrote himself or something. Now the point is that we have so far successfully obtained, banking data from Perfios or anybody or the account aggregator. GST data is still available, even, maybe not as smoothly as banking data. But a lot of the MSMEs in particular clearly don't have all of this, or even if they had all of this, that still is a very conventional way of lending. And other data which relates to utilization of their equipment, and so on, is something that we should be able to access. I'm not sure whether that is all accessible through a DPI kind of infrastructure at the moment. If the government were to make some of it available, I mean, to just take an example, for instance, for vehicles, clearly there are central repositories. It's possible to sort of know exactly what vehicles doing at any point of time. So, is it possible if a vehicle is taken on a loan, for instance, for that, for certain kinds of data to be available? So it's possible to create some of those. I think Shachindra mentioned about electricity bills, that data is also clearly available and all that. Right now, individual companies, like all of us, I think, get that data in some form or another. I think centralizing of that, or finding a way to centralize that, can be extremely useful. So the second point which relates to regulation is, I clearly feel data protection is a sort of 21st or 22nd century regulation for what is a 19th century industry in some ways. So we have to be cautious that it is not too heavy-handedly placed on all of us, because ultimately we are lending, we need data for that, and importantly we are lending public funds. It's not all sort of private funds that are getting lent. So the government needs to think of the way in which both consumer as well as SME data can be shared, especially if you are a lender. I'm not saying generally, if you're not a lender. And that's a thing where I suspect as this DPDP Act and so on starts sort of seeping through the system, we will start seeing this as an issue, where customers, will start sort of saying, look, my data is not to be offered to you, and so on. So I think these are a couple of areas that I would sort of draw attention to.
Okay, thank you. And last question to you, Sudipto. You do a lot on the consumer credit side as well, and there is a lot of talk of, new to credit customers and a big gap that exists there in terms of funding them. But the real question is, how many of them, given all this data that we are getting now through DPI, how many of them are actually passing the credit filter? Or are we really using this data to understand the existing borrower better, or are we actually putting in the NTC into formalization? So what is happening?
Yeah, so one of the things which is there is that many of the lenders just focus on people with bureaucrats and will shy away from people who does not have bureaucrats or probably new to credit or have thin files. Now, it's very important for lenders, especially, and there are many people, especially in semi-urban and rural areas, who want to start a business, want access to credit, but because they do not have they have either thin liabilities track or thin bureau tracks, they are just outside the formal ambit of organized lending, or end up in taking lending at very high rates. So I think one of the ways that we are trying to do is pushing some of the learnings from consumer lending is that obviously one axis is bureau, the other axis obviously is through account aggregator. Most NBFCs have access to liabilities data, and we're getting very good pulls on liabilities data. The third thing that we have sort of been focusing on building is what I call the trust signal based data, because of the proliferation of UPI, and we have put that into three buckets. We call it, payments trust signal, we call it GeoIQ, and we call it microgeography. These are three things that we have put. What we are trying to do is that we triangulate scores. There are payment companies or UPI sort of fintechs who have actually seen a large amount of data flow through. They have built very good usable scores that work very well, even for customers with thin bureau or thin liabilities track. Historical loss rates in a particular geography is now available, and some of the fintechs have digitized it. You send a geolocation, you get a historical loss rate. And for things that are agri-dependent or industries that are agri-dependent, microgeography or GeoIQ actually is now available and digitized from companies like SatSure or AgriWatch, where you get MSP data for over 10 years, you get crop failure data over 10 years. We have actually ended up sort of building a new engine, which probably will go into production soon, which triangulates all this data bureau liabilities as well as what I call trust signals, and does a holistic underwriting of the customer. So even if the customer is a very thin file customer, we end up underwriting him to a fair degree of confidence. Now obviously, the degree of confidence will be far, far better if I get a thick bureau track or a thick liabilities track. But pricing can to a certain extent take care of the long tail risks. So that is the way we are progressing. It's a science that is slowly building in the country. I would say it is still in its infancy. But thanks to the various DPIs which are available right now, which are funneling a lot of data and formalization of data is happening, I think in about 3 to 4 years' time, this will become a very exact science.
Thank you very much. And we are out of time. And do we have time for questions from the audience? Okay, sorry, we do not have time for questions, but I'm sure they'll be around for a couple of minutes if you want to ask anything. And thank you very much.
Thank you for that wonderful session. May I now request Ms. Pooja Barwani, moderator, to present a memento to Mr. Shachindra Nath as a token of her appreciation and gratitude, to Ms. Shubha Sri Narayanan as a token of her appreciation and gratitude, to Mr. Sudipta Roy as a token of her appreciation and gratitude, to Mr. K.V. Srinivasan as a token of our appreciation and gratitude, to Mr. Govind Shankaranarayanan as a token of our appreciation and gratitude, to Mr. Raman Agarwal as a token of our appreciation and gratitude. May I request Mr. Mahesh Thakkar, Co-Chair, Banking, NBFC and Finance Committee, to present a memento to the moderator, Ms. Pooja Barwani, as a token of our appreciation and gratitude. A group picture, sir. So, fourth panel discussion on how financial institutions can play a pivotal role in achievement of sustainable development goal, for which I would like to invite the moderator of the session, Ms. Swati Agrawal, CEO and President, Advisory, Care Analytics and Advisory Private Limited, and the elite panelists joining her on the dais are Mr. Jitesh Shetty, Co-founder, CEO, Credible ESG, Ms. Smita Hari, President, India, Octus ESG, Ms. Ranjini Lisa Verghese, CEO, Right Canvas, Ms. Hina Hushlani, Partner, Climate Change and Sustainability Services, EY India, and Mr. Manish Kumar, Head of ESG and CSR, ICICI Bank Limited. Kindly take your seats on the dais, ladies and thank you, and over to you, Ms. Agrawal. May I request all the participants to please take their seats. Thank you. Over to you, ma'am.
Thank you. Hi, everyone. A very good afternoon. Can you please settle with our cups of coffee or tea? Welcome to all my esteemed panelists. It's great. Guys, we have a wonderful topic and we have a real wonderful and a very learned panel over here and panelists over here. We actually have a very interesting topic as to how FIs can actually play a pivotal role in the achievement of SDGs. And just to set the background, we all know that these SDGs are some 17 global goals. They were adopted by the UN member countries and with a universal call to end poverty and protect the planet. These SDGs 1 to 17, they cover various areas like hunger, poverty, clean energy, sanitation, health, sustainable cities and so on and so forth. And in a way, all these 17 goals are integrated. I mean, that is, if we work in one area, we obviously create impact in the other areas. And therefore, the development amongst all these goals should actually balance social, economic, and environmental sustainability. The member countries which have all signed up, our target goal is 2030, and so that the planet enjoys peace and prosperity. And there is a global indicator framework which has a collection of 232 distinct indicators which measures the performance on some 169 objectives which form the 17 goals. In India again, this is monitored by Niti Aayog, and there is an annual report that comes out by the UN and which is called the Sustainable Development Goal Report. And this actually tells you how each country is progressing on various goals. The recent report that came out in March, which is actually based on 23 data, brings the country's performance to a level of 112 out of 166 countries. Not so great, but nevertheless it's improvement over last year with an overall index score of about 63.45%. While obviously we've done much better on certain indicators like poverty, hunger, clean energy of course, there's still a lot of work that needs to be done on some of the other indicators. Now if you look at it from a role of a financial institutions, typically financial institutions play a very significant role. And this is what we're going to hear from the panelists more. Essentially, if we were to just name a few areas, we've heard panels on financial inclusion talk about it, and therefore financial institutions, taking the government agenda in the form of Jan Dhan Yojana, Mudra loans, and other government schemes. I mean, that has led to a lot of improvement, or you could say furtherment of these SDG goals, and it touches also across a multiple level of goals. The second area could be MSMEs, and again in the MSMEs, which obviously we've heard in the panel just beforehand. We heard about how they touch, generate a lot of employment, and they touch a whole lot of the masses out there, and essentially it leads to, amongst a lot of other SDG goals, it really helps in the SDGs 8. Which helps businesses prosper. Green financing is another area again, and we all know how the country's progress on green financing, and that's SDG 7 and SDG 13, which is about green energy and clean energy. Digital innovations, again, that has led to a huge amount of the unbanked coming into the mainstream, and also led to ease of doing business or ease of doing transactions or the money flow, as well as reducing the cost, which again impacts a lot of multiple SDG goals. Social impact investments again from the FI's perspective. So with this context, let us move to our panels. We obviously have a banker here, we have quite a few consultants, and we also have a new age technology guy, fintech with us. So let's hear from them. My first question would be, Manish, to you. Financial institutions, as we all know, I mean, end of the day, if we have to really go into the movement or work on the agenda of achievement, I mean, financial institutions have to raise money, right? And the money has to be more in the nature of sustainable finance. So we've had recently RBI coming out with the green deposit framework, which was last year, and also SEBI coming out with frameworks on green bonds and all. We've had certain issuers, and recently we've seen some municipal corporations issuing green bonds and all. So as a banker, what would your comments be onto the ease and the avenues which are there towards specifically raising of sustainable finance?
Okay, thank you and good afternoon to all, and I would like to thank IMC for inviting me here to be a panelist. With regard to avenues for raising sources for green financing, I think whatever we had in terms of conventional, traditional sources, they can still be looked at from a green perspective. So whether we are talking about deposits, as you mentioned, RBI already has come up with a framework for acceptance of green deposits. We are familiar with green bonds getting raised in the market, sustainability linked bonds getting raised in the market, sustainability linked loans, getting raised in the market by financial institutions, NBFCs. The only difference is that there is a specific end use requirement for these kind of liabilities, which actually differentiates between a green borrowing and a conventional borrowing. So as long as it meets any of those specified end uses, which, from an India perspective, the government of India had specified some of these end uses as part of the sovereign green bond framework, which they had launched in November of 2021, November of 2022. And some of the areas, are renewable energy, some of the requirements are around healthcare, sanitation, if you look at the social aspects. And then when we talk about sustainability linked loans or bonds, it is about how a company can really progress towards achieving sustainability in its operations. So the short answer is that all the conventional sources which have a specified end use of green are termed as green bonds. In addition to that, now we are looking at, some of the instruments like securitization, which are now coming to the market specifically in this area, wherein, say, a pool of receivables which have sustainability or green as an end use can be securitized as a source for raising liabilities. People are talking about blended finance, and I have two very learned panelists here who will talk more about it probably, where we are talking about how different components in the banking and financial institutions market can come together and really support this entire journey of sustainability in the country.
Right. So I'll take the same question to you, Hina. You've been working with a lot of banks and financial institutions. Do you see banks and financial institutions, facing challenges in specifically raising any of these green deposits or green liabilities? Okay, so while Manish clarified that any kind of funding or any kind of liability can actually go towards that, but at the same time, there's something called greenium, right? And
Yes.
do you really see greenium coming into the market? Do you really see there is the advantage of a liability being termed specifically as green, and therefore, what is your advice to the borrower?
No, thank you. Thanks for having me. And frankly, I'm going to give a little bit of a view of frankly the reality that we've seen in the market. And the truth is that in the last 1 year, we've seen, I would say, significant momentum being generated. And when I say momentum, frankly, it's more at the awareness level. Up until a year ago, when we talk about green finance or green bonds, sustainability linked loans, most banks did not know about it. In the last 1 year, there's definitely more awareness. Have they moved? No. I'm really not sure. I mean, I don't think the number of SLLs that an Indian bank, I'm not talking about a global bank that's based in India that's giving these loans. An Indian bank, have they done any sustainability linked transactions? I can count on my fingers, it's less than 3 also, frankly. But the truth is, we are happy with the fact that there is awareness. People are talking about it. The reason it's not moving forward, and frankly, to be the reality is the banks are coming with the right intentions. There's awareness, they want to do it. I think the current dilemma or the situation that everybody is in, they're trying to figure out how to do it while keeping the economics in place. Because there is no greenium. I think we all read in the papers just 2-3 days ago, RBI's recent sovereign green bond, they had to cancel it because they're not getting the greenium. So I believe, sustainable finance has its own curve, like ups and downs, and we are somewhere in between where the momentum went up and there's more awareness, but unless and until the economics make sense, we will not see a lot of deployment. So currently, because see, a lot of companies also come to us saying, listen, if we're investing so much in decarbonization, we want funds that incentivize us. And banks are like, as much as I would love to, it doesn't work in my economics. So somebody has to give me patient capital or subsidized capital so I can pass it on. And that's where, frankly, a lot of blended finance or some of the solutions will have to come into play. People always look for the government funds or government incentives for that. So we're hopeful in the next 2-3 years this momentum has to happen because India needs transition finance. There is a significant funding gap and we're losing time on that. So we do believe that in the next 2-3 years we'll see a lot of push with the RBI's climate risk that Manish talked about. Banks have specifically, a lot of banks in the last 1 year have started taking or thinking more towards taking net zero targets. And once they take net zero targets, they have to do transition finance. They will have to deploy sustainability linked finance. And, the markets will take a turn. Yeah. So I would give it another year or two when, we'll see a lot of action.
But do you see examples of this in the international markets? I mean, do you see the investors over there are more conscious and they would give a greenium as compared to the
European Union is extremely conscious. EU is way ahead of any others. Like in India also, there are a few SLL transactions that have happened, but they've been driven by banks like DBS, Standard Chartered, Why? Because these banks at the global level have taken net zero targets. So and specifically for high emission sectors, like if they're giving loans in pharmaceuticals, chemicals, steel, manufacturing, or some of them don't want to do oil and gas, but many are doing, and they shouldn't stop funding. That's the right way to do it, and that's where we see a lot more transactions because they've taken net zero targets for 2050, which means they have to start transitioning these sectors to more sustainability. And European Union people are willing to pay premiums. I think those investors, even in India, a lot of funds, comes from FIIs. All the funds that are coming from EU do come with the caveats that there has to be ESG reporting, monitoring, and that is because there are regulations there called SFDR, Sustainable Finance Directives, CSRD, which every investor has to report on these things. So, EU is really way ahead.
Swati, I'll add to that. You specifically talked about whether this is happening globally. She talked about Europe. I was the chief risk officer of ICICI Bank UK PLC based in London. We used to participate in syndicated sustainability linked loans, and I'm talking about 2020, 2020, 21. What actually started in that market, and by that time actually the regulations were not there. What actually started was data availability. There were companies which were willing to monitor, they were willing to really put out their neck on providing data on how they will transition. I think that was one of the biggest triggers. Second was the ecosystem around sustainability ratings. So we already had agencies who had developed capability to provide monitoring mechanisms and provide ratings specifically on ESG parameters, which would enable this entire lending to happen. And number three was the regulatory. I wouldn't say it was a compulsion, but there was a discussion in the air about reporting, making disclosures as part of the annual financial statements, which the large corporates who were serious about sustainability were willing to do that. So I think it's the ecosystem which enabled that to happen in Europe. As she rightly mentioned, it is, I think, in its infancy in India. We should see that develop.
Great. I'll come more to the deployment side, but let me just kind of slightly change the topic. Smita, over to you. How would you look at FIs, achieving their goal or the role that they could play in achievement of SDGs. I mean, what would be your thoughts and what has been your experiences again?
Yeah, thanks. Thank you to IMC for inviting me as a panelist. So, just taking a step back in terms of, before I answer your question, Swati. So, I think what's important to establish is while the 2030 agenda is has been, the mantra, so to say, across markets right from 2015. Aligning policies and aligning the financing of these SDGs kind of becomes the mainstay. And this is also evident across different regulations, different agreements across the world. And the sustainable finance market has grown considerably over the past decade, half a decade or so. We have about $4.4 trillion of GSS plus bonds outstanding as of 2023. And of which about 2.8 trillion is green bonds. If we zoom into India, it's a small number of $21 billion, but nevertheless, the markets have grown considerably over the past 3, 4, 5 years. But having said that, there is a long way to go. The financing gap itself is quite substantial when we talk of SDGs in general and climate in particular, right? So 2.5 to $3 trillion, and in India itself, it's about $1 trillion annually. Now, RBI's the PSL norms kind of, fulfill the social side of it. And while RBI has made a lot of announcements in the recent past couple of years, which Manish had spoken of as well. The Currency and Finance report last year spoke of climate as an important area, but still the gap is huge. And this is where financial institutions need to kind of relook at their business model to look at the whole SDG, climate, ESG side as a business case rather than as an additionality, which is at present the case in most financial institutions. And so probably I'll answer your question in 2-3 buckets. So if you look at the capital stack, so to say, for SDG related projects, so these are perceived to be high risk and low return, these kind of aspects, right? So typically for such, the capital stack is for such new projects. Grants or philanthropies come in at the lowest rate. Then there is government subsidies, then there's equity, and finally there is debt, bank or NBFC debt. So from a grant perspective, DFIs, MDB capital is something which can kind of move the market. They can come in with diverse kind of instruments in the form of credit enhancements, interest subventions, maybe I'll talk about it a little later. So that is one important market mover, so to say. Instead of directly lending, if they come in with a credit enhancement that can multiply the market that much more. On equity, we've seen that there are a lot of investments which are going towards climate tech and new age kind of investments, but not so much the traditional SDG related investments. And finally, when we talk of debt, both banks and NBFCs, banks purely look at risk and return. That's what they are there for, right? So looking at innovative mechanisms to kind of multiply their funding by using NBFCs as a backstop, because NBFCs are the last mile delivery partners. And our few interactions with NBFCs are like, we have the reach, but we don't have the capital to do it. We don't have the right kind of tenure in my capital to do it. So marrying these different elements, bringing together ecosystem players is what will kind of move the market. And one last comment on this is, cross-sectoral nature of SDGs has to be taken into account. So while I'm looking at probably, addressing climate change, what about the social aspects of something around just transition, right? So we should be, because we are an emerging market, we should be cognizant of the fact that there are multiple angles one can look at SDGs and not just look at it with one lens.
Very interesting. You've made some few observations. I mean, one is obviously the kind of different types of capital with the MDBs coming in, and but a lot of talk has happened. Not really much has moved, at least in India. I mean, I'll come to that. And again, the actual deployment and the usage. And the third point is obviously profitability versus the real social objectives. So we will come to that. Let me move to Ranjini. You've obviously, right canvas is into, a lot of good sustainability reporting and an actually articulation of, what corporates and lenders or, companies do. What would be your take? I mean, at times, like we just heard, there's a lot of work that's really done, but it's not properly articulated in the ecosystem, or companies don't really, talk about it. I personally have had clients, who say, we've done so X, Y, Z in CSR, but we don't would like to talk about it. So, but end of the day, I mean, my answer to them is, look, your stakeholders need to know what you're doing. And if you've done the right thing and you've done it in the right earnest, I mean, there's nothing wrong in talking about it. So what is your take on this, and yeah, your comments?
Thank you. The narration, what is available right now, is basically one of the thought leadership articles you see in a paper, or probably one of the CSR initiatives being reported as a news report. And maybe, part of the annual report you see a segment reporting about the CSR. It is not because, it is not newsworthy to be reported, but historically, social, in quotes and quotes, gets sidelined or gets very little attention from the stakeholders. Having said that, CSR is perceived probably by the media as one of the marketing exercise or the PR exercise. That also pushes it to the side. So let me break it down, the three challenges basically. So one is the narration which is missing. Second, the consistency, the lack of consistency from the organization to create the narration. And third, basically the data points, the missing data, these are the 3 points. So let me draw 2 examples. So first, let me start from the financial segment itself. 2006-7 period, one of the largest banks rolled out, the doorstep, POS-based doorstep banking. This was meant for, the daily wages, and it was rolled out in Dharavi. So there was a financial technology partner, and this bank rolled it out. There was a little bit of noise made. What went missing was after 6 months or 1 year, the impacts were not measured or not passed on to the stakeholders, which is not communicated. So probably the data might have been lying with either the bank or the technology partner. But nobody actually took the initiative to build on the narrative based on the data and communicate it to the stakeholders. So this is one example which is probably a decade old. Let me draw a newest example. We all see, we all travel, we all use airports. Most of the Indian airports are doing a lot of green initiatives, and some of the airports, especially the Delhi, Bombay, Bangalore, is making noise about their green initiatives. There are airports in India which is completely operational on solar energy, which is more than a decade. There is no sustainable, narrative created. There is no sustainability report or a carbon neutrality report. I doubt even whether they have measured their carbon credits or even, taken the carbon credits. This is what is called the missing narrative. You need to create that narration. Second, it has to be consistent. As I said in the first example, the data points should have been analyzed and given to the stakeholders. So that is where you coordinate all these 3 is where you are going to actually build the narration and make it visible. So the perspective about, CSR being used as a marketing tool will have to be changed. And this is the, style or, tool which you have to put in place to create the narration. So I'll come back to the social factor again, one more time. We have seen the BRSR reports. The first set of reports came into the, being uploaded in the, social, platforms. And we started looking at it. What we felt was the S factor, ESG's S factor, is maybe, like the CSR activities was predominantly filling in the S factor. All other, parameters were missing. So that forced Right Canvas to actually look at a research report. So we actually released the short form of the research report on the 5th of June on the World Environment Day, titled it as Is S the Blind Spot in ESG? So I come back to your, like the last portion of your question, what can be done? Basically, fill your data gaps and create your own narrative, but consistently. So that is how we can address this.
Wonderful. So fill your data correctly, and that takes me to Jitesh. You are a data platform guy, and you are a new age information technology reporting guy. What is your experience of working with clients in terms of how data can actually be captured, reported, and again, like she mentioned, the consistency of that. And I'm not just talking about data pertaining to maybe ESG, but maybe also from a perspective of, let's say the SDG goals, and what would be your solutions to entities, whether FIs or NBFCs or other lenders for this? Yeah.
Thank you for having me. Good afternoon, everyone. So it's a very broad question. Let me touch a few aspects, right? So one is most customers, they want data to flow in a very automated way, right? They will say that, bring a system very magically, the data should be captured. And then when you work with them, either a bank or an enterprise, you realize that most of the data problems are within the enterprise, within the bank, right? They don't have the right owners of the data. They don't have the data in the right place. But because of BRSR, that is changing, right? That's a very good news. That's changing. And because of the supply chain part of BRSR, that's also changing for SMEs and MSMEs. On the FI side, I'll pick on what Hina said. There is very little real activity and transactions happening, but awareness is happening. Now, what awareness means is that banks are, at least the leaders in India, they are doing something about getting visibility into climate risk. What does that mean? That means, financed emission measurement, a good methodology to calculate physical risk in their portfolio, and at least on a path to figure out how do we calculate transition risk in our portfolio. Right, so they're investing capital cycles, brain cycles in that, right? So that I believe is part of kind of awareness and momentum, right? So that's the lead indicator that we will see kind of more tangible things happening. I think what's moving the needle forward from a technology standpoint, I believe is the newer AI, which we call Gen AI, right? So see what happens for most people, ESG operational measurement is a cost thing. They don't see a real value right away. So the first thing is, boom, you want us to measure this, do a BRSR report, we want least operational overhead. So most automation technologies so far, they were not very sturdy, but now, 18 months back, a game-changing technology like landed, right, which has a broad set of use cases. But one broad use case is capturing data from documents in a very smart way, right? What smart means is the predecessor of this technology for capturing data from documents is something called as a traditional OCR, which is very brittle, meaning if your document changes a bit, you have to dramatically rewrite your code. That has a lot of CapEx, OpEx involved. But Gen AI changes that. It's very less brittle. So that leads to your ability to automate in platforms, data platforms, has dramatically gone up. It's 10x that ability to automate at a very low cost for providers like us, right? We are piggybacking on this technology. So that's going to help in a big way when it comes to data capture.
But in the sense that, garbage in, garbage out, right? What would be then your view or your advice in terms of safeguards, in terms of seeing that, you know, how the data points get input or the collection happens right from the source, so that at least the input is kind of, you know, sanitized or is pretty hygiene.
Yeah, it's a great question. So when you think about garbage in, garbage out, what is the status quo to avoid that is audit and assurance, right? Now what platforms like Credible do, they take like a multi-front solution approach, right? So one is, can you, in a very automated way, capture data from source like SAP systems, HRMS system, BMS system, that's one. Second, can you take evidence directly, like a piece of electricity bill, from the provider, from that capture again the resource consumption, right? So given again GenAI, it makes it a lot more easier, more effective, less cost for providers like us. That's second one. Third is, how do you create a piece of technology that allows internal assurance? So we do that at scale, right? For large companies like IHCL, Wellspun, before an audit happens, they run through our GenAI pre-assurance workflow, and it will tell you, right? Okay, this piece of evidence in, let's say, in this hotel, diesel consumption, there is no evidence attached, right? In this factory for scope 2 electricity, the evidence looks wrong, right? So it's kind of a step-by-step process that reduces now your audit cost. Right, and eventually we'll get to a stage where you can do a lot of these audits in a very automated way.
Interesting. And probably that's the usage and that's what you want out of fintechs, right?
Yeah. So one caveat, right? If you have a bad actor determined to do wrong, determined to greenwash, right? It is a moving target. They will always find loopholes. And you know, we all know, right, this part of the world, audit especially, like, you know, certification, that can be very gamed, right? But technology actually helps there, right? It creates a much better audit log, you know, and most enterprises today, they actually don't want to, they want to do the right thing, right? When it comes to sustainability and ESG. That's what we are seeing.
So coming back again to Manish, Manish as a bank, right? I mean, we heard the discussions on the borrowing side. Now on the lending side, we heard the previous panel saying credit is first, then comes climate. How true, or how is it? What is the general nature? I mean, is really SDG goals or ESG goals really built into financing or lending for that matter, you know, at the time of credit? Or do you turn around and say, okay, hey, it's a very good piece of credit, but I'll overlook the, you know, the so-called, as long as it's just meeting the borderline, you know, what really goes on? How does a lending guy think?
So I'll actually answer this question in two parts, and in fact your question has two parts. First is, I believe, and this I'm speaking for most of the banks today, I think credit risk is paramount. So green can come later. First, you know, the ability of a bank on, you know, return of capital. Earlier it used to be return on capital. Today it is return of capital, which is paramount. So assessment of credit, ability of the entity to generate cash flows from business, from its operations, I think is important, and that is here to stay. I think the banking system in India has had, you know, a very hard time over the last 10 years, going through a particular process, ensuring that now we are adequately capitalized, and you know, we are now, I would say, prepared for the next phase of growth. So that is paramount. Then comes the ESG assessment, and that is where, you know, I'll answer your question on whether SDGs, you know, are embedded. So here, let me step back. If you look at, you know, how the Indian banking system has evolved, and thanks to a lot of regulatory guidelines on directed lending, when we talk about, you know, priority sector lending, all that is actually SDGs. Because if you look at what is SDGs, it was about eradication of poverty, malnutrition, education, providing, you know, environment, sustainability. All that is actually priority sector lending that we have been doing. Financial inclusion, you know, has been something that we have been doing for ages. So it's not that SDGs had been overlooked. It's only now that, the same thing is being presented in the form of SDGs, and, people have a narrative to say so around how they are, establishing their practices. With regard to, on the lending side, identifying opportunities in SDGs, if I just move away from the lending activity of a bank, we can also focus on the corporate social responsibility of a bank. Now, as part of the corporate social responsibility initiatives, which of course now are governed by the Companies Act of 2013, and in fact they revamped the entire regulation in 2021, when they came up with the corporate social responsibility rules. A lot of the initiatives which are already specified in Schedule 7 of the Companies Act are actually addressing the SDGs. So if the organizations can really structure their corporate social responsibility activities in that direction, we will be addressing the SDG goals for the country, the SDG requirements for the country. Just to give you a sense, based on the data published by the Ministry of Corporate Affairs, so as part of the corporate social responsibility requirements, the entities need to actually publish an annual report, which is published on, which is submitted to the Ministry of Corporate Affairs. And the Ministry of Corporate Affairs, aggregates all this data. They publish an annual report, and based on the last published annual report, the total spend of the country in corporate social responsibility was close to 26,000 crores. Now that is the money which is going for SDGs completely. Out of the 26,000 crores, if you look at the sector-wise, bifurcation, 75% of these funds are actually going into the top 5 SDGs, which is actually eradication of hunger, poverty, dealing with malnutrition. It is about education. It is about sanitation. It is about healthcare. It is about environmental sustainability. So 75% of 26,000 crores is already going there, and given how we are right now positioned as a country, we are seeing increased profitability of corporate India. The way corporate social responsibility regulation is, it is actually linked to the profitability. So organizations which have a net worth of at least 500 crores or a turnover of 1,000 crores, or they have they are required to set aside 2% of the average last 3 years profit towards corporate social responsibility. So to give you a sense, the top 10 entities in India, which are actually spending towards CSR, they actually contribute to almost 25 to 30% of this 26,000 crores. So that is the kind of funds which already are getting deployed to meet the SDG requirements of the country. So in addition to the lending activities, which now are getting termed as green finance, are being looked at sustainability lending, I would also urge that we should look at the corporate social responsibility angle, which I think the companies have been doing. They will continue to do, and they will continue to do at scale.
These are good data points, Manish, but clearly I guess 26,000 crore falls short for a country of India's size. Just a very wild question. Do you think that somewhere in future we could actually have a regulation that, like you have financed emissions, you say financed SDG goals?
So actually, she actually alluded to that, and in fact in the previous session also, as part of the corporate social responsibility, there is a requirement to assess impact. So I don't know whether it will be financed emissions, but assessment of impact could be a measure of how we are performing on SDGs.
Yeah, but that's also about 10 crores or 10 crores and above and 1 crore and above kind of a project, right?
Yeah, so 1 crore and above needs to get assessed, but obviously that is a regulatory requirement. I'm sure responsible organizations can do much more.
Absolutely. So you want to talk on this, since we are on the topic of CSR engineering, you want to take this forward and maybe throw some lights on the social return on capital kind of aspects of projects on that?
We have seen a lot of work, especially in the clean energy segment happening. When we talk about clean energy, there are two types. One is like the larger, clean energy projects which is being developed in the country, and the smaller ones, that is the standalone or For example, a solar lighting or a solar pump or a solar fan for that matter. The investment which has gone into this segment actually started giving returns. Yes, I mean that is what the data is showing. Probably banks, the larger banks may not be in that segment, but NABARD for that matter. I'm talking about the wash lending segment. So there is returns, and NABARD's latest data shows it's 100% repayment. And the ticket size is very small, 15,000 to probably 45,000 or 60,000 is the ticket size, but 100%. There is no, non-performing assets there, which itself speaks for itself. And the quality of life has improved in the rural segment. This is about rural. When we come to, urban, take the example of the first renewable energy village in India, which is in Gujarat, called Modera. So that village has installed around 1,300 solar rooftop. And the whole village, their electricity bill has come down to the minimum. So this is grid connected. The first thing which I spoke is like standalone entities, which is also giving, good returns. On the other hand, in the urban, not urban, but semi-urban area, like a whole village, where the clean energy has brought down the energy bills. So that is cost-effective energy, clean energy which is available. So in that way, if you take these two examples, there is return. Absolutely, there is return.
It's good, interesting. I'll come back to the original 2 points that we were wanting to discuss, innovative financing and profits versus social goals. So I'll take the innovative financing. Smita, would you want to talk about the innovating financing structures, more on blended finance and adaptability in India, challenges, gaps? I mean, what's really holding it all back? Every year, even COP28, we heard so much about all this, and still not much is really seen on the ground. So.
Yeah, so I think we look at it probably from the capital raising side and the capital deployment side, right? So traditional financing, because of the nature of SDGs and the unique nature of the projects, the perceived risk and even actual risk in some cases is high, and therefore there is a need to kind of look at how to reduce that risk component, because for a bank, for an FI, it's ultimately, like even Malish told, the credit risk is the paramount factor. So blended finance, which you spoke about, Swati, is an oft repeated term, and very across markets it's being kind of explored on how to deploy. So I'm sure everybody in the room knows what it is. So it's basically looking at how to leverage public capital to leverage private capital, how to use public capital to bring in that catalytic effect to draw in more private capital to achieve scale. While this is an important, this is a good structure, so to say, there are inherent challenges in terms of how different stakeholders kind of come together to, carry it forward. So there's an interesting example I just wanted to talk about, which happened in the run of Kutch about 2016, 2017, where a private sector bank in India came in partnership with a local NGO and a local cooperative bank. This was Seva, and which is focused on women. And basically the structure, so the run of Kutch has a lot of salt pan farmers, thousands and thousands of women farmers who work in scorching heat, to make the salt. And they use diesel pumps. So this particular structure addressed about 7 or 8 SDGs, where the blended finance structure looked at transitioning from diesel pumps to solar pumps. And there was a guarantee component which the bank brought in as a guarantee for the loan given by the local bank to these women farmers, because they didn't have a credit history, there was no paperwork, etc. And there was an interest subvention, because Otherwise, they used to borrow from money lenders at exorbitant rates. So the loan itself was subvented. So part of the grant component used to reduce the interest rate, and there was a technical assistance component to build capacities. So it was a very tight-knit structure, and this bank did a pilot with 600 farmers, and then it went on to a larger bank, Indian public sector bank, which took on a larger cohort. And there were SDGs across environment, health, financial inclusion, gender. We've not spoken about gender. So gender empowerment, which kind of were addressed. So these structures, to answer your question on what is holding it back, it is about bringing the different ecosystem players together to stitch together a structure where everybody wins, and that comes with push from all parties. And there are other structures which Manish spoke about, sustainability linked loans, outcome based financing, etc. Okay. But I think we are running short of time, so I'll stop.
No worries. Back to you, Hina, again. You've been an impact investor also, and obviously you advise again banks and financial institutions. So we heard Manish on the side of building ESG in your investment proposals or lending proposals. I mean, what is your advice to your clients in terms of marrying the two, the social goals and the financial goals? And you also as an impact investor, I mean, do you guys kind of take a little bit of hit on the financial returns to kind of look at the social goals, or how does it work?
So I'm gonna bust a few myths in the next 2 minutes. One, so the origins of impact investing in India started with social, frankly. That's more than 15 years ago. And how did it start? Frankly, a lot of DFIs have started. The pool, and don't quote me on this, but the pool for DFIs for specific countries remain the same. And we all know that the local, bilateral, geopolitics all play a role on where that money is going. So an XYZ government will have a certain amount of allocation for India. Now, 25 years ago, that used to come as aid and support and guarantees. 15 years ago, it came as social financing and so-called impact financing. So the DFIs became LPs in the impact investing funds. Now it's a similar pool that's coming more towards environment. So the pool hasn't increased. With that being said, that pool does provide patient capital. So to answer your question, do impact investors are willing to take smaller returns? Yes and no. Like Manish said, I have, see, credit risk is primary. It's not a transaction where the credit risk is not taken care of, right? It needs to be mitigated. So, but what's happening, and I have a different viewpoint here, that 5 years later, or let's not even say 5, 3 years later, it will become credit risk plus green risk. Like right now what's happening is credit risk is established. Some companies look at the green risk. 98% are not even looking at the green risk right now. Some are, but the decision making there is no green risk involvement there. Even a lot of impact funds that are doing it, green becomes a filter. Like, it becomes an outcome in some cases, a filter in some cases to establish it, and that's what needs to happen 5 years later. I would say for banks specifically, banks and FIs, the way they make decisions when it comes to allocating loans, specifically in high emission sectors. When I say high emission sectors, I'm really talking about oil and gas, manufacturing, I wouldn't say agriculture, but primarily chemicals and some of these extremely, infrastructure, power, all of this. They will, 5 years later, green will be alongside credit when it comes to making a decision. And when I say it's not about green positive, it's about green neutrality. So basically, you're not necessarily putting money where there is some positive impact on the climate, but you're making sure that the money you're giving is not having a negative impact. You can't add to the emissions or to the damage, because we've already seen, I think, what frankly, there's no data around it, and maybe, Smita will add more to it in terms of if there is any data. I'm not aware if there's any data around the damage that if we don't focus on green right now, that I think environment has caught all of us in such a phase that if we don't do it, 2 years later, whatever we're doing with CSR, whatever we're doing with social funding is all, environment is having an impact on all our businesses. And, all the progress that India's made as a country will start fading away because people are losing their, livelihoods, losing their properties and everything to the climate change. So it's just a matter of time before we start doing that. Just want to add one more point, specifically on the blended finance part. Now, India needs, there are multiple numbers out there, but say 10 trillion till 2070 to actually achieve, I would say, net zero. I'm not talking about SDGs, but say net zero. Where is this money going to come from? That's a lot of money. There is a huge, huge gap. Blended finance, I think India is a hotbed for it. We have the social, we have the environmental challenges. Whatever models for blended finance can be piloted here can be scaled to multiple emerging markets. And we've proven that with impact investing. Impact investing, whatever the model that's been deployed in India is now being used in Africa, South America, Southeast Asia, right? The same thing for blended finance. But with that being said, the Indian regulations don't support blended finance. Let that be, we've been in conversations with a few DFIs and private sector investors to stitch something together, but there are tax issues, because the money is coming from different geographies, there are legal issues. I don't think India is ready, or currently the regulations are not in favor for even experimenting on a few things. And a big role that in order to fill that gap would be the 26,000 crore that you're talking about. I think the CSR funding, there are a lot of caveats on what it can and cannot fund. For blended finance, you need a certain amount of funds who are willing to take the hit, who are willing to be the patient capital, who are willing to say, you know what, I will lose this money, but go ahead and try this transaction. And that, India is one of the fewest countries in the world, if not the only country, with a 2% regulation which says there has to be mandatory. And we should make the best of it because that is why India is the hotbed for blended finance. We have we have the factors in the environment. We just don't have the regulation supporting it. If that can change, I think India will scale significantly in terms of, the gap to filling for the net zero specifically.
Interesting point. I would love to, kind of go on because I also wanted to, kind of rake again Manish's brain on, credit risk without actually factoring in physical risk. Is really credit risk immune to physical risk? But I guess we are running out of time. I think we just have a couple of minutes more, and we should, give a chance to the audience. Any questions from the audience? Yeah, we can see one hand behind. So, sorry, we will have a mic first.
Good evening to all of you. Yeah, see, as far as me as a common man, I fail to understand that, there's no transparency maintained when we are talking about any CSR activity taken up by a corporate house. So, I believe that CSR departments itself are made in big corporate houses to be manipulated. Because as an end user, a common man does not know where the funds are going. People coordinate, the CSR department coordinates with the kind of trust and NGOs where there is a lot of manipulation happening. The figures that you are mentioning are only for the purpose of showing up to the people, but people are not aware about any CSR activity which is being taken place. And when you're talking about mandatory obligation, there's no proper mechanism to assess, there is no proper CSR audit which is being taken place. So but people are, there's a lot of distortion in this area. So I believe there needs to be some transparency in the CSR activity which is being taken place. Some mechanism has to be in place where people in large should be able to know. Huh?
Yeah, so I think it was with this objective that revamped in 2021. And one of the requirements is actually to make available all this information on the website of the company. So probably you may like to revisit that.
I think,
A loud applause. That was a very good session. May I now request Ms. Swati Agarwal, moderator, to present a memento to Mr. Jitesh Shetty as a token of her appreciation and gratitude. To Ms. Smita Hari as a token of her appreciation and gratitude. To Ms. Ranjini Lisa Varghese as a token of her appreciation and gratitude. To Ms. Hina Khushlani as a token of her appreciation and gratitude. To Mr. Manish Kumar as a token of her appreciation and gratitude. May I request Mr. P.D. Singh, Co-Chair, Banking, NBFC and Finance Committee and Bank CEO, JP Morgan Chase Bank, to present a memento to our moderator, Ms. Swati Agarwal, as a token of her appreciation and gratitude. Thank you, ladies and gentlemen. So we now move on to the fifth panel discussion. Inclusive insurance, for which I would like to invite the moderator of the session, Mr. Siddharth Shah, Director, Consulting, Deloitte India, and the elite panelists joining him on the dais are Mr. Suresh Badami, Deputy Managing Director, HDFC Life, Mr. Piyush Trivedi, President, Kotak Life Insurance Company Limited, Mr. S.V. Sundar Krishnan, Chief Risk Officer, Life Insurance Corporation India, Mr. Rajiv Kumar Gupta, President, PB Fintech Limited Policy Bazaar. May I request all to take their seats on the dais. May I request all the participants to move away from the stage. Can I request all the speakers to move away from the stage? Dear participants, please do not crowd on the stage. Dear participants, please do not crowd on the stage. We are about to begin the session. Their time is running out. Their time is running out.
Wonderful. Thank you so much to the panelists for joining us this evening. I think if we look at insurance as a sector, right, I know we're talking about inclusive insurance, but there are very few sectors that are designed or industries that are designed to be inclusive. The fact that we are pooling risks together fundamentally makes insurance an inclusive industry to be in. And I think that's a great starting point for us to, just think about and reflect on what we can accomplish as an industry. For us to be able to get to the next level, like if you look at the most recent data that that the IIDI has published, we are between 4.2 to 4.3% of GDP in terms of penetration when it comes to premiums. The next frontier obviously is to make it to the next tier of our populations and our citizens in India who have historically not been able to buy insurance or have not even participated in financial services. And I think one of the barriers has typically been awareness. Obviously, we've come a long way in being able to overcome that barrier. Would love to get your perspective, and maybe Rajiv, we start with you in terms of how have you seen the barrier of awareness being overcome, and especially from a digital standpoint, right? Because that plays a key role in being able to access newer populations as well.
So I think I represent InsurTech industry. I mean Policy Bazaar. So over the last 15 years, I would say Policy Bazaar has done enough to create visibility and awareness as far as the insurance business is concerned. Now, coming to your point, how do we reach out to a segment which has been ignored, or how do we address the protection gap which has been prevalent in this country? So what we've done over the last 2-3 years is we've also built a phygital model in the sense we've gone offline 3 years ago. So we represent about 97% of India's PIN codes. Now, the biggest challenge in these markets is how do we create the financial literacy? I mean, while Jandan accounts, initiatives like UPI, have all reached those pockets, but people should know why buying an insurance is so important. So education in terms of financial literacy is crucial before we can penetrate into those markets, number one. Number two, obviously, how do we create visibility? The visibility can only be created if you create local influences in those places. I know of NBFCs who operate from tier 2, tier 3 cities, and they have appointed local women from the same village to represent their products. So in a way, I think, one, we educate those people first. In turn, depend on those local guys to create groups to influence and educate the other people in that market. I think that's the way I would say we can probably make a beginning.
Got it. No, Rajiv, that's very helpful. Suresh, maybe pivoting to you next, right? Have you seen a shift in the last 2-3 years? Obviously, COVID put a little bit of a bump in the industry's growth, and then there was a little bit of a spurt, especially on the health side. But have you seen a shift over the last 2-3 years in terms of awareness? And to Rajiv's point, like incumbents have a lot of physical distribution.
So Siddharth, I think the challenge in the industry is not so much of awareness anymore. Okay. I mean, to be fair, LIC has been in the country for many years and almost everybody knows about LIC insurance, right? And then the private players came in. I think COVID in many ways brought insurance right up forefront where everybody got to know about the need for insurance, right? I think many of the government schemes like PMJJBY, everybody knows about many of these schemes, so that you know that. So really the challenge is not anymore in the country to be aware of insurance as a product. I think there's a little bit of inertia, and then the inertia converting to people actually going and buying insurance, which is why our penetration levels are so low. But if you really ask me, the way and I'm sure even if you go to the smallest of towns, in fact, almost 60-65% of our business at HDFC Life comes from the tier 2, tier 3 markets. What Rajiv mentioned is every corner of the country now has a bank branch expansion happening, right? And whether it is the PSU banks or the private banks, we work with almost every bank, every NBFC, every small finance bank, every ecosystem. We're large partners with Policy Bazaar, we're large partners with every bank which is there. So really it is no longer an issue of taking insurance to at least a tier 2, tier 3. Right? I think off late the awareness also in terms of how do we take it to really the rural areas or get into those markets. Some of the government and the IRDA led initiatives in terms of Bima Vistar, Bima Vahak, where you take it to the end Gram Panchayat. So it is now a question of how do we reach and convert and make sure. And both on the individual side as well as on the group side. And I think really when you talk about inclusiveness at the really upcountry markets, the tier 3 and the rural markets, the question is how do we go back and take products like PMJJBY or other group products where we can go back and service the insurance needs. So, and of course, in terms of marketing and visibility is no longer a challenge. I think, the way telecom has gone into each of these markets and how we have also ridden along with telecom to some of these markets. So it's now a question of how do we create those products to be able to solve. So there has been a shift. I think post-COVID, you're right, there was a little bit of a bump up in terms of the protection requirement. But given what is happening and, the IRDA and the government vision of making sure that by 2047 every Indian should be covered, I think it's
a great point just on product itself, right? And so then maybe you can weigh in from your experiences. How does one underwrite a risk of population that we've historically not been able to underwrite very effectively? Do we have enough data? With the advent of third-party data sets, do we feel comfortable as a sector that we have all that we need to effectively underwrite the risk so that it's affordable and at the same time it's not it's profitable for the industry as well?
I think data is a challenge. So much as we would like to have very intrinsic data and well characterized across tier 4, tier 3 and rural area, data is still a challenge. But having said that, Aadhaar has made some inroads, PAN, Aadhaar and the mobile network. So, but the KYC even at the telecom level is not so great yet when you actually go to enforce that. And so products, there is a liberalization that has come from regulator. Now you don't need to file the products, you can do use and file. So the ability to change the products or refine the products as per needs is there. And if you see some demand for a product in a particular location or a particular place, you can actually come up with a product. That's there. And then, of course, Suresh touched upon telecom, and that's a very important initiative. So if you're able to sell simple products or products in a simplified manner, using telecom, using mobile, and then you use mobile to buy, then it would work. I think it's already there. All the underwriting, those supply side, those things are there. It's just that the awareness needs to creep up, and much more needs to be done on awareness side. And to underwrite data in a mass way, you have PMJJ experience, but you know the pricing is still a challenge. The supply side, we still find the price tough, and we need to have the flexibility to change as per the underwriting requirements. Coverage should be there, but ability to reprice or price more than what is given, given the underwriting risks, which are different in different parts of the country, different occupation, different lifestyle, different places. But so coverage should be mandated. I think that there is some need there. But then you can't then say we'll price only at this rate and then you sell it. It's very difficult. And then you'll have the suppliers wondering where is the profit margin and profits there. So it's not possible in that sense. There are a lot of changes even again in the norms of the government. Now it's getting tougher and tougher for the supplier side to make money or have adequate profit margin. There's already talk about surrender thing coming in products, wherein you'll have to offer a certain price. All this requires deep reserves to back the product, and then that kind of reserve you can't price the way it is you asked to. And so you'll have to meet these challenges when you think about the country and the largeness of that. At the same time, again, if people do not have money, they are below, just above the poverty line, and then how can you force them to buy insurance? Then you mandate insurance in a certain way, in a group manner or something like that, and cover bulk of the population. Then you can achieve 2047 motto of insurance for all.
No, I think that's a very valid point. And like if you look at India as a country, obviously micro insurance, group insurance on the back of microfinance, we made a huge headway. Piyush, in terms of product innovation, where do you see the next wave of innovation coming from, especially to cater to historically underserved segments, the missing middle as we often call it?
I think I would like to start with something which Suresh covered in terms of inertia. So inertia is coming from the consumer not engaging in the product, and not engaging in the product because like they find it a complicated topic. Like something which you talk many times, like when people get married, they'll talk about what is the income earning on either side. They don't talk about what will happen if that earning is not there, that's where the insurance comes in. So if you look at last 10 years, the innovation which has happened on products is phenomenal. Whether it's protection segment, whether it's retirement segment, or even on the savings and ULIP. Still, and PMJJBY, I think somebody covered that. I think it's a brilliant initiative to what Sundar talked about, people who are near poverty line, people who can't afford significant premium, but they can afford 500 rupees for the year, and the 2 lakh cover is significant, like kind of for that profile. So there's a lot of innovation which has happened. I believe something which we need to crack as an industry and as a society is like people who are the youngsters at the age of 23, 24, 25, how do we make them understand the value of protecting their future, protecting the future of their family, and start participating from that stage. But generally when people enter at the age of 40, I think it's slightly late. And many times you have seen events which like at an early stage, people should have got themselves covered. So that's something which we need to cover for. In terms of the missing middle which to talk about, I think affordability is kind of taken care of. Like today, the products are offered across ticket sizes, across premiums. And people can choose what they want. What duration, what kind of cover, what kind of cash flow objective which they would have. So I think there is enough which is done. Certainly we can do more. If you look at internationally also, except a few products which are linked to market, like index-linked annuity kind of thing, I think most of the products are available in India today. And again, someone talked about the liberalization relaxation which IRD has come up with, where the products can be designed and launched by the company itself instead of going back to IRD taking approval, which used to take slightly longer. So the response time has improved significantly. So if I see an opportunity, something a consumer would want, something a consumer would value, we are able to respond in a month's time today. So.
No, that's a very interesting point you make, and maybe Rajiv, I'll come to you. We still see that persistency levels in the industry are not where we would want it to be, right? Across life, motor, in motor, especially when it comes to two-wheeler, it becomes a lot lower, after year 3, year 4. If we go by, what has been discussed here, that awareness has increased. Once the customer has experienced the product, they know what they are protected against. What can we do more to drive persistency, thereby protecting the insured as well as ensuring that the policy life cycle continues and insurers and distributors are also remunerated adequately?
So I think on the life side, since I also spent a decade in SBI Life earlier, I can certainly see a sea change in terms of the improvement in persistency. I mean, right from 13th month to say 72nd month, I think the persistency has certainly improved a lot. People realize that if you buy a life insurance product and if you don't pay, it doesn't help them in any way. I think so. That is one area which is taken care of. When it comes to motor or health, obviously today there's a lot of selling happening, service issues, trust deficit. So people putting from one company to the other because they are not long-term policies, they are on annual premiums. Yeah. In case of health, you do have 3-year plans and now you offer those third-party insurance for 3 years. But I guess that's one area which can only be resolved if the trust deficit is removed. And so somewhere, how does the unit work together? I mean, when it comes to health insurance, healthcare industry, the TPA, the insurer, the agent, or the middleman, I think all of us have to come together to ensure that the customer experience at the time of buying remains the same at the time of when he wants the claim. I mean, that's the biggest challenge which today people face. And a lot of steps are being taken by everybody. I would say the insurers are taking their own step. The TPAs are integrating very well. Now, we as a broker, Policy Bazaar, we have started offline physical centers in about 127 cities of the country where physically our people are present to assist in claims, be it motor or be it health, predominantly health. Motor doesn't require so much of assistance. Yeah. So somewhere that integration of dealing with too many people, and getting a shock that this is not covered and that is not covered, you raise a claim for 1 lakh, you get paid 80,000. People are not aware why the 20,000 is not paid. Yeah. So somewhere all this will have to be reworked. Creating a document which educates people at the time of buying that what are you going to get covered when you buy a policy, be it motor or health. Yeah. So important is to take care of that first, and number 2, at the time of delivery, I think when it comes to claims, the experience will have to be much more better.
Yeah. And Suresh, maybe I'll go to you next. At least on the life side, you have interventions such as PIVC, more digital, analytics being run right up front on who we need to check for. But what more can we do to actually build that customer trust, and potentially with, if a composite license was to come and foray into health and all, how do you want to build a relationship wherein your customer is looking at a holistic financial well-being portfolio from HDFC Life and other insurance companies?
So, Siddharth, if I were to add back to the first question on awareness, I think 2 other things have happened in the industry over the last many years. One is this whole piece in terms of transparency and simplicity of the products. The way even the regulator IRDA has gone back and ensured that products are simpler, the charges are simple, they're capped. So one is that to say that how do we make sure that the charges and the benefits to the customer are better, yeah, and they're capped. So it has come along with awareness, along with a little bit of simplicity and transparency in the products and in terms of being customer friendly. The third thing which has happened, frankly, is this whole technology which has kind of allowed us to reach out to the end customer, whether it's in terms of sourcing the policy or servicing the policy or even the claims which has come in. So really all 3 go in tandem, the awareness, the product simplicity and transparency, and third, the technology, right? Now, obviously, when you go to the customer, we have one of the best-in-class persistencies in the market. But the idea is to make sure that the customer understands the product not just at the time of sale, but also at the time of renewal, right? And it's not that you've sold the product once and then you forget about it. The customer understands. So it is in some sense a continuous engagement which can now come with either technology. And you have obviously the advantages of technology to have a standard instruction where the customer doesn't forget to pay, stuff like that which can be done, right? On the second aspect, to say how do we build trust with the customer, I think the trust with the customer comes when they see claims being paid on time, which is the best. So, you'll have the best in terms of claim settlement. You see the servicing getting done. You see the families around you benefiting by what claims are coming in. And I think that has started showing clearly trends in the industry, which is happening. On health specifically, and given composite license you're mentioning, we are equally keen to see that composite license plays out. Look, at the end of the day, the customer needs to be covered for both the mortality and the morbidity, right? And you want to make sure that the customer, when he's engaged with, and worldwide actually life insurance companies look at health. In India, we only sell fixed benefit products. But even with fixed benefit or indemnity, the advantages are tremendous. So when you go to a customer, at one shot, the same medical can cover for life and health. Right. Second, life insurance is a low engagement product. You sell and you don't then engage with the customer. Health is a much higher engagement product. So then it allows the life insurance companies to kind of engage with the customer a lot more often. Third, in terms of underwriting health, you've got the customer's background and the health checks. You can use that for life insurance. So you can offer better products, better pre-approved, better medical limits. Right. All that can be done. And finally, if you were to add value added like wellness propositions. So, in some sense, life and health. And really what will happen is when the customer sees the entire benefit of life and health coming, the trust builds, right? And so then finally, life insurance is about claims, right? And you are able to ensure that whoever is covered, of course, other than the savings, mainly about claims. And you see that, look, there have been years when we have settled like more than 383,000 claims for 4,300 crores. That's the number of families that we have gone out and touched in terms of claims service. I think over a period of time, that will build into long-term trust for you.
Trust with the customers. Wonderful. Sundar, there's been so much talk about technology. I think with technology comes a fair bit of risk as well, right? When it comes to cyber risks, when it comes to consent architectures and ensuring that individuals' privacy and rights are kept in mind. How should the insurance company think about it in terms, especially when dealing with segments that have historically not been as, they've not been made aware of the risks that come with technology. I mean, as Indians, we tend to give away our data a lot more freely than many other citizens from around other countries, right? So what are maybe some thoughts on that?
I think I've worked in banks, mutual fund and insurance companies, all the three, entire BFSI space. So I see marked improvement in way insurance companies understand cyber risk. Yeah. And there are tremendous investments on security, architecture, and machinery, and logging, and monitoring. So I think the understanding is fairly mature now, at this stage. Initially it wasn't so. But insurance is caught up with banking, more or less. I think if you see the investments, everybody is invested heavily on various security equipments that are required, audits, monitoring, logging, everything is there. So in terms of people, process, technology, I think we caught up sufficiently. Coming back to the other question on persistency, I had a journey from 56% to now 82.5. Yeah. And the whole journey was technology enabled. So we used to take the technology consent from the customer, call up the customer, welcome calling, then you have confirmation calling, saying these are the things you bought and you are aware clearly that you have to pay premium for 10 years. Yeah. And that improves persistency a lot. You take up checks in advance, or you take a EFCS, financial transfer, which the customer does beforehand, the persistency jumps up. We also take 2 mobile numbers now, and that again persistency jumps up. So each and every technological advancement that you do, the persistency jumps up. So there is a lot of awareness of technology usage in the industry. It is highly technology driven, probably the number 1 or the number 2 expenditure if you take people into account. Yeah. And I think it's quite risk management and security is quite advanced now. So I wouldn't be that worried about companies grappling with technology risk. Even LIC is going for digital transformation and an agency transformation. We've appointed BCG and Nitty Kearney and a lot of support. EY is doing the risk management. We have done the risk management. So there's a lot of support companies seek to go ahead with the journey. And it has certainly helped persistency also and awareness about cybersecurity.
Yeah. I'll maybe catch you off the stage on
Sure.
data privacy. But Piyush, maybe the last question to you, just in the interest of time. It would be a missed opportunity if we don't talk about generative AI in being able to get to the next tier of customer, playing a significant role in being able to get to the next set of individuals, whether it's vernacular, whether it's other interventions that can really help us drive inclusion.
I think he would have been better expert on Gen AI, but so what I believe is like one of the life insurance model, the way it works is because of the need to sit with somebody and explain the product. There is huge dependence on human beings, whether it's your employee, all your agents, or your partner employees, etc., those kind of things. And ensuring that at each interaction, the communication in the way you would want, the communication standard, that becomes difficult. A Gen A kind of solution, like for a call center kind of thing, it can ensure that the initial pitch is identical. It can ensure that whatever is being communicated, so whatever people are talking, you can, on the go, training could be done, on the go, factors can be identified and can be corrected kind of thing. Like even the communications or like what you want to drive, what are the initiatives you want to take, a lot you can do on Gen AI because like it's able to adapt. It's able to learn on an ongoing basis, the way we human beings learn. So a lot of things which we are doing today, properly adapted, today it's very expensive because of for each ping you have to pay and that's damn expensive. But once it becomes more economical, I think a lot of use cases will develop and the ability to reach out to larger number of people in a shorter period of time. So many years back, people started selling insurance on telephone, telesales model which started. The biggest advantage was that like if you have to reach out to 50 people, you can't do it in a day. But when you're calling on the phone, you were able to reach out to call 150 people and talk to say 20, 25 people. And that helped you reach out to people and sell to the large number of people at different time. So I think Gen AI will bring that kind of revolution where your ability to reach to larger number of people at a much more economical cost and at much faster the pace would be possible. At the same point of time, it would be able to speed up things and make them more efficient on the back end.
Got it.
There are a lot of things which you can do on the back end side.
Got it.
So if I can just add to that, there are obviously a lot of interest in what we can do, but clearly 3 areas which emerge on Gen AI: underwriting, the call center, as well as distribution marketing. And we can expand on this, but clearly underwriting also is a huge area of where Gen AI can come in and ease the process of insurance.
Even the risk management side, AI can speedily identify a fraud or a outsider in the framework.
Yeah.
So there are many frauds that have been caught using AI faster.
Thanks for that. Maybe any questions from the audience?
Anybody? Yeah, please. Yeah, the mic, please.
Hello. Thank you for the announcement. My question is, let's say from awareness point of view, so demand point of view, there is awareness and people are okay. From supply side, do the insurance company have lack of incentives, as in because the ticket size will be less in those areas, more and more network and capacity building will be required. So are there any lack of incentives on the supply side at least, or how do we see things progressing there in the future? Thank you.
So I think from a supply side, there is firstly no dearth in terms of the value proposition. The products are all available. So if you really look at it, there are products on the individual side, there are products on the group side. There are products across ticket sizes, with the smallest of ticket sizes to very high ticket sizes products are available. So it's really not a question of how do we be able to provide something if the customer is interested, right? And depending on the customer profile, there are products which are just pure term, there are products on the unit links, market link side, there are products on the guaranteed side. So the products are all available. Now the question is, especially in terms of inclusiveness, how do we take it to the smaller markets? And you will find that slowly from tier 1 business, the insurance companies are expanding to tier 2, tier 3. In fact, like I mentioned, for us, almost 65% of the business comes from tier 2, tier 3. A lot of the insurance companies are setting up branches or setting up their financial consultant setups in the middle and the smaller markets. But really at the end state, which is really in the rural and the social obligation, which is there, and in some sense, IRDA mandates that every company needs to do a certain number of policies. There are a lot of initiatives which is happening. The biggest one is the whole Bima Vahak and the Bima Vistar initiative, which the IRDA chairman is looking at to say, how do we take it to every Gram Panchayat? So every insurance company is expected to own a certain number of Gram Panchayats. The second, a lot of these products are on the group side, like how Rajiv had mentioned earlier. Finally, it's about assessing the risk, either it's in terms of the health profile or in terms of claims or investing the claims. The best is you design products which are small ticket size, which are then available for a huge number of customers. Because the risk in insurance is if you sell a product and it goes only for negative selection, for people who are unwell, it will not be a win-win for either the customer or the insurance. Really, you need products which are small, which are then available to, let's say, the entire village or the entire small city. Then you cover the risk, and that is how insurance was born, right? If something happens, the rest of the city kind of pays for that. So there is no real demand either, or no real supply side problem in terms of designing products or reach out. And with technology, whether it is fintech or whether it's telecom, for instance, we had a product where we had built in a product to one of the telecom prepaid products, right? So whenever, and everybody has a phone now. So you can build it into that like a sachet product. And if you take this product, you have plain insurance, or you have plain telecom services. But if you take it along with this, you have a built-in insurance. So, these are the kind of innovation which can happen to be able to take products to the end customer in the rural and so on.
Thank you, Suresh.
Okay, thank you. That was an interesting session in such a short, sweet span of time. May I now request Mr. Siddharth Shah, moderator, to present a memento to Mr. Suresh Badami as a token of our appreciation and gratitude. To Mr. Piyush Trivedi as a token of our appreciation and gratitude. To Mr. S.V. Sundar Krishnan as a token of our appreciation and gratitude. To Mr. Rajiv Kumar Gupta as a token of our appreciation and gratitude. May I request Mr. Dr. M. Narendra to present a memento to Mr. Siddharth Shah, our moderator, as a token of our appreciation and gratitude. Thank you. A group photo panelist. Thank you to all the panelists. Ladies and gentlemen, now we move on to our final panel discussion. That is, what are the opportunities and challenges for inclusive growth in Vikasit Bharat? For which, I would like to invite the moderator of the session, Mr. Madhav Nair, CEO India, Bank of Bahrain and Kuwait BBK, and the elite panelists joining him on the days are Mr. Shaugata Bhattacharya, ex-Executive Vice President and Chief Economist, Axis Bank Limited, Mr. Soumyajit Nyogi, Director and Head Capital Markets, India Ratings and Research Private Limited, and Mr. Sanjay Agarwal, Senior Director, Care Ratings Limited. May I request all the panelists to take their seats on the dais? The session is over to you, Mr. Nair.
I think the topic for our panel discussion is what are the opportunities and challenges for inclusive growth in Viksit Bharat. But first of all, what is Viksit Bharat? The term means developed India, which represents the government vision to make India a developed nation by 2047 with economic growth, environmental sustainability, social progress and good governance. And the four pillars of Viksit Bharat are Yuva, Garib, Mahila and Kisan. This vision has many components from economic growth to all-inclusive development and imbibing technology innovation. So what we'll try to do in this panel discussion is try to find where we are currently and how is it that we could become Viksit Bharat, what are the challenges and opportunities. To begin with, I think I just read an article saying that the Indian economy is in a Goldilocks phase with strong growth and manageable macro stability risks, and it is expected that India is likely to maintain a potential growth of 6 to 7%, 6.5% to 7% year on year, at least till 2030. The macro economic indicators are also quite satisfactory, and the credit growth is at close to 16%. The country's manufacturing boom, energy transition, and digital infrastructure components continue to support economic expansion. Recently, we also read that S&P Global Ratings revised its outlook on India to positive from stable. But unfortunately, India's sovereign ratings continue to remain at the lowest rung of the investment grade for many years, despite a dramatic improvement. So, my first question to you, Sagata, is definitely you'll agree that a rating upgrade will reduce our cost of borrowing and it will significantly help in our long-term goal of Viksit Bharat. So what in your view should be done from India's perspective to improve our, even if we improve our credit rating by one notch, I am told that it will give a significant cost advantage.
Absolutely. So thank you, Madhav sir. Thank you, IMC, for this opportunity to be part of this panel. So by far the most important thing that needs to be done to improve our sovereign ratings is to manage our fiscal situation. So I was just looking at some numbers. India is growing, is the fastest growing large economy. The macro financials in India are very robust, very resilient. So it's the fisc that is keeping primarily. There are other factors as well, but it's the fiscal situation which is creating the problem. So one thing I must emphasize in this. So the solution is to keep on the sustaining the fiscal discipline consolidation that we have done so far on the fisc. So all our ASEAN type emerging market peers, they have very strangely a very similar set of ratings. We are BBB minus. They are say BBB or BBB plus. Only Malaysia, I think, is A. So the thing that India's weakness now is our level of sovereign debt. We are at about 82.5%. Only Brazil and strangely China are higher than India's. All the rest are 40, 50, 60 odd percent. This becomes a problem. India is not going to default on its debt. Our sovereign debt is completely local currency. There is no foreign currency involved. So there is absolutely nothing to default on debt. But what the problem, this high level of debt, is the high level of interest payment that we have to bear. And that constrains our ability to follow up on many development expenditures. So ultimately, it is a situation on the fisc. And we are very, very confident about this, that in the next budget that you are seeing, from the original in the interim budget from 5.1% of GDP, we are probably going to take the fiscal deficit down even more, probably to 5 or 4.9% of GDP, and the target for 4.5% in FY26 will probably be met, and that's going to be a big boost.
And you expect that would make the rating agencies rethink about India's rating and give an upgrade?
Sitting from the outside, here is one, my colleague and friend from a ratings agency, so I'm not going to, but from an outside perspective, I would suggest that if we get a good fiscal response this time in the budget, we are going to see a ratings upgrade fairly soon in the country.
Sanjay, your take on that?
Thanks for having me out here. So we as a rating agency, we are a domestic rating agency, and we ourselves have plans to go international. Thanks. We are a domestic rating agency, and we plan to go international in terms of rating other sovereigns, etc., along with the support of Government of India and all. So internally, we have been discussing this sovereign rating a lot, and we have arrived at certain parameters on how to rate. So if you see what is constraining India's rating right now, the largest issue is the low per capita GDP, which means that the earnings per capita is low, so the ability of the country to invest on infrastructure and other things on a per capita basis is also low. And that situation is going to remain for a long time. Right now we are something around $2,500 to $2,600 per capita, for us to reach about a 5,000 level, which take a lot of time. So I think that constraint remains. So we do not expect too much of activity on that level. While the growth in the GDP is high, as Sugato sir says, but the base itself is very low. The other issue which was touched upon is the interest payment to the revenues of the government. Because of the high interest rates in the past, we have a very high, and the low tax base. The tax revenues to GDP is very low at about 11-12% on a central government basis, whereas in other countries about 24-25%. So because of that, our interest payment to revenues of the central government is very high, almost like 25%, whereas a more comfortable level would be something around 5 to 10%. So there also we are constrained. It's probably the figures for other countries will move up since their interest rates are now higher. But otherwise our interest rates are high and our interest to the revenues of the government will remain high. So we are constrained on that aspect. The third aspect is the institutional framework. The institutional framework in India, while it developed a lot from our eyes, but it still remains not so strong, right? We have cases running up to 30, 40 years and there is no certainty that justice will be delivered in a couple of years, etc. So these are the 3-4 things which look bad. Incidentally, globally, when you do sovereign rating, the payment track record is not given very high importance, the way we give credit to payment track record in India. And in external payments, we are very strong because we have very little of external liabilities, whereas we have a very strong sector service in services, which is servicing the external sector. And last thing, I think the last weakness from our side is on the reserve currency. Euro and dollars are reserve currency, and you can raise resources against those currencies very fast. Whereas raising resources against Indian currency in the global market is weak. So it's very difficult for us to move on those counts. Now, what are the differences between where the global rating agencies do and the way we think we should be working on? One is the sheer size of the economy is not taken into account because that itself gives a lot of resilience. We are the 3rd to 4th largest economy in the world, the way you see it. The political stability in India has been high for the last 10 years. Somewhere that has not been fully factored in. So as a weak economy, it's suspected that the political stability is weak, which actually is not very wrong, but not totally right. Right, and then the last thing is that the global economy don't require so much of capex, but Indian economy requires a lot of capex. While that brings in a lot of liabilities, but it also gives you a lot of opportunities for improving the quality of business. Because of that, while the rating is low right now at BBB minus, and other countries which have probably defaulted at some point of time would have a rating of something around A or something, but we don't expect it to move significantly, let's say to by a 3 or 4 notches in, let's say, 10 years. That's
in the short term, do you see at least a 1 notch up?
Short term would mean at least from the, if you're seeing from the eyes of a global rating agencies where the focus is not on India as much as it's on Europe or US, probably a short term would mean 2 years. Otherwise, like rating agency of Japan, etc., have a rating of BBB plus because it's more Asia centric. And that is how it is. The other question is on the interest rates. If you borrow in the international market, the rates Indian government and sovereign companies are now getting is linked to something around the A minus or A levels. So we are already getting a very fine interest rate. So to that extent, the rating would not immediately matter as much.
Thanks. A slightly more controversial one. A month back or so, a CEO of a large Indian company during an investor call pointed out to the lack of correlation between India's GDP growth figure and the metrics of certain core sectors, expressing lack of surety over how to read the real GDP. Of course, he later gave us clarification saying that he was not questioning the GDP numbers. But Swamijit, how do you read this?
Thanks IMC and thanks Madhav for invitation. The first thing would like to highlight one thing, that the diffusion of the digitization, what we saw during the 2001 or 2002, the internet boom was giving this kind of surprise when it took time for understand to decipher the actual impact on the society, actual impact on the economy, that how the internet and the tech boom helping that overall business. So some kind of this digitization is also happening. So that is the reason that every time you see the quarterly GDP forecast, whether it is regulator, whether it is market economics, or whether it is economics from the other, whatever, everyone is missing the GDP growth, and GDP is continuously surprising on the higher side. That's one. Second, yes, one of the factor that we have to keep in mind, the taxes and the subsidy, that is one of the key factor, and the divergence between the GDP and the GVA, it's continuously on an elevated level. Now coming to the core point, that many people ask the same question, that if the GDP is going 8%, GDP is going at the double digit on a nominal basis, but it is not, somewhere it is not visible, it is not, I can't feel it, that animal spirit. The simple example or the simple what I say explanation is that the private final consumption, that is one of the key factor that you can feel everywhere when you go to mall, when you go to everywhere. That is obviously growing, but growing at a much lower rate compared to any other constituent. I think that is one of the key challenge, that the infrastructure is going, government spending is being on a very higher side, but that is only one thing which is at the very modest level, which is private final consumption, and it cannot be, either the GDP has to come down little bit or the private consumption has to catch up. Two example, in every decade you find there was a company emerge from the US and rule the world, and decade after decade. We talk about the Microsoft, followed by the Google, followed by the Apple, followed by everywhere. We need such kind of company, which is only possible unless until you start spending heavily on the R&D, and that's the only sutra.
From the corporate side, I think this is a problem in India. I haven't mentioned this specifically, MSMEs. Because this is the way, the path to both increasing productivity as well as employment. So this is something that we need to pay a huge amount of attention to. You'll see in all organizations that the MSMEs, how to increase MSMEs, and this is that missing middle of India's corporate sector. So this is something which is very, very important. And on MSMEs, an equally important part is the access to credit, increasing access to credit to the MSME sector, to my mind, from the corporate side.
One question I have to also ask now. This net savings, recent days, a lot of reports suggest that the net financial savings are lowest, whereas the financial liabilities are going very heavy. And of course, Reserve Bank also came on the unsecured loan. But two two figure, one is investment to GDP, another is savings to GDP. So how do you see this trend? If one side just we become a more debt-oriented individuals, but not savings, and the other side you are also knowing the deposit growth is not keeping in phase, where the credit growth are going up, and Reserve Bank recently also voiced that. So how these things will shape up, at least in the next 5 to 10 years?
Yeah, that's definitely a challenge. So the country with a debt to GDP of 80 to 83%, way higher than any BBB rated country on a sovereign parlance, and public debt is already at the elevated level. And if you try to see that the household debt is also rising with the low per capita income, plus a skewed distribution, that's a challenge. For the banks, yes, that's the biggest challenge. So it is not that the banks are only facing competition within the bank, they are facing competition among others. So the question is that why it is happening. So the convenience, what we have it is increasing. So with one click you can invest anywhere, with one click you can liquidate your investment. So banks, they have to offer higher rates, and how they can pass it on, they have to think about it. That's the only solution.
So the transmission of rates, as that happened in the credit, same thing has happened in the deposit also now, recently.
Yes, but in the few pockets, yes. But still, if you look at the savings rate is 2.5. Yes, the 16%, 17% is the credit growth, that the savings bank rate is still 2.5. When the credit growth was around 8-9% last decade, that time they had reduced the savings rate. And that is why the people are putting money in the small liquid fund, all those things.
So 10 seconds. I mean, so one, on the deposit side, this is very clear from this is an effect of the RBI's constriction of liquidity. From about a 4.5 lakh crores daily average liquidity that the RBI used to to inject into the system, we are now into a deficit of 1 lakh, 1.5 lakhs. So that obviously there's no money in the market, so there's no savings in the market. So I mean, so one thing is clear. The other part on savings is, again, so financial savings has come down, but physical savings has actually increased. So what is happening is people are, I mean, when I buy a house, I have to pay EMIs for the house. So that reduces my savings. But I'm building up equity in that property. So that physical savings is what accounts for this mismatch in terms of savings and assets and liabilities of the household.
Thank you all. I thank my fellow panelists for a very, very endearing session. And thanks IMC and Dr. Narendra for this, giving us this opportunity. Thank you.
Thank you. Thank you very much. May I now request Mr. Madhav Nair to present a memento to Mr. Shaugata Bhattacharya as a token of our appreciation and gratitude. To Mr. Soumyajit Niyogi as a token of our appreciation and gratitude. To Mr. Sanjay Agarwal as a token of our appreciation and gratitude. May I request all of you all to stand for a group photo. Please stand for a group photo. So after a thought-provoking long day of knowledge sharing in banking, finance, insurance, we are finally concluding the day, and for that, may I request Mr. Ajit Mangrulkar, Director General, IMC Chamber of Commerce and Industry, to kindly present the vote of thanks. Over to you, sir.
Thanks a lot. Thank you, Selby. And all good things must come to an end. So this also brings us to an end of the 14th Annual Banking and Finance Conference organized by the IMC Chamber of Commerce and Industry. Our grateful thanks to our chief guest, Dr. Shrikanta K. Panigrahi, Honorable Director General and Distinguished Research Fellow, Indian Institute of Sustainable Development, New Delhi. And to all our guests of honor, Mr. Surendra Rana, DMD, Agri, SME and FI, State Bank of India. Mr. Sumnesh Joshi, Deputy Director General, Joint Secretary, Government of India level, Ministry of Communications, Government of India. Thank you to all our speakers, moderators, participants and press for being part of this conference. It was an extremely enriching day. IMC is grateful to our gold sponsor, State Bank of India, our silver sponsors, Kia AI and Shriram Finance Limited, and to all our logo sponsors, Mahindra Finance, Ugro Capital Limited, Credible ESG and Rupee Boss Financial Services Private Limited for supporting this conference. Thank you, Deloitte, for being the knowledge partner and releasing the conference knowledge paper. Last but not the least, I would like to acknowledge and thank our Banking Committee Chairman, Dr. Narendra, Mr. P.D. Singh, and the entire Banking Committee of IMC for putting up a fantastic program. If you have seen the content, I think the content has been brilliant. We had a packed house right until now. Of course, it's towards the end of the day, so we expect that only the people interested in the sessions will be there. But it was a great event. We've had great press coverage. And thank you, sir, for everything. Thank you, PD, for your stellar support to this, and I'm sure that going forward you will see better and bigger conferences. And of course, I would like to thank the entire IMC team. You see the entire team standing here. A big round of applause for them, especially Bharti, who is the OIC for this. She is a very silent worker, but she delivers results. And of course, my right hand, Sanjay Mehta and Sheetal Kalro, and the rest of the team, because I know it's very easy to say, it's just a conference, but there's so much that goes behind it. I mean, with the committee and all so if I start naming, probably we'll have all our entire staff being named, but thank you everyone. It's a brilliant show, and of course to our MC Selby, who you've seen probably in every show that we have. Thank you so much. She's absolutely spot on. So thank you so much. Thank you for being a patient audience, and have a great day and a great weekend. Thank you.